McGraw-Hill Ascent Audio presents Winning the Loser's Game, Timeless Strategies for Successful Investing, 8th edition, by Charles D. Ellis. Narrated by Andrew B. Werlin. Publisher's note. In this audio edition, you will hear references to figures and tables present in the print and ebook formats of the book. Forward. Metaphors can have powerful influence on how we think and act, and can have enormous impact on real-world outcomes. Metaphors can move minds and markets. To take one well-known example, Adam Smith's invisible hand had a major effect on economic thought and became the essential intellectual foundation for free market capitalism. Charlie Ellis has created a metaphor that has enjoyed a similar kind of influence on investment management. Winning the Loser's Game was first released in 1985, although the germ of the idea was published in a professional article a decade earlier. Using the game of tennis as an example, Ellis shows that amateur tennis players are often their own worst enemies. When playing against other amateurs, the winner is not usually the one with the best drop shot or most powerful serve, as in professional matches. Rather, it is the player who makes the fewest unforced errors. Thus, the best strategy is simply to try to return the ball and wait for the other player to make a mistake. By analogy, the optimal strategy in investing is to avoid trying to beat the market. The successful investor simply buys and holds a broad-based index fund that contains all the stocks that are available and waits for Mr. Market eventually to reflect the growth in the economy. Actively buying and selling shares involves extra costs and higher taxes and is very likely to lead to unforced errors. As markets have developed over time and new editions of the book have come out, it has become increasingly clear that the Ellis advice is applicable for most professional investors as well as amateurs. A century ago, over 90% of the trading on our stock exchanges was done by individuals. In such a market, professionals with quicker access to information could hope to gain an advantage over unsophisticated investors and outperform a passive index fund. But over time, it has come to be the case that most individuals invest in mutual funds and exchange-traded funds with institutions that run their retirement plans, and over 90% of the trading is now done by professionals. In this environment, outperformance is likely to be very rare, even for the most skilled professionals. In this new edition of Winning the Loser's Game, Ellis documents that the vice of data is now tightening, and new evidence reveals that the thesis of earlier editions holds with even greater force. Standard & Poor's has become the unofficial scorekeeper of investment performance. Publishing semi-annual SPIVA reports, the company documents how active managers have performed versus broad S&P stock indexes. The data shows that each year, over two-thirds of managed funds are outperformed by the broad S&P 1500 stock index. Moreover, those active managers who outperform in one year are not the same as those who beat the market in the next. When one examines 15-year records of professional money managers, over 90% must hold their heads in shame versus a low-cost, broad-based index. Moreover, the percentage of active investors who outperform the market has been steadily falling over time. Actively buying and selling individual stocks in a futile attempt to beat the market is truly a loser's game. Ellis's message is particularly timely today. In this age of COVID-19, with millions sheltered at home, a pandemic of gambling has infected Americans as well as those in Europe and Asia. Sports betting is setting new records, and gambling on the stock market has become a national pastime. Zero-commission trading has prompted legions of individual investors to confuse gambling with investing and to become day traders. We have witnessed bankrupt companies quintuple in value, only to fall back later to their original valuations. The most favored stocks on Robinhood, a popular online trading platform, tend to be among the riskiest and most volatile. For example, Tesla is a stock that has moved as much as 25% in a single day. Several studies have documented how poorly individual traders actually do in the stock market. Barber and Odine of the University of California analyzed the active trading accounts of the discount broker Charles Schwab over a 6-year period. They found that those active traders substantially underperformed a simple low-cost index fund. And the traders who traded the most had the worst returns. In another study by them, together with Taiwanese researchers, the trades of day traders in Taiwan, where the practice has been especially popular, were analyzed over a 15-year period. It turned out that less than 1% of day traders were able to beat the market returns available from a low-cost ETF, and over 80% of them actually lost money. In a study of day trading in Brazil, the results were even more devastating. Only 3% of day traders made money. In this delightfully written new edition, Ellis shows that serious investing involves broad diversification, rebalancing, active tax management, avoiding market timing, staying the course, and using indexed investment instruments with rock-bottom fees. Of particular note in this update is the warning that investors need to reconsider the use of bonds during an age of financial repression. Central banks throughout the world have pushed bond yields near zero, and even to negative returns in Europe and Asia. In such an environment, even if inflation remains subdued at under 2%, Ellis warns that bonds are hard to justify as appropriate long-term investments. With timely advice such as this, listeners who follow the Ellis recommendations will significantly improve their odds of becoming winners in the investment game. Burton G. Malkiel. Preface. Lucky me. Married to a wonderful and inspiring woman, I was born in the United States, privileged in education, blessed with parents, children, and grandchildren I like, admire, and enjoy, and also blessed with an unusually wide global circle of friends in investment management, an endlessly fascinating profession, and a remarkably favored business, replete with bright, engaged, and creative people. Investing can seem way too complex, and investing wisely can seem to take too much time. Most individuals are too busy to take the time to learn all about it. They and you have better things to do. With increasing concern, I've seen the long-term professionalism that attracted me to investing get increasingly compromised by short-term commercialism and growing numbers of investors worrying about the uncertainties about how to manage investments for the long term. With all my advantages comes a clear responsibility to serve others. That's why I wrote this book. Over the past half-century, the securities markets have changed massively, and in many ways, creating an overwhelming problem for individual and professional investors. Those profound changes are explained in Chapter 1, The Loser's Game. Raised in a tradition that if you recognize a problem, you should look for a good solution, I've written this short book of straight talk. Each listener can understand the realities he or she faces and know how to take appropriate action to convert the usual loser's game into a winner's game, in which every sensible investor can and should be a long-term winner. As Winston Churchill so wisely observed, people like winning very much. We all like winning with investments, and we all can win at lower costs, less risk, and less time and effort if we can clarify our real objectives, develop sensible long-term policies, and stick with them so the market's fluctuations are working for us, not against us. In over 50 years of learning about investing from outstanding practitioners and expert theorists around the world, I've tried to collect, distill, and explain clearly and as plainly as possible the principles for successful investing, for both individual investors and institutional investors who have the necessary self-discipline and wish to avoid the loser's game. The simple messages in this short book are now and will be the keys to success in the winner's game of sensible investing for the next 50 years. Companies change, and markets and economies go up and down, sometimes a lot. But the core principles of successful investing never change, and never will. That's why, when you've listened to this book, you'll know all you really need to know to be successful in investing. Charles D. Ellis, New Haven, Connecticut, March 2021. Chapter 1. The Loser's Game. Disagreeable data are streaming steadily out of the computers of performance measurement firms. Over and over again, these facts and figures inform us that most mutual funds are failing to perform or beat the market. The same grim reality confronts institutional investors, such as pension and endowment funds. Occasional periods of above-average results raise expectations that are soon dashed as false hopes. Contrary to their often articulated goal of outperforming the market averages, investment managers are not beating the market. The market is beating them. Faced with information that contradicts what they believe, people tend to respond in one of two ways. Some ignore the new knowledge and hold firmly to their old beliefs. Others accept the validity of the new information, factor it into their perception of reality, and put it to use. Most investment managers and most individual investors, being in a sustained state of denial, are holding on to a set of romantic beliefs developed in a long-gone era of different markets. Their romantic views of investment opportunity are repeatedly and increasingly proving to be false. Investment management, as traditionally practiced, is based on a single core belief. Investors can beat the market, and superior managers will beat the market. That optimistic expectation was reasonable 50 years ago, but not today. Times have changed the market so much in so many major ways that the premise has proved unrealistic. In round numbers, over 1 year, 70% of mutual funds underperform their chosen benchmarks. Over 10 years, it gets worse. Nearly 80% underperform. And 15 years later, even worse. The number is nearly 90%. Yes, several funds beat the market in any particular year, and some in any decade. But scrutiny of the long-term record reveals that very few funds beat the market averages over the long haul. And nobody has yet figured out how to tell in advance which funds will do it. If the premise that it is feasible to outperform the market were true, then deciding how to go about achieving success would be a matter of straightforward logic. First, because the overall market can be represented by a public listing, such as the S&P 500 or the Wilshire 5000 Total Market Index, a successful active manager would only need to rearrange his or her portfolios more productively than the mindless index. The active manager could choose to differ from the chosen benchmark in stock selection, strategic emphasis on particular groups of stocks, market timing, or various combinations of such decisions. Second, because an active manager would want to make as many right decisions as possible, he or she would assemble a group of bright, highly motivated professionals whose collective purpose would be to identify underpriced securities to buy and overpriced securities to sell. And, by shrewdly betting against the crowd, to beat the market. With so many opportunities and so much effort devoted to doing better, it must seem reasonable to casual observers that experienced experts working with superb information, powerful computer models, and great skill would outperform the market, as they so often did decades ago. Unhappily, the basic assumption that many institutional investors can outperform today's market is false. Today, the institutions are the market. They do nearly 95% of all listed stock trades and derivatives trades. It is precisely because investing institutions are so numerous and capable and so determined to do well for their clients that investment management has become a loser's game. Talented and hardworking as they are, professional investors cannot, as a group, outperform themselves. In fact, given the operating costs of active management, fees, commissions, market impact, and taxes, many active managers will underperform the overall market every year, and over the long term, a large majority will underperform. Individuals investing on their own do even worse. On average, much worse. Day trading is the worst of all, a sucker's game. Don't do it. Ever. Before analyzing what happened to convert institutional investing from a winner's game into a loser's game, consider the profound difference between the two kinds of games. Dr. Simon Ramo, a scientist and one of the founders of TRW Inc., identified the crucial difference between a winner's game and a loser's game in an excellent book on game strategy, Extraordinary Tennis for the Ordinary Tennis Player. Over many years, Ramo observed that tennis is not one game but two, one played by professionals and a very few gifted amateurs, and the other played by all the rest of us. All the players in both games use the same equipment, rules, and scoring, and both conform to the same etiquette and customs. They play two very different games. After extensive statistical analysis, Ramo summed it up this way. Professionals win points. Amateurs lose points. In expert tennis, the ultimate outcome is determined by the actions of the winner. Professional tennis players hit the ball hard with laser-like precision through long and often exciting rallies until one player is able to drive the ball just out of reach or force the other player to make an error. These splendid players seldom make mistakes. Amateur tennis, Ramo found, is almost entirely different. Amateurs seldom beat their opponents. Instead, they beat themselves. The actual outcome is determined by the loser. Here's how. Brilliant shots, long and exciting rallies, and seemingly miraculous recoveries are few and far between. The ball is all too often hit into the net or out of bounds, and double faults at service are not uncommon. Rather than try to add power to our serve or hit closer to the line to win, we should concentrate on consistently getting the ball back so the other player has every opportunity to make mistakes. The victor in this game of tennis gets a higher score because the opponent is losing even more points. As a scientist and statistician, Dr. Ramo gathered data to test his hypothesis in a clever way. Instead of keeping conventional game scores, 15 love, 15 all, 30-15, and so forth, he simply counted points won versus points lost. He found that in expert tennis, about 80% of the points are won, whereas in amateur tennis, about 80% of the points are lost. The two games are fundamental opposites. Professional tennis is a winner's game. The outcome is determined by the actions of the winner. Amateur tennis is a loser's game. The outcome is determined by the mistakes of the loser who defeats himself or herself. The distinguished military historian Admiral Samuel Eliot Morison made a similar central point in his thoughtful treatise, Strategy and Compromise. In warfare, mistakes are inevitable. Military decisions are based on estimates of the enemy's strengths and intentions that are usually faulty, and on intelligence that is never complete and often misleading. Other things being equal, the side that makes the fewest strategic errors wins the war. War is the ultimate loser's game. Amateur golf is another. Tommy Armour, in his book How to Play Your Best Golf All the Time, says, "The best way to win is by making fewer bad shots." This is an observation with which all weekend golfers would concur. There are many other losers' games. Like institutional investing, some were once winners' games, but have changed into losers' games with the passage of time. For example, 100 years ago, only very brave, athletic, strong-willed young people with good eyesight had the nerve to try flying an airplane. In those glorious days, flying was a winner's game. But times have changed, and so is flying. If the pilot of your 747 came aboard today wearing a 50 mission cap and a long white silk scarf around his or her neck, you'd get off the plane. Such people no longer belong in airplanes because flying today is a loser's game with one simple rule: don't make any mistakes. Often, winners' games self-destruct because they attract too many players, all of whom want to win. That's why gold rushes finish ugly. The money game, we still call investment management, evolved in recent decades from a winner's game to a loser's game because a basic change occurred in the investment environment. The market came to be overwhelmingly dominated by investment professionals, all knowing the same superb information, having huge computer power, and striving to win by outperforming the market they collectively completely dominate. No longer is the active investment manager competing with overly cautious custodians or overly confident amateurs who are out of touch with the fast-moving market. Now he or she competes with hundreds of thousands of other hard-working investment experts in a loser's game where the secret to winning is to lose less than the others lose, by enough to cover all the costs and fees. The central problem is clear. As a group, professional investment managers are so good that they make it nearly impossible for any one of them to outperform the market, the expert consensus they collectively determine. Today's money game includes a truly formidable group of competitors. Several thousand institutions, hedge funds, mutual funds, pension fund managers, private equity managers, and others operate in the market all day, every day, in the most intensely competitive way. Among the 50 largest and most active institutions, which do half of all trading, even the smallest spends $100 million in a typical year buying services from the leading broker-dealers in New York, London, Frankfurt, Tokyo, Hong Kong, and Singapore. Understandably, these formidable competitors want to get the first call with important new analytical insights, But the Securities and Exchange Commission now requires publicly owned companies to make every effort to assure that all investors get the same useful information at the same time. Thus, almost every time individual investors buy or sell, the other fellow they trade with is one of those skillful professionals. With all their experience, all their information, all their computers, and all their analytical resources. And what a tough group of skillful professionals they are. Top of their class in college and graduate school, they are the best and the brightest. Disciplined and rational, supplied with extraordinary information by thousands of expert analysts who are highly skilled and are all playing to win. Sure, professionals make mistakes, but the other pros are always looking for any error so they can pounce on it. Important new investment opportunities simply don't come along all that often, and the few that do certainly don't stay undiscovered for long. Regression to the mean, which is the tendency for behavior to move toward a normal, is a persistently powerful phenomenon in physics, sociology, and investing. The key question under the new rules of the game is this: how much better must the active mutual fund investment manager be to at least recover the costs of active management? The answer is daunting. If we assume 80% annual portfolio turnover, implying that the fund manager holds a typical stock for 14 months, which is slightly longer than average for the mutual fund industry, and we assume average trading costs, commissions plus the impact of big trades on market prices, of 1% to buy and 1% to sell, plus 1.25% in mutual fund fees and expenses, the typical fund's operating costs before taxes are 3.25% per year. So an active manager must overcome a drag of about 3.25% in annual operating costs just to break even. For the fund manager to match the market's generally expected 7% future rate of return, he or she must return 10.25% before all those costs. In other words, to do merely as well as the market net, an active manager must be able to outperform the market, the consensus of experts, in gross returns at more than 46%. Achieving such superiority is, of course, virtually impossible in a market dominated by professional investors who are intensely competitive and extraordinarily well-informed and are continuously looking for any opportunity to exploit. That's why the stark reality is that most active managers and their clients have not been winning the money game. They have been losing. So the burden of proof is surely on the manager who says, "I am a winner. I can win the money game." For any one manager to outperform the other professionals, that manager must be so skillful and so quick that he or she can regularly catch the other professionals making mistakes and systematically exploit those mistakes faster than the other professionals can. Even the pros make macro mistakes, particularly being fully invested together at market peaks, trying to anticipate the anticipation of the other pros, who, of course, are anticipating one another's anticipations. When they make micro mistakes, they correct their errors quickly or see them exploited and quickly corrected by their professional competitors. The reason investing has become a loser's game, even for dedicated professionals, is that their efforts to beat the market are no longer the most important part of the solution. They are now the most important part of the problem. As we learn in game theory, each player's strategy should incorporate an understanding and an anticipation of the strategies and behavior of other players. In the complex problem each investment manager is now trying to solve, his or her efforts to find a solution, combined with the same efforts of many expert competitors, have become the dominant adverse reality facing all active managers. It's not the individual active manager's fault that his or her results are so disappointing. The competitive environment within which active managers work has changed dramatically in the past 60 years, from quite favorable to very adverse. And it keeps getting worse because so many brilliant and hardworking people with extraordinary equipment and access to superb information keep joining in the competition. To achieve better than average results through active management, you must depend directly on exploiting the mistakes of others. Others must act as though they are willing to lose, so you can win after covering all your costs of operation. Back in the 1960s, When institutions did only 10% of public trading and individual investors did 90%, large numbers of amateurs were, realistically, bound to lose to the professional active managers. Now, most professional managers are also destined to lose. Working efficiently, as Peter Drucker so wisely explained, means knowing how to do things the right way. But working effectively means doing the right things. Because most investment managers will not beat the market in the future, all investors should at least consider investing in index funds so they will never get beaten by the market. Indexing may not be fun or exciting, but it works well. The data show that index funds have outperformed most investment managers. And the challenges to active managers have been getting tougher as professionals have increasingly dominated the market. For most investors, although figuring out the optimal investment policy can be difficult, that is not the hardest part of real-life investing. The hardest part is staying committed to a sound investment policy through bull and bear markets and maintaining what Disraeli called constancy to purpose. Being rational in an emotional environment is never easy. Holding on to a sound policy through thick and thin is both extraordinarily difficult and extraordinarily important work. This is why investors can benefit from developing and sticking with sound investment policies and practices. The cost of infidelity to your own commitments can be very high. Sustaining a long-term focus during market highs or market lows is notoriously difficult. At either kind of market extreme, emotions are strongest when current market action appears most demanding of change and the apparent facts seem most compelling. An investment advisor's proper professional priority is to help each client identify, understand, and commit consistently and continually to long-term investment objectives that are both realistic in the capital markets and appropriate to that particular investor's true objectives. Investment advice should help investors choose the right objectives and stay the course. Before examining the many powerful changes in the investment world, let's remind ourselves that active investing is, at the margin, always a negative-sum game. Trading investments among investors would by itself be a zero-sum game, except that the large costs, as a percentage of returns, about 15%, of management fees and expenses plus commissions and market impact must be deducted. These costs total in the billions of dollars every year. Even more discouraging to investors searching for superior active managers is the evidence that managers who have had superior results in the past are not particularly likely to have superior results in the future. In investment performance, the past is not prologue, except for the grim finding that those who have repetitively done badly are likely to stay in their slough of despair. The one encouraging truth is that while most investors are doomed to lose if they play the conventional loser's game of trying to beat the market through active investing, every investor can be a long-term winner. To be long-term winners, we need to concentrate on setting realistic goals and developing sensible investment policies that will achieve those objectives, and then have the self-discipline and fortitude required for persistent implementation of those policies so each of us can enjoy playing a true winner's game. That's what this book is all about. Chapter 2. The Winner's Game. Everyone likes to succeed in investing. Millions of people depend on investment success to assure their security in retirement, to provide for their children's education, or to enjoy better lives. Schools, hospitals, museums, and colleges depend on successful investing to fulfill their important missions. When investment professionals help investors achieve their realistic long-term objectives, investment management is a noble profession. The accumulating evidence, however, compels the recognition that most investors are suffering serious shortfalls. The largest part of the problem is that investors make mistakes, but they are not alone. Investment professionals need to recognize that much of the real fault lies not with their clients, but with themselves. Fortunately, all professional investors can and should make changes to help ensure investing is, for both their client investors and themselves, truly a winner's game. For all its amazing complexity, the field of investment management really has only two major parts: One is the profession, doing what is best for the returns for investment clients, and the other is the business, doing what is best for the profits of investment managers. As in other professions, such as law, medicine, architecture, and management consulting, there is a continuing struggle between the values of the profession and the economics of the business. Investment firms must be successful at both to retain the trust of clients and to maintain a viable business. In the long run, the latter depends on the former. Investment firms are losing the struggle to put professional values and responsibilities first and business objectives second. To stop losing this struggle, investment firms need to offer investment counseling and work more closely with professional investment advisors or registered investment advisors to help clients focus on the game that they can win and is worth winning. Fortunately, what is good for professional fulfillment can also be good for investment firms' business, because delivering what clients need is always, in the long run, good business. While the investment profession, like all learned professions, has many unusually difficult aspects that require great skill, it too has just two major parts. One is the increasingly difficult task of price discovery. Somehow combining imaginative research and astute portfolio management to achieve superior investment results by outsmarting the ever more numerous professional investors who now dominate the markets and collectively set the prices of securities. Always interesting and often fascinating, the work of price discovery and competing to beat the market, as we shall see, has been getting harder for many years and is now extraordinarily difficult. That's why most active investors are not beating the market, and the market is beating them. The second major part, and the most valuable part of what investment professionals can do is, fortunately, the least difficult: to provide investment advice. Difficulty is not always proportional to importance. In medicine, simply washing hands has proved to be second only to penicillin in saving lives. Experienced investment professionals can help each client think through and determine the sensible investment program most likely to achieve the client's realistic long-term objectives. This will include the client's own tolerance for various risks, such as variations in income, changes in market values, or constraints on liquidity. This can help each client stick with a sensible investment program, particularly when markets seem full of exciting, this time it's different opportunities, or fraught with disconcerting, it's gotten even worse threats. Success in staying on course is not simple or easy, but is much easier and far more important and has far more impact than success in active management. With the new tools available to investment advisors, this is getting easier, even as superior active investing is getting steadily harder. With remarkable irony, those devoting their careers to active investing have unintentionally created for themselves three kinds of errors. Two kinds are errors of commission with increasingly serious consequences. The third is an even graver error of omission. The first error is to define their mission falsely to clients and prospective clients as beating the market. 50 years ago, those taking up that definition of mission had good prospects of success. But those years are long gone. In today's intensely competitive securities markets, few active managers outperform the market over the long term. Most managers fall short, and in terms of magnitude, underperformance substantially exceeds outperformance. In addition, identifying the few managers who will be the future winners is notoriously difficult, and the rate of subsequent failure among one-time market leaders is high. The grim reality of this first error of commission is that active investment firms continue selling what most of them have not delivered, and in all likelihood will not deliver: beat the market investment performance. The second error of commission is allowing the values of the investment profession to become dominated by the economics of the investment business. It is at least possible that the talented and competitive people attracted to investment management have, however unintentionally, gotten so caught up in the superb economic rewards of the investment business to them that they are not asking potentially disruptive questions about the real value of their best efforts, particularly when they know they are unusually capable and working terribly hard. Consider the two main ways the profitability of investment management has increased over the past 60 years. Assets managed, with only occasional short pauses, have risen many, many times, partly due to market prices and partly due to increasing contributions. Fees, as a percentage of assets, have multiplied several times. The combination of these two forces has proven powerful. As a result of strongly increasing profitability in the investment management business, compensation for highly skilled individuals has increased nearly fivefold, and enterprise values of investment management organizations are way, way up. For clients, an even more important change has come in leaders and their priorities. As investment management organizations have gotten larger, it is not surprising that business managers have increasingly displaced investment professionals in senior leadership positions, or that business disciplines have increasingly dominated the old professional priorities. Business disciplines focus the attention of those with strong career ambitions on boosting profits, which is best achieved by increased asset gathering, even though investment professionals know that expanding the assets managed usually works against investment performance. When business dominates, it is not the friend of the investment profession or of clients. The third error, an error of omission, is particularly troubling. Losing sight of the professional opportunity to focus on effective investment advice and counseling. Most investors are understandably not experts on contemporary investing. Many need help. All would appreciate having access to the intelligent thinking and judgment that many investment professionals are well positioned to provide. Investors need a realistic understanding of the long-term and intermediate prospects for different kinds of investments. Risk and volatility first, rate of return second. So they will know what to expect and how to determine their strategic portfolios and investment policies. Still more important, most investors need help in developing a balanced and objective understanding of themselves and their investment situation, their investment knowledge and skills, their tolerance for risk in assets, income, and liquidity, their realistic time horizon, their financial and psychological needs, their financial resources, their financial aspirations and obligations in both the short and the long run, and the likely challenges they will face. Investors need to know that the problem they most want to address and solve is not beating the market. It is dealing effectively with the combination of those other factors, particularly their own ability to stay the course, that creates their reality as investors. Although all investors are the same in several ways, they are very different in many more ways. All investors are the same in that they have many choices and are free to choose. Their choices matter, and they want to do well and avoid doing harm. At the same time, all investors differ in many important ways. Assets, income, spending obligations and expectations, investment time horizons, investment skills, tolerance of risk and uncertainty, market experience, and financial responsibilities. With all these differences, most investors, both individuals and institutions, would benefit from professional help in developing a solid understanding of who they really are as investors, what investment program will work best for each of them, and how to hang in there and stay on plan when markets are most disconcerting. Skiing provides a useful analogy. At Vail or Aspen, thousands of skiers are enjoying happy days, partly because the scenery is beautiful, partly because the snow is plentiful and the slopes are groomed, but primarily because each skier has chosen the well-marked trails best suited to his or her skills, strength, and interests. Some like gentle bunny slopes, some like moderately challenging intermediate slopes. Some are more advanced. And still others want to try out trails that are challenging even for fearless experts in their late teens with spring steel legs. When each skier is on the trail that is right for her or him, and skiing that trail at the pace that is right for her or him, everyone has a great day, and all are winners. Similarly, when investment advisors guide investors to investment programs that are right for the individual client's investing skills and experience, financial situation, and tolerance for risk and uncertainty, most investors can achieve their own realistic long-term objectives. This is the important work of investment advice or counseling. Developing the investment program that is right for each unique investor is the real secret of how to succeed as an investment advisor. Because having the right plan and staying on that plan are the keys to long-term investment success. Chapter 3. The Grim Realities. The stock market is not your grandfather's stock market anymore. Truly massive changes have transformed the markets and investment management so greatly that beating the market is no longer a realistic objective, as more and more investors are slowly recognizing. Here are some of the changes over 60 years that have converted active investing into a loser's game. Trading volume on the New York Stock Exchange has increased more than 2,000 times, from about 3 million shares a day to over 6 billion. Other major exchanges around the world have seen comparable changes in volume. The mix of investors has changed profoundly. From 90% of total NYSE-listed trading on and off the exchange done by individuals who averaged one trade every year or two, to over 90% done by professionals or computers operating in the market all day, every day. And anyone with a long memory will tell you that today's institutional investors are far bigger, smarter, tougher, and faster than those of yore. Derivatives have surged in value, traded from nil to larger than the cash market, and almost all derivatives trading is institutional. Over 150,000 analysts, up from 60 years ago, have earned chartered financial analyst credentials, and an additional 200,000 plus are CFA candidates. Investment research reports from major securities firms produce an enormous volume of useful information that gets distributed instantly via the internet to hundreds of thousands of expert analysts and portfolio managers around the world, working in fast response decision-making organizations. Regulation Fair Disclosure, commonly known as Reg FD, has commoditized most investment information now coming from corporations. Public companies must tell everybody everything they tell anyone, and tell it all at the same time. What was once the treasured secret sauce of traditional research-based active investing is now, by law, just a commodity. Algorithmic trading, computer models, and numerous inventive quants are powerful market participants. Globalization, hedge funds, and private equity funds have become major forces for change toward consistent fair value for all securities. More than 345,000 Bloomberg terminals spew all sorts of data and virtually any desired analysis, 24 hours a day. The number of people earning their living in the capital markets has increased from about 5,000 to over 1 million. The internet and email have created a technological revolution in global communications. Investment professionals really are all in this together, and almost everyone knows almost everything all the time. As a result of these and many other changes, the stock markets, the world's largest and most active prediction markets, have become increasingly efficient. It is more and more difficult to compete successfully with all the smart, hard-working professionals, with all their information, computing power, and experience who set those market prices. And it's much, much more difficult for any investor to beat the market, the consensus of experts, after taking into account the costs and fees of active management. Sadly, most descriptions of performance do not even mention the most critical aspect of investing: risk. So, it is important to recall that the losers underperform the market 1.5 times as much as the winners outperform. Nor do the data adjust for taxes, particularly the high taxes on short-term gains that come with high portfolio turnover. Finally, performance for funds is usually reported as time-weighted, not value-weighted. So the reported data do not reflect the true investor experience. That can only be shown with the value-weighted record of how real investors have fared with their real money. It is not a pretty picture. Nor is it comforting to see the details of how clients, both individuals and institutions, turn negative toward their investment managers after a few years of underperformance and switch to managers with a hot recent record, positioning themselves for another round of buy high, sell low dissatisfaction, and obliterating roughly 1/3 of their fund's actual long-term returns. Individuals who actively manage their own investments notoriously do even worse. Unfortunately, this costly behavior is encouraged by investment firms that, to increase sales, concentrate their advertising on a few funds, clearly selected because of their stellar recent results, over carefully selected time periods that make good results look even better. Some fund managers have several hundred different funds, so they will always have at least some documented winners. In hiring new managers, individual investors tend to rely on past performance, even though studies of mutual funds show that for 9 out of 10 deciles of past performance, future performance is virtually random. Only the bottom decile's past results have predictive power, apparently because high fees and chronic incompetence have a repetitively negative impact on investment results. The sad truth is that time and again, investors, both institutional and individual, buy after the best results and sell out after the worst is over. This behavior is costly to investors. When they earn the trust and confidence of their clients, investment advisors can add far more to long-term returns than active managers can ever hope to produce. Effective investment counseling takes time, and learning the complexities of markets, investing, and investors is hard work. But it can be done, and done well, repeatedly. Successful advisors will help each client understand the risks of investing, set realistic investment objectives, be sensible about saving and spending, select the appropriate asset classes, allocate assets wisely, and not overreact to market highs or lows. Advisors can help their clients stay the course and maintain a long-term perspective. They do this by helping them understand what each type of investment can achieve over the long haul, how and when to anticipate market price fluctuations, how to understand predictably disconcerting market turbulence, and why to be confident that over the years, investment results will reward their patience and fortitude. Chapter 4. Beating the Market. The only way active investment managers can beat the market after adjusting for market risk is to discover and exploit other active investors' mistakes and overcome the, surprising to most of us, high costs of fees and market operations. Note that in a liquid professional market, prices are set by those with the most confidence that they know more than the current consensus and who are willing to commit substantial money to back up their judgments. Of course, in theory, beating the market can be done, and it has been done by many investors some of the time. However, very few investors have been able to outsmart and outmaneuver other expert investors often enough and regularly enough to beat the market over the long term, particularly after covering all the costs of playing the game. Ironically, the reason so few investors do better than the market is not because they lack skill or diligence, but rather because the markets are dominated by other investing experts who are also very capable and well-informed and working hard all the time with the best technology. In theory, active investment managers can try to succeed with one or a combination of 4 investment approaches: timing the market, selecting specific stocks or groups of stocks, making timely changes in overall portfolio structure or strategy, developing and implementing a superior long-term investment concept or philosophy. Casual observers of stock and bond markets will be impressed by the splendid array of apparent and enticing opportunities to do better than merely settling for average. The major changes in price charts for the overall market, for major industry groups, and for individual stocks make it seem deceptively obvious that the best active investors must be able to do better. After all, we've seen with our own eyes that the real stars perform consistently better than average in such diverse fields as sports, theater, law, and medicine. So why not in investing? Why shouldn't quite a few investment managers be consistently above average? And why should it be all that hard to beat the market? Let's take a careful look. The most audacious way to increase potential returns is through market timing. The classic market timer moves the portfolio in and out of the market so that it is fully invested during rising markets and substantially out of the market when prices are falling badly. Another form of timing would shift an equity portfolio out of stock groups that are expected to underperform the market and into groups expected to outperform. But remember, every time you decide to get into or out of the market, the investors you buy from or sell to are professionals. Of course, the pros are not always right. But how confident are you that you will be more right more often than they will be? What's more, market timers incur trading costs with each and every move, and unless you are managing a tax-sheltered retirement account, you will have to pay taxes every time you take a profit. Over and over, the benefits of market timing prove illusory. The costs are real and keep adding up. Investment history documents conclusively that the very first weeks of a market recovery produce a substantial portion of all the gains that will eventually be experienced. Yet it is at the crucial market bottom that a market timer is most likely to be out of the market, and thereby missing the very best part of the recovery gains. Market timing does not work because in today's highly competitive market, no manager is much more astute or insightful or has more or better information on a repetitive basis than all those professional competitors. In addition, many of the stock market gains occur in very brief periods and at times when investors are most likely to be captives of the conventional consensus. In a bond portfolio, the market timer hopes to shift into long maturities before falling interest rates drive up long bond prices, and back into short maturities before rising interest rates drive down long bond prices. In a balanced portfolio, the market timer strives to invest more heavily in stocks when they will produce greater total returns than bonds, then shift back into bonds when they will produce greater total returns than stocks, then into short-term investments when they will produce greater total returns than either bonds or stocks. Unfortunately, on average, these moves don't work because the sellers are just as smart as the buyers, and the buyers are just as smart as the sellers, and both groups know the same facts at the same time. And the more frequently these moves are tried, the more certainly they fail to work. Perhaps the best insight into the difficulties of market timing came from one experienced professional's candid lament. I've seen lots of interesting approaches to market timing, and I have tried most of them in my 40 years of investing. They may have been great before my time, but not one of them worked for me. Not one. Just as there are old pilots and there are bold pilots, but no old, bold pilots, there are no investors who have achieved recurring successes in market timing. The market does just as well, on average, when the investor is out of the market as it does when he or she is in it. Therefore, the investor loses money relative to a simple buy-and-hold strategy by being out of the market part of the time. Wise investors don't even consider trying to outguess or outmaneuver the market by selling high and buying low. They understand how important it is to stay on plan. One reason is particularly striking. Figure 4.1 shows what happens to long-term compounded returns when the few best days are removed from a record of nearly 10,000 trading days over 36 years. Taking out only the 10 best days, only 0.1% of the long period examined, cuts the average rate of return by 19%, from 11.4 to 9.2%. Taking away the 20 next best days cuts returns by an additional 17%, from 9.2 to 7.7%. Figure 4.2 shows a similar result when the best year or years are excluded from the calculation of the long-term averages. Using the S&P 500 average returns, the story is told quickly and clearly. In one study, all the total returns on stocks in 20 years were achieved in the best 35 days, way less than 1% of the 5,000 trading days over 2 decades. Imagine the Walter Mitty profits if we could simply know which days. Alas, we cannot and never will. What we now know is both simple and valuable. If you missed those few and fabulous best days, you missed all the returns over 2 long decades. In another study, removing just the 5 best days out of 72 years of investing would have reduced cumulative compound returns without dividend investments by nearly 50%. If an investor missed just the 10 best days over 112 years, that's 10 days out of 49,910 days, he or she would have missed 2/3 of the total gains. One of the ways investors hurt themselves over the long run is to get frightened out of the market when the market has been awful, and as a result miss the surprisingly important best days when the market turns. The lesson is clear. You have to be there when lightning strikes. That's why market timing is a truly wicked idea. Don't try it. The second theoretical way to increase returns is through tactical stock selection, or stock picking, by being better or faster at price discovery. Professional investors devote extraordinary knowledge, skill, time, and effort to this work, which dominates the research efforts of investing institutions all over the world. Through financial analysis and field research on a company's competitors and suppliers, as well as management interviews, professional investors strive to attain an understanding of the investment value of each security, or group of securities, that is better than the market consensus. When investment managers find or believe they have found a significant difference between the market price and the value of a security as they appraise it, they can buy or sell in an effort to capture for their clients' portfolios the differential between market price and true investment value. This attempt to get ahead of the competition at price discovery was at least possible before Reg FD and the commoditization of information that, with all the other changes, have made stock markets so hard to beat. Unfortunately, the work of security analysts, taken as a whole, does not appear to be a profitable activity. The stocks that investment managers sell after doing fundamental research and the stocks that they don't buy typically do about as well relative to the overall market as the stocks they do buy. Because they are so well informed, institutional investors collectively set the prices. That's why the only way to beat the market is to beat the professionals who, as a group, are the market. The problem is not that investment research is not done well. The problem is that research is done so very well by so many. Research analysts at major brokerage firms share their information and evaluations almost instantly through global networks with thousands of professional investors who strive to act quickly in anticipation of how others will soon act. As a result, it is very hard to gain and sustain a repetitive advantage over all the other investors on stock selection or price discovery. As experts sell to one another and buy from one another, academics say they are making the market pricing mechanism efficient or more accurate. Strategic decisions, the third way to try to increase returns in both stock and bond portfolios, involve making major commitments that affect the overall structure of the portfolio. These decisions are made to exploit insights into major industry groups, changes in the economy and interest rates, or anticipated shifts in the valuation of major types of stocks, such as emerging growth stocks or value stocks. Full of interesting potential, moving the portfolio to the right place at the right time, this approach to investing challenges the investor to discover a new edge, or way to invest, as markets shift, to become proficient at that new way, and then to abandon that new way for a new way when other investors have recognized the prior insight. In theory, of course, this can be done, but will it be done? Sure, it will be done, occasionally. But how often? And how often will a decision be a false positive? The long-term record is not encouraging. Another possible way to increase returns is for an individual portfolio manager or an entire investment management organization to develop a profound and valid insight into the forces that will drive superior long-term investment results in a particular sector of the market or a particular group of companies or industries, and then systematically exploit that investment insight through cycle after cycle in the business economy and in the stock market. An investment organization that is committed, for example, to growth stock investing will concentrate on evaluating new technologies, understanding the management skills required to lead a rapidly growing business, and analyzing the financial requirements for investing in new markets and new products to sustain growth. This organization will strive to learn from experience, including sometimes painful experience, how to discriminate between ersatz growth stocks that fizzle out and true growth companies that will achieve serial successes over many years. Other fund managers take the view that among the many large corporations in mature and often cyclical industries, there are always some that have considerably greater investment value than most investors recognize. Such investment organizations strive to develop expertise in separating the wheat from the chaff, avoiding the low-priced stocks that really ought to be low-priced. These managers believe that with astute research, they can isolate superior long-term values and, by buying good value at depressed prices, achieve superior returns for their clients with relatively low risk. The important test of an investment concept or philosophy is the manager's ability to adhere to it persistently for valid long-term reasons, even when the short-term results are disagreeable. The great advantage of a major conceptual or philosophical approach is that the investment firm can organize itself to do its own particular kind of investing all the time. Avoid the noise and confusion of distracting alternatives. Attract investment analysts and managers interested in and skilled at the particular type of investing and, through continuous practice, self-critique, and study, develop real mastery. The great disadvantage is that if the chosen kind of investing becomes obsolete, overpriced, or out of touch with the changing market, a focused specialist organization is unlikely to detect the need for change until it has become too late, both for its clients and for itself. What is remarkable about profound investment concepts is how few have been discovered that have lasted for long. This is most likely because the hallmark of a free capital market is that few, if any, opportunities to establish a proprietary competitive advantage can be found and maintained for that long. The market for good investment ideas is among the best in the world. Word gets around very quickly. All forms of active investing have one fundamental characteristic in common. They depend on the errors of others. Whether by omission or commission, the only way a profitable opportunity can be available to an active investor is for the consensus of other professional investors to be wrong. Although this sort of collective error does occur, we must ask how often these errors are made and how often any particular manager will avoid making similar errors at the same time and instead have the wisdom, skill, and courage to take correct actions opposed to the consensus. One way to increase success in lifelong investing is to reduce mistakes. Ask any golfer, tennis player, or driving instructor how beneficial reducing errors can be. With so many competitors simultaneously seeking superior insight into the value and price relationship of individual stocks or industry groups, and with so much information so widely and rapidly communicated throughout the investment community, the chances of discovering and exploiting profitable insights into individual stocks or groups of stocks, opportunities left behind by the errors and inattention of other investors, are certainly rare. Many investors make the mistake of trying too hard, striving to get more from their investments than those investments can produce, typically by borrowing heavily on margin to increase leverage and thus courting serious disappointment. All too often, trying too hard is eventually expensive because taking too much risk is taking too much risk. An opposite mistake investors make is not trying hard enough, usually by being too defensive and letting short-term anxieties dominate long-term thinking and behavior. Over the long run, it has been costly to maintain even a modest cash reserve within an equity portfolio. Even the most talented investment managers must wonder how they can expect their hard-working and determined competitors to provide, through incompetence, error, or inattention, sufficiently attractive opportunities to buy or sell on such a regular basis that they can repeatedly beat the market by beating them. Even after recognizing that market timing does not work, outside observers often wonder about the stock market's major moves. If the market is so darned efficient, why does it go up and down so much? Surely the true value does not go up so much or down so much, or, in either case, so swiftly. Of course not. But perceptions of future value always anticipate estimates of other investors' estimates of still other investors' estimates of other investors' estimates. And the best indicators of change in investors' estimates of estimates are changes in pricing. The market's short-term pricing mechanism is neither stable nor consistent. So, just as the apocryphal butterfly of chaos can change weather and cause violent storms, the market can appear to behave irrationally. Why? Because diligent, rational people, ready to react quickly to any change in perceptions of others' perceptions, try to anticipate a market that reacts to all sorts of bits and pieces of new information, or, of course, misinformation. That's why economists laugh about the stock market anticipating 9 of the last 3 recessions. But if all that noise and stock pricing were not rational, wouldn't someone have figured out by now how to profit from those collective errors? To see the reality through an analogy, imagine yourself at an antique fair with dozens of open booths. When you arrive, hoping to find some lovely things for your home, You are given one of 4 scenarios. In the first, you will have 2 hours, alone, to look over the merchandise and make your selections. In the second, you will be joined by 24 other special guest expert shoppers for the same 2 hours. In the third, you will be admitted to do your shopping for 2 days, along with 1,000 other special ticket holders, shortly after the 24 experienced special guests have spent 2 hours making their selections. In the final scenario, you will be one of 50,000 shoppers admitted on the third day of the fair after the experts have made all their decisions. In this last scenario, you may find a few objects you like at prices you think are reasonable, but you know you won't discover any antiques that are seriously mispriced bargains. Now, make a few more changes. All the shoppers are not only buyers looking for ways to upgrade their collections, they are also sellers, each bringing and hoping to sell antiques they own. In addition, the prices of all transactions, and all past transactions, are known to all the market participants, who all studied antiques at the same famous schools and all have ready access to the same curators' reports from well-regarded museums. This simple exercise reminds us that open markets with many expert and well-informed participants will do well at their primary function, price discovery. So, while a purist might correctly claim that the major stock markets of the world are not perfect at matching price to value at every moment in time, most prices are too close to value, or will so quickly move there for any investor to profit regularly from the errors of others by enough to cover the fees and costs of making the effort. And so, while the market is not perfectly efficient, it's no longer worth the real costs of trying to beat it. That's why more and more investors are coming to agree that if you cannot beat them, you can join them by indexing, particularly for the big 4 reasons. 1, the stock markets have changed extraordinarily over the past 60 years. 2, indexing outperforms active investing. 3, index funds are low cost. And 4, indexing investment operations enable investors to focus their time and attention on the policy decisions that are so important for long-term investment success. In the movie Full Metal Jacket, 2 crusty drill sergeants are watching their basic training class jogging in close order drill to their graduation ceremony, shouting military calls like, "Airborne, all the way." One drill instructor says, "Sarge, what do you see when you look at those boys?" After the classic expectoration, the other replies, "What do I see? I'll tell you, about 10% of those boys are honest-to-God soldiers." Pause. The rest are just targets. That's just a scene from a war flick, but it has real-life meaning for every investor to ponder. Here's a way to turn on the lights. Let's assume that you are so skilled and so well-informed that you are, in fact, in the top 20% of all individual investors. Bravo. Take a bow, but then watch out. Here's why. Even if you are a well above average individual investor compared with other individuals, you are almost certain to be making below average trades in markets now dominated by the trading experts who make millions of highly skilled trades each year and more trades each day than you and I would make in a lifetime. It's in the numbers. The first step into reality is to recognize that the key to market success is not your skill and knowledge as an investor compared with other individual investors, but the skill and knowledge with which each specific investment transaction is made. So if 90% of the pros trade with more skill and knowledge than you have, which is, alas, quite likely, your transactions will, on average, be buried deep in the bottom quartile of all transactions. In a paper titled, "Why Do Investors Trade Too Much?" Terence Odine, finance professor at the University of California, Berkeley, looked at nearly 100,000 stock trades made over 15 years by retail investors at a major discount brokerage firm. He found that, on average, the stocks these investors bought underperformed the market by 2.7 percentage points over the following year, while the stocks they sold outperformed the market by 0.5 points in the following year. Similarly, a paper published by Brookings Institution economists Joseph Lakonishok, Andrei Schleifer, and Robert Vishney showed that the stock trades made by professional fund managers subtracted 0.78% from the returns they would have earned by keeping their portfolios constant. Finally, The Plexus Consulting Group, a firm that researches the costs of trading for professional money managers, studied more than 80,000 trades by 19 investment firms and found that while the typical purchase of a stock added 0.67% to a fund's short-term return, the typical sale subtracted 1.8%. Casinos in Las Vegas, Macau, and Monaco are busy every day, so we know not everyone is entirely rational. If you, like Walter Mitty, still fantasize that you can and will beat the pros, you'll need both good luck and our prayers. Meanwhile, experienced investors understand 4 powerful truths about investing, and wise investors will govern their investing by adhering to them. 1. The dominating reality of investing is that the most important decision is your chosen long-term mix of assets. How much in stocks, real estate, bonds, or cash. 2. Asset mix should be determined partly by your real purpose for the money, partly by when the money will be used, and partly by your ability to stay the course. 3. Diversification within each asset class and among asset classes is vital. Bad things do happen, usually as surprises. 4. Patience and persistence are paramount. Good things come in spurts, usually when least expected, and fidgety investors fare badly. Plan your play and play your plan, say the great coaches, and that takes you back to list item number 1. Curiously, most investors who all say they are trying to get better performance do themselves and their portfolios real harm by going against one or all of these truths. They do not concentrate time and attention on determining their optimal balance among asset classes. Their portfolio structure is not tailored to the time when the money will be spent. They diversify too little, so they take more risk than they realize until too late, and the risk becomes reality. And they have too little long-term patience and persistence to stay the course. In addition, they pay higher fees, incur the costs of change, and pay more taxes. They spend hours of time and lots of emotional energy and accumulate loss leaks that drain away the results they could have had from their investments if they had only taken the time and care to understand their own investment realities, developed a sensible long-term program most likely to achieve their real goals, and then patiently stay the course with that program. The importance of being realistic about investment markets gets greater as the markets are increasingly dominated by large, fast-acting, well-informed professionals armed with major advantages. And over the past 20 years, 9 out of 10 pros got beaten by the market averages, as we would see if accurate and complete records were published. For individuals, the grim reality is surely far worse. Chapter 5. Mr. Market and Mr. Value. The stock market is fascinating and quite deceptive in the short run. Over the very long run, the market can be almost boringly reliable and predictable. Almost. Understanding the personalities of 2 very different characters is vital to a realistic understanding of the stock market. These very different characters are Mr. Market and Mr. Value. Mr. Market gets all the attention because he's so interesting, while poor old Mr. Value goes about his important work almost totally ignored by investors. It's not fair. Mr. Value does all the work, while Mr. Market has all the fun and causes all the trouble. Introduced by Benjamin Graham in his classic book, The Intelligent Investor, Mr. Market occasionally lets his enthusiasms or his fears run wild. Emotionally unstable, Mr. Market sometimes feels euphoric and sees only the favorable factors affecting a business. At other times, he feels so depressed that he can see nothing but trouble ahead. This most accommodating fellow stands ready, day after day, to buy if we want to sell, or to sell if we want to buy. Totally unreliable and quite unpredictable, Mr. Market tries again and again to get us to do something, anything, but at least something. For him, the more activity, the better. To provoke us into action, he keeps changing his prices, sometimes quite rapidly. Mr. Market is a mischievous but captivating fellow who persistently teases investors with gimmicks and tricks, such as surprising earnings reports, startling dividend announcements, sudden surges of inflation, inspiring presidential pronouncements, grim news of commodities prices and ugly bankruptcies, exciting revelations of amazing new technologies, and even serious threats of war. These events can come from his big bag of tricks when they are least expected. Just as magicians use clever deceptions to divert our attention, Mr. Market uses very short-term distractions that can trick us and confuse our thinking about investments. Mr. Market dances before us without a care in the world, and why not? He has no responsibilities at all. As an economic gigolo, he has only one objective: to be attractive. Meanwhile, Mr. Value, a remarkably stolid and consistent fellow, never shows and seldom stimulates any emotion. He lives in the cold, hard, real world, where there is nary a thought about perceptions or feelings. He works all day and all night inventing, making, and distributing goods and services. His job is to grind it out on the shop floor, at the warehouse, and in the retail store, day after day, doing the real work of the economy. His role may not be emotionally exciting, but it sure is important. Mr. Value always prevails in the long run. Eventually, Mr. Market's antics, like sandcastles on the beach, come to naught. In the real world of business, goods and services are produced and distributed in much the same way and in much the same volume when Mr. Market is up as they are when he's down. Long-term investors need to avoid being shaken or distracted by Mr. Market from their sound policies for achieving favorable long-term results. Similarly, wise parents of teenagers avoid hearing or remembering too much of what their children say in moments of stress. The daily weather is comparably different from the climate. Weather is about the short run. Climate is about the long run, and that makes all the difference. In choosing a climate in which to build a home, we would not be deflected by last week's weather. Similarly, in choosing a long-term investment program, we don't want to be deflected by temporary market conditions. Investors should ignore that rascal, Mr. Market, and his constant jumping around. The daily changes in the market are no more important to a long-term investor than the daily weather is to a climatologist, or to a family deciding where to make its permanent home. Investors who wisely ignore the deceptive tricks of Mr. Market and pay little or no attention to current price changes will look instead at their real investments in real companies and to their earnings and dividends, and will concentrate on real results over the long term. Because Mr. Market always uses surprising short-term events to grab our attention, spark our emotions, and trick us, experienced investors study long-term stock market history to understand what really matters. Similarly, airline pilots spend hours and hours in flight simulators, flying through simulated storms and other unusual crises, so they become accustomed to all sorts of otherwise stressful circumstances and are well prepared to remain calm and rational when faced with those situations in real life. The more you study market history, and the more you know about how securities markets have behaved in the past, the more you'll understand their true nature and how they probably will behave in the future. Such an understanding enables us to live rationally with markets that would otherwise seem wholly irrational. At least we would not so often get shaken loose from our long-term thinking by the short-term tricks and deceptions of Mr. Market's gyrations. Knowing history and understanding its lessons can insulate us from being surprised. Just as a teenage driver is genuinely amazed by his or her all-too-predictable accidents, Dad, the guy came out of nowhere. Investors can be surprised by adverse performance caused by anomalies and Six Sigma events. Actually, those surprises are all within the market's normal bell curve distribution of experiences. For the serious student of markets, they are not truly surprises. Most are really almost actuarial expectations, and long-term investors should not overreact. Of course, most professional investment managers would have good performance, comfortably better than the market averages, if they could eliminate a few disappointing investments or a few difficult periods in the market. And most teenagers would have fine driving records if they could expunge a few surprises. However, the grim reality of life is that most investment managers and most teenage drivers are almost certain to experience anomalous events. In investing, these events occur when an unusual or unanticipated event, one the manager understandably did not expect and is almost certain never to recur in exactly the same way, suddenly wipes out what otherwise would have been superior investment performance. Gravity, we all know, is a powerful force that is always at work. An equally powerful and equally pervasive force at work in the securities markets: regression to the mean. In less formal terms, this is the tendency of a series of events to become more normal or average over time. For example, very hot or very cold days tend to be followed by less hot or less cold days. And so it is with the earnings of companies. Companies with much faster recent growth than their competitors tend to have future earnings growth less superior to their industry peers. And companies with very poor earnings records tend to have less poor future earnings. The same back toward normal occurs with price or earnings multiples. Stocks that are selling at very high multiples of their earnings tend, over time, to have less unusually high multiples of their earnings. And of course, since both earnings and multiples tend to move away from an unusually high or low level, they can both move toward normal at about the same time, and this can cause a double whammy change in the stock price. For investors, the power of regression to the mean, or normal, is particularly valuable and worth remembering when other people, being human, are getting excited either positively or negatively and are saying and believing things like, "This time it's different." Yes, we are all different and every day is different, but only in details. In most ways, most of us are mostly alike. So when the reason for making an investment decision is dependent upon a stock or a company being very different, the odds are that it is not all that different. And the more different a company or stock must be to justify the decision to buy or sell, the greater the odds that the reason will not come to pass. Regression to the mean is at work in many aspects of our lives. It makes it possible for us to find our way through all sorts of relationships and to be able to anticipate each other. Regression to the mean is important for long-term investors, particularly when current and recent experience seems most compelling. In such situations, knowing the power of this great force can help us remain calm and carry on. And long-term investing is inevitably dominated by regression to the mean. That's why unusually high stock prices, as much as you may enjoy them, are not really good for you. Eventually, you'll have to give back most, if not all, of the increment of return you got that was above the long-term central trend. Investing is not entertainment. Investing is a sober responsibility. Investing is not supposed to be fun or exciting. At its best, investing is a continuous process, like refining petroleum or manufacturing cookies, chemicals, or integrated circuits. If anything in the process is interesting, it's almost surely wrong. That's why practicing benign neglect and staying on plan are, for most investors, the secret to long-term success. The biggest challenge in the stock market is not Mr. Market or Mr. Value. The biggest challenge is neither visible nor measurable. It is hidden in your and my emotional reactions as investors. Investing, like parenting teenagers, benefits from calm, patient persistence, a long-term perspective, and constancy to purpose. The biggest risk in investing is almost always the short-term behavior of the investor. That's why know thyself is the cardinal rule for all investors. The hardest work in investing is not intellectual. It's emotional. Being rational in an apparently irrational, hyperactive short-term anticipations of anticipations market environment is not easy. This is particularly true with Mr. Market, always trying with all his clever skills to trick you into focusing on the short term and making changes. That's why the hardest work is not figuring out the optimal investment policy. It's sustaining a long-term focus, particularly at market highs or market lows, and staying committed to your optimal investment policy. Chapter 6. Investor's Dream Team. The largest part of any portfolio's total long-term return will come from the simplest investment decision, and by far the easiest to implement: buying the market by investing in index funds. If your instinct is to say, "Oh no, I don't want to settle for average, I want to beat the market," others may think quietly to themselves, "Alas, here's another Walter Mitty fantasizing that he'll beat the pros." Even so, let's offer you the help you'll need, your investor's dream team. If you could have anyone and everyone you ever wanted as colleague investors working with you all day, every day, Which great investors would you include on your investor's dream team? Warren Buffett? Done deal. He and his partner, Charlie Munger, are on your team. David Swenson? Jack Mayer? Paula Valent? Seth Alexander? They are all yours, plus all the analysts and fund managers at Fidelity and all the professionals at Capital Group. Brett Baraket, George Soros, David Einhorn, and Steve Mandel? Okay, they are on your side too. And so are all the best hedge fund managers across the country and around the globe. Don't stop there. You can also have all the best analysts on Wall Street. 600 at Merrill Lynch, 600 at Goldman Sachs, and 600 at Morgan Stanley. Plus nearly equal numbers at Credit Suisse, UBS, and Deutsche Bank. And all the boutique broker analysts specializing in technology or emerging markets. You can have all the best portfolio managers worldwide and all the analysts who work for them on your dream team. In fact, you can have all the best professionals working for you all the time. All you have to do is agree to accept their best thinking. To get the combined expertise of all these top professionals, all you have to do is index, because an index fund replicates the market. And today's professional-dominated stock market reflects the accumulated expertise of all those diligent experts making their best judgments on pricing all the time. And as they learn more, they quickly update their judgments, which means that you will always have the most up-to-date expert consensus when you index. Realistically, the stock market is the world's largest prediction market, with many independent experts making their best predictions and putting up real money and their professional reputations to back their respective estimates. When you index, not only do you get the advantages of having the investor's dream team working for you, you also automatically get other important benefits. Peace of mind is one. Most individual investors have to endure regret about their specific past mistakes and to worry about potential future regret. Indexing makes both unnecessary. And for those who go with the investor's dream team and index, there are several more powerful competitive advantages. Lower fees, lower taxes, and lower operating expenses. These persistent costs of active investing mount up unrelentingly and do real harm to investment returns. Avoiding them by investing in index funds will make you a winner, beating nearly all other investors over the long haul. And that's before taxes. While increasingly appreciated, particularly among experienced investors, indexing is not always popular. The pejoratives range from just settling for average to un-American. The worst pejorative is the very name often used: passive. Try it. This is my husband. He's passive. Or, I'll vote for X as president because she's passive. Hopelessly unpopular with active investment managers and with many hopeful investors, the market portfolio, or index fund, is actually the result of all the hard work being done every day by the investor's dream team. Index investing is seldom given anything like the respect it deserves. But it will, over time, achieve better results than almost all mutual funds, and far better results than almost all individual investors achieve. Considering all the time, cost, and effort devoted to trying to achieve better than market results, the index fund certainly produces a lot of value for very little cost. This dull workhorse portfolio may appear mindless, but it is in fact based on an extensive body of research on companies, industries, economies, and markets that is well worth examining and can be briefly summarized as follows. The securities markets are open, free, and competitive markets in which large numbers of well-informed and price-sensitive professional investors compete skillfully, vigorously, and continuously as both buyers and sellers. Non-experts can easily retain the services of experts. Prices are quoted widely and promptly. Effective prohibitions against market manipulation are well established. Many thousands of analysts, portfolio managers, arbitrageurs, traders, hedge funds, private equity funds, market technicians, acquisitive corporations, and longer-term research-based investors continuously seek to find and profit from any market imperfections. Because the competing investors are well-informed buyers and sellers, particularly when they are considered in the aggregate, It is unlikely that any one investment manager can regularly achieve superior results because too many other equally dedicated professionals will also be using their experience and expertise, powerful computers, and the best research they can obtain to make their decisions on whether and when to sell or buy. Such a market is considered efficient, not perfect, but sufficiently efficient that wise investors will recognize that they cannot expect to exploit regularly and successfully the errors of others. The more numerous the skillful competitors, the less likely that any one of them can achieve consistently superior results. Significantly, the number of well-educated, highly motivated people going into professional investing worldwide has been phenomenal. In a perfectly efficient market, not only do prices reflect any information that can be inferred from the historical sequence of prices, but they also incorporate all that is knowable about the companies whose stocks are being traded. While there is some evidence that quarterly earnings reports are not immediately and completely discounted in securities prices, the apparent opportunities to be exploited are so limited in magnitude or duration that managers of large portfolios are not able to make effective use of this kind of information anyway. An efficient market does not mean that stocks will always sell at the right price. As everyone knows, markets fluctuate, as in October 1987, or October to November 2008, or March 2020. Fluctuation can be quite violent. Note that investors can be quite wrong in their collective judgments on the overall market, overly optimistic or overly pessimistic, which will show up later in overall market corrections, and still be highly efficient at incorporating into relative market prices any available fundamental information about individual securities. So the beginning of wisdom is understanding that few, if any, investment organizations will outperform the market over long periods, and that it is very difficult to estimate in advance which managers will outperform. The next step is to decide, even if it might be one, whether this loser's game is worth playing, particularly when indexing provides investment managers and their clients with an easy alternative. Indexers do not have to play the more complex games of equity investing, such as changing portfolio strategy, selecting stocks, and so forth, unless they want to. The freedom to invest at any time in an index fund is a marvelous convenience. Using an index fund enables all investors to keep pace with the market virtually without effort. It also allows us to play active investing and select any part of the wide investment spectrum for deliberate action when and where we really want to at any time for as long or as brief a period as we wish. This gives us freedom to invest away from index funds only when the incremental reward fully justifies the incremental risk. One of the world's most successful investors, Warren Buffett, recommends that most investors consider indexing. Most investors, both institutional and individual, will find that the best way to own common stocks is through an index fund that charges minimal fees. Those following this path are sure to beat the net results, after fees and expenses, delivered by the great majority of investment professionals. As every debater, negotiator, and litigator knows, the most important part of developing a convincing argument is to analyze the opponent's argument. Table 6.1 examines the pros and cons of the various arguments that advocates of active management make in opposition to index investing. Several strong reasons for indexing are never mentioned by the advocates of active investment because they give indexing an unfair competitive advantage, particularly over the long term. Taxes. Index funds incur far less in tax liabilities because they have much lower turnover than actively managed funds, roughly 5% versus 40 to 60% or more, and report zero short-term profits, which, of course, are what incur higher tax rates. High fees. High fees are a significant and unrelenting drain on an active manager's results. As Ben Franklin wisely said, a penny saved is a penny earned. Costs. Trading costs are much lower for index funds than for active managers. Peace of mind. While all investors will experience the market's ups and downs, investors in index funds have no concerns about their manager's style changing, or being off the market, or their manager being acquired, or, as so often happens to successful managers, being overloaded with money to invest. Another way to examine the choice between indexing and active management is to flip the usual sequence and propose that an experienced indexer switch to active investing. This argument for changing to active might go like this. Active investing gives investors the chance to do better than the market. In order to have that chance, however, a few problems must be accepted. Fees and operating costs are much higher. Over the longer term, nearly 90% of active mutual fund managers fall short of their self-selected benchmarks, and those that underperform do significantly worse than the winners do better. There is no known way to identify superior managers in advance. Taxes are higher, deteriorating managers, and there are many causes over the long term, are hard to identify before serious problems become evident in repeated performance shortfalls. And as an investor, you are always worried that your active manager will get into trouble or grow too fast in assets managed, or get acquired, or get complacent. Central to each investor's optimal investment strategy is determining the level of market risk to take. There is an optimal level of market risk for each investor. It is the level of market risk that is appropriate to the length of time that the investments will stay invested, and the market volatility the particular investor can live with and confidently stay the course. Sounds simple, and it is simple. But it's certainly not easy, particularly when Mr. Market is pushing all your buttons and tension is high. Broadly, there are two major categories of risk in investing. One is investment risk, the other is investor risk. The first gets all the attention, but the second should be our focus, because while we can do very little about investment risk, every investor can make a major difference with a moderate effort on investor risk. The market is what it is. Mr. Market does what he does. As with the weather, we can choose an agreeable climate, but we must learn to accept the day-to-day weather changes as they come. A small boat sailor can do little to change the wind or tide, but can do a lot by selecting the right course, keeping sails well trimmed, knowing what he and his boat can do in heavy weather, and watching the skies to avoid serious storms. Similarly, the investor can work with the markets to achieve her realistic objectives, but she must not take on more risk of heavy weather or possible market movements beyond her capacity to sustain commitments while waiting for the market storms to pass. Active investors can do better, and some will do better some of the time. But if certain mutual fund managers had been doing significantly better for many years, particularly after taxes, fees, expenses, and errors, we would all know which funds they managed. But we don't, because they don't and can't. That's why investors will be wise to devote attention to understanding the real advantages offered by the total market index fund, the product of all the skill and work being done every day by the investor's dream team. While Darwinian evolution enjoys extensive scientific confirmation, over 40% of Americans still profess belief in creationism, and a similar percentage still doubt global warming. Although serious students of reality may find it hard to understand why so many resist indexing and exchange-traded funds, ETFs, we should not be entirely surprised. Rejecting or even challenging a line of work is very difficult for those whose large incomes depend on its continuation. Accepting reality is not always easy, and when it goes against someone's economic interests or obliges giving up a long-held set of beliefs, particularly when many others apparently hold on to those same beliefs, accepting reality can be very difficult. This is one of the best explanations of why so many active investment managers continue to resist indexing, even those who index some or all of their own investments. As Thomas Kuhn explained in his classic, The Structure of Scientific Revolutions, change is hard to accept for those who have built their careers developing all the follow-on particulars of a theory based on certain basic assumptions. To change from old assumptions and beliefs to a new set of assumptions is hard when we have a lot to lose in stature and income. Study after study adds to the accumulation of evidence that, with rare exceptions and no exceptions that could have been predicted in advance, active management costs more than it produces in value added. No systematic studies support an alternative view. So what can we sensibly expect of the way people, many with strong economic, social, or emotional interests in continuing to favor active management, will behave? The pattern by which innovations win acceptance is well known. The short description is simple: slowly and inevitably. The process is one of resistance being overcome one person at a time. Resistance to innovation, the viscosity of acceptance, differs by culture or society. Farmers were slow to accept the innovation of hybrid seed corn. Doctors were much quicker to accept new kinds of pharmaceuticals, and teenagers are quick to take up the new anything. Two groups are important. Innovators are always trying new things. Their experiments often fail, but they delight in the newness and do not mind the failures because they never overinvest in their experiments and don't take it personally if a new thing fails. Influentials are widely respected for their ability to pick new ways with high rates of success and almost never fail. The clever influentials monitor innovators closely, and when they see an experiment succeed, they will then try it too. Because the influentials only try what has worked for the innovators. Their success rates are very high. That's why they are influential. Many people watch what they do and follow them with confidence. ETFs and indexing have been moving up the familiar curve of acceptance and are doing so at a gradually accelerating rate. Why? Because more and more investors are realizing that ETFs and indexing have been and surely will be consistently more successful, after fees, costs, and taxes, and after adjusting for risk, than active management. Active manager fees are quoted as only 1% of assets, but the investor already owns all those assets and expects to benefit from the manager's returns. So what are fees as a percentage of returns? If returns average 7%, as many now expect in the low-growth world ahead, then 1% in fees is about 15% of those 7% returns. Yet, as all economists remind us, the real cost of active management is the incremental fee for active investing as a percentage of incremental returns greater than the commodity offering, index funds. But active management performance lags behind index funds over the longer term. That means incremental fees for active investing are now actually over 100% of incremental returns. Increasingly, the unhappy results of active management, after costs and fees, are causing clients to have serious questions about the cost-benefit value to them of active investment management. Given the persistent accumulation of evidence, there can be little wonder that more and more institutions and individuals are using indexing, and no wonder that institutions and individuals who are already indexing are steadily increasing their index allocations. The real wonder is why the two rates of increasing demand are not even faster. Success in investing comes from having clearly defined objectives and the right asset mix and staying with the program. Indexing makes it easier for investors to focus on what really matters. Setting the right goals on risk. Designing the portfolio most likely to achieve those sensible objectives. Rebalancing as appropriate. And staying the course. Indexing simplifies policy implementations, freeing the investor to focus on long-term goals, portfolio strategy, and investment policy. Chapter 7. Indexing, your unfair advantage. All great strategists seek to establish a sustainable advantage over their competitors. That's why Army generals want to take the high ground and have the advantage of surprise. Coaches want stronger and faster players, strive for even better conditioning, and care a lot about team spirit and motivation. Corporate strategists attempt to create branded franchises for their products and services and try to build strong brand loyalty among each group of customers. Corporations strive to move up the experience curve so their unit costs of manufacturing will be lower than those of any competitors. Patent protection, FDA approval, low-cost transportation, technological leadership, consumer preferences, and trademarks all have one thing in common: competitive advantage. In each case, strategists are trying to identify and obtain a significant, sustainable, strategic advantage that competitors will feel is an unfair competitive advantage. In investing, there are 3 ways to achieve a desirable, unfair competitive advantage: the physically difficult, the intellectually difficult, and the emotionally difficult. The physically difficult way to beat the market is the most popular, or at least the most widely used. Believers in this game plan get up earlier in the morning, stay up later at night, and work on weekends. They read more reports, make and take more phone calls, go to more meetings, and send and receive more emails, voice messages, and text messages. They strive to do more and work faster in the hope that they can get ahead of the competition. The intellectually difficult approach to beating the market is used by only a few investors, including a very few whose skills inspire us all. They strive to think more deeply and see further into the future so they can gain truly superior insight and understanding of particular investment opportunities. The emotionally difficult approach to superior investing is to maintain calm rationality at all times, never get excited by favorable market events, and never get upset by adverse markets. This should be the easiest way to invest. But at market extremes, who among us actually finds it easy to sustain that most useful investment stance against Mr. Market and his unnerving gyrations? Benign neglect. You are well suited to the easy way if you can examine the facts of the situation and accept the conclusion that your own efforts are unlikely to improve the results. We all do this with weather conditions. When investing in today's highly professionalized markets, accepting the consensus of experts at low cost by indexing seems wise to more and more investors. The easy way to gain and sustain an unfair competitive advantage as an investor is to invest in low-cost index funds. If you can't beat them, join them, and at much lower cost, and then set the asset mix. You can and will live with the market risks, aka fluctuations or volatility, expected of this portfolio, even at the market's most disconcerting extremes. The long-term, expectable average results will meet your objectives. The great advantage of index investing is that we can avoid the vain search for superior performance and concentrate our time and energy on the most important investment decisions. Defining the long-term policy portfolio that will both minimize the risk of avoidable mistakes and maximize the chances of achieving your true investment objectives. Well, some professional investors are so skillful and so independent-minded that they really can add value by actively changing their investments. The record shows repeatedly that their numbers are far fewer than most investors want to believe. More important, the chance of your identifying great active management winners before their records have been established is very low. Finally, most of the great winners are not accepting new money from new investors. Changing managers successfully, firing one before disappointment comes and hiring a new one before success is shown, is virtually impossible. For many years, data have shown that most investors get it wrong both ways. The fired manager's future results are all too often better than the newly hired manager's. If, as the pundits say, success is getting what you want, and happiness is wanting what you get, you can be both successful and happy with your investments by concentrating on the right asset mix and by living with a few simple truths so your investments really work for and serve you and your purposes. Most individual investors make many mistakes over many years and go through many unhappy experiences to learn these simple but never easy truths. Fortunately, there is a convenient alternative. We can all learn by reading history. Markets are markets, and people are people. Together, they have created a lot of history. Market history will roughly repeat itself because it's so hard for people, particularly as a large group, to learn or change. Here are the unfair advantages of index investing in today's market environment. Higher rates of return. The rates of return are higher because over the very long term, over 90% of active managers fall short of the market. It is nearly impossible to figure out ahead of time which managers will make it into the winning, i.e., not losing, top 10%. And long term, most of these will not stay winners. Indexing consistently achieves the top half of the top quartile of performance over the long haul. Lower management fees and expenses. Fees are 10 basis points, 0.1%, or less versus 100 to 120 basis points, 1.0 to 1.2% or more, compounding year after year. Because index funds have much lower turnover, the operating costs are much lower. Lower taxes. Because turnover is so much lower, fewer profits are recognized each year, particularly as short-term gains. For actively managed mutual funds, tax costs average about 1% of assets every year. So that's 15% more than today's expected annual returns of only 7% kept in your pocket every year. Lower transaction costs. The transaction costs are lower because portfolio turnover is a lot lower, below 10% per year for indexing versus 40% for actively managed mutual funds. Lower market impact costs of transactions. They are lower because portfolio turnover is so much lower. Convenience. There are almost no records you need to keep. Freedom from your numerous modest errors or even a major blunder. This may be the best advantage of all. Freedom from both modest and major missteps is possible because no market timing or portfolio strategy decisions and no manager selection decisions are required. All decisions that can so easily go wrong, and because no single stock ever represents a disproportionate position in your portfolio. Freedom to focus on really important decisions. Examples of important decisions include defining your investment objectives and determining sensible long-term investment policies and practices that will work well for you. Freedom from worry about a manager being acquired or having internal problems or growing too big. Most active managers will experience outcomes like one of these sooner or later. The case for indexing accumulates greater and greater strength as the period for evaluation lengthens. Also, as experts with skill, tenacity, and drive increasingly dominate the markets will surely become even more efficient. So trying to beat the market will continue to get harder. To minimize risk relative to return, or to maximize return relative to risk, investors should at least consider diversifying internationally. Most investors are surprised to learn that the best plain vanilla index fund mix is about half domestic and half international. Recognizing that diversification is the investor's only free lunch, it's easy to see that investing proportionally in all the world's major stock markets and all the different economies those markets represent significantly increase diversification. That's why wise investors choose an index fund, or ETF, that replicates the broadest market at low cost. For entirely rational investors, this will be a worldwide total market index fund, or ETF. Investors who decide to concentrate their investments in their home country are making an implicit decision to emphasize that one country over others. Curiously, most investors do just that. British investors concentrate their investments in the United Kingdom. Canadian investors focus on Canada. Japanese investors on Japanese stocks, and Australian investors on Aussie stocks. They may not be very wrong to do so if their home country has a large, complex, and dynamic economy, like that of the United States, and they have large financial obligations or responsibilities in that country's currency. Exchange-traded funds have mushroomed in assets and proliferated in number and variety since first introduced in 1993. There are now more than 7,600 exchange-traded funds and exchange-traded products with total assets of over $7.7 trillion. Investors should know that most of the growth in ETFs has not come from individual investor demand, but from dealers and professionals hedging against particular risks, not investing for the long term. More than 95% of ETFs and 85% of ETF assets are specialized. Professional investors, particularly at hedge funds, use these specialized ETFs to fine-tune risk management. Individual investors should never use them. There are now index funds and ETFs for every major market around the world, and for the whole world stock market, as well as for small caps, large caps, growth portfolios, and value portfolios. However, although each index is designed to replicate a market or a sector of the market fairly and accurately, indexes are not all equal. Usually, the differences are small and inconsequential, but in some markets, differences among indexes and the index funds that track them are significant, particularly in the fees charged. Years ago, Warren Buffett once estimated what he considered the annual horrendous costs of active investing to be. $35 billion for management fees, expenses, sales charges, wrap fees, and so on. $25 billion for a miscellany of spreads on futures and options, costs of variable annuities, and the like. Noting that all this was just 1% of the total market value of the Fortune 500, Buffett, always seeing reality as an owner should, reminded us that this $100 billion cut a big chunk out of the $334 billion that the whole Fortune 500 earned that year. As a result, investors earned less than $250 billion, just 2.5%, on their investment of $10 trillion. That 2.5% return on investment was, in Buffett's view, slim pickings. Don't we all agree? Another leak in an individual investor's total return comes with taxes driven by active portfolio turnover. The more turnover, the more taxes, and the lower the accumulated returns. With short-term gains, which are often realized in mutual funds, the negative impact of higher taxes is even greater. If you decide to overweight small-cap stocks or emerging markets, or even frontier markets in your portfolio structure, you can do so with index funds, ETFs, or both. But beware. The argument for index funds is strongest when investing in the most efficient markets, like those for large-cap stocks in the United States, the United Kingdom, and Japan. Specialized index funds and specialized ETFs invest in markets that are not as broad, deep, and efficiently priced, or are not as diversified. In smaller markets, market replication can be more difficult and less accurate. Still, in every major market, index funds achieve better performance than most of the actively managed funds investing in those same markets. Chapter 8. Investor Risk and Behavioral Economics. Pogo, that famous folk philosopher, shrewdly observed an essential truth that has particular meaning for investors. We have met the enemy, and he is us. So true. We are emotional because we are human. We believe that we'll do better when we try harder, and we find it hard to take advice such as, if it ain't broke, don't fix it. Because we're human, we are not even close to being entirely rational. So, if predictable errors made by most investors will do harm, we need to know how and why, so we can avoid them. Investing can usefully be understood by dividing it into three parts: the market, the investment manager, and the investor. All too many investors, unfortunately for themselves and their overall long-term investment experience, assume that the investment manager has the leading role, that the market and all its gyrations comes next, and that the individual plays only a minor part. Actually, the true order of importance is exactly opposite. Today, the investor has by far the most important role, and the investment manager has the least important role. 50 years ago, active managers did perform important roles, but due to the confluence of numerous important changes, as already shown, the role active managers can perform has declined markedly. Ironically, this profound diminution is not because of any loss of skill or drive among active managers. On the contrary, it is only because so many brilliant, ambitious, hard-working professionals have been attracted to investing that they have collectively made it nearly impossible for any one of them to outperform consistently the collective expert consensus on price discovery. And that's why, even though it takes even greater skill to be competitive in today's market, the active investment manager's proper role has become smaller and smaller. On the positive side, because each investor is unique, only the investor, often with help from a registered investment advisor, can specify that particular investor's set of goals based on that particular investor's risk tolerance, investment expertise, present and future financial resources, and present and future financial obligations, responsibilities, and personal aspirations. Most investors, most investment managers, and all advertisements about investments focus on only one side of investing: returns. There is another side: risk, particularly the risk of serious permanent loss. And for long-term success, that other side is even more important than returns. Risk comes in various forms: Madoff, Enron, WorldCom, and other deliberate frauds and scams, Polaroid, Lucent, and other companies that saw their shares fall as their businesses suffered major troubles. Individual investors getting frightened out of the market at a terrifying low and not getting back in before the market recovered, trying too hard and buying into stocks or a fund at a market peak. investing in your employer's stock out of loyalty and therefore not being wisely diversified, or running out of retirement funds because you did not save enough or invested unwisely or spent too much or lived too long. Losses, not market fluctuations, but real permanent losses, are destructive, both financially and spiritually. The risk of such losses is clearly the real risk. For many years, economists operated on the assumption that people are rational calculators, know what they want to achieve, know how to achieve it, and consistently strive to make rational, unemotional, self-interested decisions in order to achieve their objectives. More recently, behavioral economists have shown that, as human beings, we are not always rational, and we do not always act in our own best interests. This self-inflicted harm has been documented by students of behavioral economics. Here are some of the things we actually do. We fail to appreciate the great power of regression to the mean. We ignore the base rate, or normal pattern of experience. Even though we know the odds are against us, we gamble at casinos and get caught up in bull and bear markets. We believe in hot hands and winning streaks, and that recent events matter, even in flipping coins. They do not. We overreact to first impressions, so we allow our initial views to anchor our future thinking and distort our analysis of subsequent information so that our conclusions confirm our first impressions. We suffer from an illusion of control and underestimate the odds of bad events, particularly very bad events. We evaluate the quality of a decision based on the favorable or unfavorable outcome, not on the quality of the way the decision was made. This is called either hindsight bias or outcome bias. We overly rely on experts and are overconfident of the expert's expertise. We respond to the halo effect of a recommendation from someone we admire, even in an area outside the person's turf, such as athletes endorsing particular soft drinks, watches, or travel destinations. We overweight dramatic events that are easy to recall or events that are given extensive media coverage. We overestimate our own skills and our own knowledge. We are overly impressed by short-term results, like recent mutual fund performance. We are confirmation biased, looking for and then overweighting the significance of data that support our own initial impressions. We do this a lot in politics. We anchor our final judgment to an early estimate, even when that estimate was just a number or a guess. We distort our perceptions of our decisions, almost always in our own favor, so we believe we are better than we really are at making decisions. And we don't learn. We stay overconfident. We confuse familiarity with knowledge and understanding. We overreact to recent good news and to recent bad news. We think we know more relative to what others know than we really do. And nearly 80% of us think we are above average as car drivers, as listeners, as dancers, at evaluating other people, at being friends, on having a good sense of humor, as parents, and as investors. And 80% of us quietly believe our children are also above average. We now know that as human beings, we are endowed with certain inalienable characteristics of mind and behavior that compel us to make imperfect decisions, even dreadfully serious mistakes, as investors. We often do not realize how we think and react, so we would be wise to use simple checklists to guide our behavior. That's what Captain Sullenberger so wisely did when, shortly after takeoff, his engines stopped and he suddenly had to land his passenger plane in the Hudson River. At least, let's not do it to ourselves, urged JFK. His caution about self-inflicted harm applies to all investors because we ourselves cause risks that are quite unnecessary and could easily be avoided if we would just recognize our unfortunate proclivities and discipline ourselves to do less harm, particularly to ourselves and our investments. Benign neglect can be good for us as investors. Here are some of the investors' risks to avoid. Trying too hard and taking too much market risk. Not trying hard enough, usually by having too much in money market funds or bonds, not stocks. Being impatient. If your investments went up 10% a year, that would be less than 1% a month. On a daily basis, that rate of change would be anything but interesting. Test yourself. How often do you check the prices of your stocks? If you check more than once a quarter, you are satisfying your curiosity, not your need for price information. If you make an important investment decision more than once every 5 or 10 years, or a significant operational decision more than once a year, you are probably being too active in trading. Changing the mutual funds you own after less than 10 years. If you're doing this, you're really just dating. Investing in mutual funds should be more marital, entered into soberly and advisedly, and for the truly long term. Changing mutual funds costs investors heavily. The average return realized by mutual fund investors is sharply lower than the returns of the very funds they invest in, just because investors sell funds with recent disappointing performance and buy funds with recent superior performance. As a result, we all too often sell low and buy high, repeatedly throwing away a significant part, studies say about 1/3, of what we could have earned if we had only shown enough patience and persistence. Borrowing too much. 3 out of 4 of the fortunes that are lost got lost because borrowed money was used. The borrowers were hoping to make an even bigger pile, but it became a painful pile-up instead. Being naively optimistic. Being hopeful is often helpful in other fields, but in investing, it's much better to be objective and realistic. Being proud. Over and over again, studies show that we substantially overestimate our own investment capabilities and our investment performance relative to the market. And we don't like to recognize or acknowledge our mistakes, even to ourselves. Too often, we are also stubborn. Remember the adage? The stock doesn't know you own it, and it really doesn't care. Being emotional. We smile when our stocks go up and frown when our stocks go down. Our feelings get stronger and stronger the more and the faster the prices of our stocks rise or fall. Our internal demons and enemies are pride, fear, greed, exuberance, and anxiety. These are the buttons that Mr. Market most likes to push. If you have them, that rascal will find them. No wonder we are such easy prey for Mr. Market and all his attention-getting tricks. The crucial question is not simply whether long-term returns on common stocks would exceed returns on bonds or T-bills if the investor held on through the many startling gyrations of the market. The crucial question is whether the investor will hold on for the long term so that the expected average returns can actually be achieved. The problem is not in the market, but in ourselves, our perceptions, and our all too human short-term reactions to our present perceptions. This is why it is so important to develop a realistic understanding of investing and of capital markets, so Mr. Market will not trick you, and to develop a realistic knowledge of your own tolerance for market fluctuations and your long-term investment objectives, so you won't trick yourself. The more you know about yourself as an investor, and the more you understand these securities markets, the more you will know what long-term asset mix is really right for you. And the more likely it is that you will be able to ignore Mr. Market and sustain your investment commitments over the long term. As I emphasize, the best way to start learning how to be a successful investor is to follow the standard instruction: know thyself. As an investor, your capabilities in 2 major realms will determine most of your success: your intellectual capabilities and your emotional capabilities. Your intellectual capabilities include your ability to analyze financial statements, balance sheets, funds flow accounts, and income statements, store and recall information, correlate and integrate various bits of data and information into insight and understanding, and master and use information about hundreds of different companies and their stocks. Your emotional capabilities include your ability to be calm and rational despite the chaos and disruptions that will, thanks to Mr. Market, intrude abruptly upon you and your decision-making. Each investor has a zone of competence, the kind of investing for which he or she has real skill, and a zone of comfort, the area of investing in which he or she will be calm and rational. If you know yourself, your strengths and your weaknesses, you will know the limits you must learn to live with in each realm. The place where your spheres overlap in a Venn diagram is your investor's sweet spot. That's where you want to concentrate, where you have the right skills and the right temperament to do your best investing. In the trade-off between the conflicting investor goals of eat well and sleep well, the sage advice is to sell down to the sleeping point. Don't go outside your zone of competence because you'll make costly mistakes. And don't go outside your comfort zone because you may get emotional. And being emotional is never good for your investing. A strong defense is the best foundation for a strong offense in investing. So always stay inside your joint comfort and competence zones. It is your money, so treat it with the care and respect it deserves, and you deserve. Investing only when you know from experience that you have the requisite skill and can be consistently rational. Chapter 9. The Paradox Haunting Active Investing. A paradox is haunting active investment management. Funds of investors with very long-term purposes are all too often not being managed to achieve long-term objectives that are feasible and worthwhile. Instead, they are being managed to meet short-term objectives that may be neither feasible nor important. The unimportant and daunting task to which most active managers devote most of their time, with way too little success, is trying to beat the market. The important work is to understand the particular investor's objective, establish the resulting asset mix, and then stay the course. Let's refer again to our skiing analogy from Chapter 2. At every ski resort, the trails are marked by a degree of difficulty, so each skier can go to the right slopes. Beginners know the bunny slopes will be smoothly groomed, with no ice patches or bumps, and will be perfect for slow and easy skiing. And our 17-year-old heroes with spring steel legs and 100 days a year of skiing can chase one another down the double black diamond expert runs. If they each go to the trails that are right for them, thousands of skiers can enjoy the mountain at the same time. If the 17-year-old gets stuck on the beginner's slope or grandma goes to double black, both will suffer. The same arrangement works for different kinds of investors if they are realistic about themselves and realistic about the kind of investment portfolio that's right for each of them. We are different from one another in many ways. Here are a few. Age, assets, income, time horizon, dependence, investment experience and expertise, risk tolerance, likely inheritance, intended bequests, philanthropic aspirations. Chances are, nobody is quite the same as you, or any other specific investor. Our fingerprints, DNA, and eyes all differ from everyone else's too. What's best for each investor is unique. That's why investors should each tailor their investment portfolio so it's really right for them. That's why the best opportunity to achieve superior investment results lies not in scrambling to outperform the market, but in establishing and adhering to appropriate long-term investment policies that will enable you to reach your objectives by riding with the main underlying forces in the market over time and through market cycles. In reality, few investors have developed clear investment goals, and most investment managers operate without really knowing their clients' specific objectives and without explicit agreement on their mission as investment managers. This is the investor's fault. While investment counseling is more important to long-term success than investment management and can make far more economic difference over the long term, most investors do not do the disciplined work of formulating sound long-term investment policies for themselves. That's why, for relatively modest fees, registered investment advisors offer counseling, the most important investment service most investors will ever use. Getting it right on investment policy, with or without a professional advisor, is up to you, the investor. After all, it is your money. You know the most about your overall financial and investment situation, your earning power, your ability to save, the time you plan to retire, your obligations for your children's educational expenses, the likely timing and scale of needs for spendable funds, and the way you feel about the disciplines of investing. Only you can know your own tolerance for changes in market prices, particularly at market extremes, when the pressures for change are strongest. So it's your responsibility to know who you really are as an investor and what you really want. Investors can get great help from fee-only financial advisors on how best to think through the answers to 6 important questions. First, what are the real risks to you of an adverse outcome, particularly in the short run? Unacceptable risks should never be taken. For example, it would not make sense to invest all of a high school senior's college tuition savings in the stock market because if the market went down, the student might not be able to pay the tuition bill. Education is a great long-term investment, but the bill must be paid in the short term when received. Nor would it make sense to invest in stocks all the money saved for a house just 2 or 3 years before the intended date of purchase. Second, what are your probable emotional reactions to an adverse market experience? You should know this and stay well within your tolerance, ideally a well-informed tolerance, for interim price fluctuations in your portfolio. Avoiding market risk does have a real opportunity cost. That's why you want to understand all the gains and losses that must be anticipated with each incremental level of market risk taken and the opportunity cost of each level of market risk not taken. Third, how knowledgeable are you about the history and realities of investing and the realities and vagaries of financial markets? Sometimes astute investing seems almost perversely counterintuitive. Lack of knowledge tends to make investors too cautious in bear markets and too confident in bull markets, all too often at considerable cost. Suggestion: recall how you reacted in March 2020 with the COVID market decline, or how you responded in the fall of 2008. Did you stay the course or liquidate some of your investments? Or go to your library and spend several hours reading the daily newspapers from the summer and fall of 1929 or the fall of 1987 or the dot-com era. Getting up close and personal can help you understand how it feels to be in a storm and should help you learn how to remain calm in the next one. An investor who is well informed about the investment environment will know what sort of market behaviors to expect. He or she will be able to take in stride the disruptive experiences that would cause other, less informed investors to overreact to either unusually favorable or unusually adverse market experiences. Fourth, what other capital or income resources do you have, and how important is your investment portfolio to your overall financial position? Fifth, are there any legal restrictions on your investments? Many trust funds are quite specific. Many endowment funds have restrictions on how income is to be defined and spent. Sixth, are there any unanticipated consequences of interim fluctuations in portfolio value, possibly rather large ones, that might affect your optimal investment policy? We all know that it can be hard for individual investors to continue taking the calm, long-term view when markets are rising rapidly, or worse, falling rapidly. Each of these possible concerns should be clarified so each investor can ascertain how much deviation is truly warranted from the normally optimal investment policy of broad diversification at a moderately above average market risk. By defining your objectives clearly, you can focus on what really matters, not the futile struggle to beat the market, but the reasoned and highly achievable goal of setting and meeting your own realistic long-term investment objectives. Each investor has an important opportunity to match long-term investment objectives with the long-term investment strategy that's best for each of us. If investors are not willing to act like serious, engaged principals, we can be sure that the paradox, managing long-term investments according to short-term priorities, will remain in force for a long, long time. Cynical observers of the paradox that haunts investment management say it is unrealistic to expect investors to take on the self-discipline of doing all that homework, or to expect investment managers to risk straining client relationships by insisting on a well-conceived and carefully articulated investment policy with explicit objectives when most investors seem uninterested in going through the discipline. So, escaping from the paradox depends on you asserting your role as the expert on your own needs and resources and developing appropriate investment goals and policies. For that important work, while we can get real help from experienced financial advisors, we must look primarily to ourselves. Chapter 10. Time. Archimedes' lever. Give me a lever long enough and a place to stand, and I can move the earth, said Archimedes. In investing, Archimedes' lever is time, and the place to stand, of course, is on a firm and realistic investment policy. The length of time that investments will be held, the period over which investment results can be measured and judged, is crucial to any successful investment program because it is the key to getting the right asset mix. Time transforms investments from least attractive to most attractive, and vice versa, because while the average expected rate of return is not at all affected by time, the range or distribution of actual returns around the expected average is greatly affected. So, given enough time, investments that might otherwise seem unattractive become highly desirable, and vice versa. The longer the time period over which investments are held, the closer the actual returns in a portfolio will come to the expected average. The actual returns on individual investments, in contrast, will often be more and more widely dispersed as the time period lengthens. As a result, time changes the ways in which portfolios of different kinds of investments can best be used by different investors in different situations and with different objectives. If time is short, the highest return investments, the ones a long-term investor naturally most wants to own, will not be desirable, and a wise short-term investor will avoid them. But if the time period for investing is abundantly long, a wise investor can commit without great anxiety to investments that in the short run would appear to be too risky. The conventional time period over which rates of return and their distribution are usually calculated is just 1 year. What a shame! While convenient and widely used, this 12-month time frame simply does not match the time periods available to all the different kinds of investors, with all their different constraints and purposes. Some investors are investing for only a few months at a time, while others will hold their investments for several decades. The difference in time horizon matters greatly in investing. To show how important time is, let's exaggerate for effect and look at the returns expected for a one-day investment in common stocks. If a typical stock's share price is $40, trading during 1 day might easily range from $39.25 to $40.50, a range of $1.25 or 3.1% of the average price for the day. Remembering that the average annual rate of return for common stocks in recent decades has been approximately 8%, let's postulate that an investment in this hypothetical stock would have an expected daily return of 0.04%. 8% annual return divided by 250 trading days each year, and a range around that expected average of plus or minus 1.55%, the 3.1% intraday range divided by 2. Now let's annualize that daily return of 0.04% and that daily price variation. The average annual expected rate of return would still be 8%, but the range of returns around that 8% would be a daunting plus or minus 387.5%. In other words, the annualized rate of return for a one-day investment in our hypothetical stock would be somewhere between a profit of 395.5% and a loss of 379.5%. Of course, no sensible investor would knowingly invest in common stocks for only a single day, or month, or even for a year. Such brief time periods are clearly too short for investments in common stocks because the expectable variation in return is too large in comparison to the expected average return. The extra uncertainty incurred when investing in common stocks is not balanced in the very short run by a sufficiently large or sufficiently sure reward. Such short-term holdings in common stocks would not be investments. They would be rank speculations. However, this deliberate one-day burlesque of the conventional use of annual rates of return leads to a serious examination of the differences in investor satisfaction when the measurement period is changed. That examination shows why an investor with a very long time horizon might invest entirely in common stocks, just as wisely as an investor with a very short time horizon would invest only in treasury bills or a money market fund. The examination also shows why an intermediate-term investor would, as his or her time horizon is extended outward, shift investment emphasis from money market instruments toward bonds, and then, more substantially, toward equities. Despite the constancy of the average expected rate of return, No matter what the time period, the profound impact of time on the actual realized rate of return is clearly demonstrated in the chart in Figure 10.1. The 1 year at a time rates of return on common stocks show both large and small gains and large and small losses occurring in a seemingly random pattern. At best, you could have gained 53.4% in 1 year, but at worst, you could have lost 37.3% in another single year. It seems almost absurd to summarize those wildly disparate 1 year experiences as having any average rate of return whatsoever. Shifting to 5-year periods brings a considerable increase in regularity. There are, for example, few periods with losses, and the periods with gains appear far more often and consistently because as the measurement period lengthens, the long-term average rate of return increasingly dominates the single-year differences. Shifting further to 10-year periods increases the consistency of returns. Only one 10-year loss is experienced, and most periods show average annual gains of 5 to 15%. Again, the power of the base rate, or average rate of return, now compounded over a full decade, overwhelms the single-year difference. Moving on to 20-year periods brings even more consistency to the rates of return. There are no losses, only gains, and the gains cluster more closely together around the long-term expected average rate of return. Appreciating that actual experiences in investing are all samples drawn from a long-term continuous stream of experience is vital to understanding the meaning contained in the data. Even in New England, the weather, when considered over a long time, becomes a sensible, reliable climate, though the days of bitter cold or sweltering heat seem individually so unpredictable, particularly in regard to the exact dates of their occurrence. Similarly, in investing, the patient observer can see the true underlying patterns that make the seemingly random year-by-year, month-by-month, or day-by-day experiences not disconcerting or confusing, but splendidly predictable, on average and over time. In weather and investments, larger and more numerous samples enable us to come closer and closer to defining the nature of the normal distribution from which the sample is drawn. This understanding of the normal experience enables you to control your own behavior so you can take advantage of the dominant long-term normal pattern and not be thrown off by the confusing daily events that present themselves with such force in the short term as Mr. Market strives to catch your attention. The single most important dimension of your investment policy is the asset mix, particularly the ratio of fixed income investments to equity investments. Analyses of asset mix show repeatedly that the trade-off between risk and reward is driven by one key factor: time. Lamentably, the time horizon most often used in determining asset mix for an investment portfolio is not chosen for the real horizon of each specific investor, but instead it is the convention of a 5-year period. This 5-year focus leads to the familiar recommendation of a 60-40 ratio of equities to debt. A 10-year horizon would lead to a 70-30 ratio. A 25-year horizon would typically result in a 90-10 ratio. And so it goes. The unfortunate reality is that none of these time horizons is right for most individual investors who want to provide financial security for their families. They are all far too short for an investor with a realistic investment horizon of 30 to 50 years or more, because most investors will be living and still investing for far more than the conventional 5 or 10 years. Most individual investors and almost all institutional investors will be investing for at least 30 to 50 years. If investors used truly long-term thinking, they would invest differently and would earn higher long-term returns. Chapter 11. Investment Returns. Investment returns come in two very different forms: quite predictable cash received from interest or dividends, and quite unpredictable, in the short run, gains or losses in market price. Changes in market price are caused by changes in the consensus of active investors about what the price of a stock ought to be. This purchasing power-weighted consensus is determined not by individual investors, but by many thousands of professional investors seeking opportunities for investment advantage. These active investors devote most of their time and skill to trying to increase returns by capitalizing on changes in market prices by outsmarting other expert investors. That's certainly not easy. It's somewhere between very hard and impossible. In addition to studying the rational world, professional investors also study the irrational world of behavioral economics and investor psychology, consumer confidence, politics, and overall market tone, because in the short run, the securities markets, thanks to Mr. Market, are not entirely rational. Even with all this homework, of course, not all the interpretations and perceptions of professional investors are correct. Some, particularly in retrospect, will seem terribly wrong. But the process of many thousands of highly motivated professionals, all having superb technology and the latest information, and all striving to discover the correct prices, is very hard to beat. Active investment management in today's dynamic markets is a turbulent, stressful process of competing in the world's most competitive market against talented and ambitious investors for any advantages that might be gained from greater knowledge, wiser interpretation, or better timing. The irony is that for most investors, both professional and individual, most of this activity really does not matter. Not because the investment professionals are not highly talented, but because so many competitors are equally so highly talented, superbly informed, well-equipped, and persistently striving. For all the surface complexity in the process, two main areas are dominant in evaluating common stocks. The first is the consensus of expert investors on the probable amount and timing of future earnings and dividends. The second is the consensus of expert investors on the discount rate at which this stream of estimated future dividends and earnings should now be capitalized to establish its present value. Estimates of future dividends and earnings will vary among different investors and at different times due to changes in expectations for long-term economic and industry growth, cyclical fluctuations in unit demand, prices, taxes, discoveries and inventions, competition at home and abroad, and so forth. Over time, the discount rate considered appropriate will also vary with many factors, among which the most important is the perceived risk of a particular investment or investments in its industry or of its general type or the expected rate of inflation. In addition, active investors know that other investors' estimates of other investors' estimates of still other investors' estimates ad infinitum are always changing, and that a third layer of estimates, how other investors' estimates of others' estimates will probably change, is always changing too, sometimes significantly. Finally, the longer the future period over which estimates of earnings and dividends and of the discount rate are extended, the greater the uncertainty that will be factored into investors' estimates of other investors' estimates, driving day to day, month to month, and year to year fluctuations in stock prices. Note that the consensus that matters for long-term investors is not today's consensus about the distant future, but the consensus that will prevail when we actually get to that distant future. As the holding period over which an investor owns an investment lengthens, the importance of the discount factor decreases, and the importance of corporate earnings and paid dividends increases. For a very long-term investor, current price matters relatively little, and the relative importance of earnings and the dividends received is overwhelming. For a short-term price speculator, everything depends instead on the day-to-day and month-to-month changes in market and investor psychology. Like the climate, the average long-term investing experience is never surprising. But like the weather, the short-term experience is frequently surprising. Long-term investors understand from experience the remarkable discipline of the normal distribution of the bell curve of economic behavior and corporate events, and the strong tendency of major forces in the economy and the stock market to move toward normal via the powerful regression to the mean. They know that the farther current events are from the center of the bell curve, the stronger the regression to the mean forces will pull current experience back toward the center, or average. As mentioned in Chapter 2, sailors know the remarkable power of the righting arm, in which the farther the boat heels over, the harder the weight of the keel works to drive it back upright. Investors want to know the most probable investment outlook for the years ahead. One way to look ahead is to appraise the likely change in two powerful variables: long-term interest rates and corporate profits. To be realistic, assume that the future range of interest rates and profits will be within the historical upper and lower limits and will tend toward their respective means. Caution: if the market has been going up, investors, who curiously usually evaluate future prospects by looking into the rearview mirror, will assume some further upward momentum, and if the market has been trending down, they will add some further downward momentum. The wise investor will adjust for this notorious human tendency. The history of returns on investment, as documented in study after study, shows three basic characteristics. Common stocks have average returns that are higher than those of bonds. Bonds, in turn, have higher returns than short-term money market instruments. The daily, monthly, and yearly fluctuations in actual returns on common stocks exceed the fluctuations in returns on bonds, which in turn exceed the fluctuations of returns on short-term money market instruments. The magnitude of the average period-to-period fluctuation in rate of return increases as the measurement period is shortened, and decreases as the measurement period is lengthened. In other words, rates of return appear more normal over longer periods of time. Daily and monthly returns show virtually no predictive or predictable pattern. They are not really random. Hidden within Mr. Market's gyrations is a strong tendency of regression to the mean rate of return, or run rate. That's why investment managers are learning to describe investment returns in formal statistical terms. Individual investors would be well advised to know what is meant by mean and normal distribution, and what is meant by two standard deviations as a measure of the frequency with which unusual events are expected and do occur. In addition to learning the importance of describing the distribution of returns around the mean, we have learned to separate out the different components in the average rate of return and to analyze each component separately. The average rate of return has three main components: the real risk-free rate of return, a premium over the risk-free rate of return to offset inflation's expected erosion of purchasing power, a premium over the inflation-adjusted risk-free rate of return to compensate investors for accepting market risk. Dividing total returns into these three classes of return make it possible to compare the returns of these types of investments: stocks, bonds, and treasury bills. The analysis is informative. Treasury bills appear quite safe and reliable, in nominal terms, not adjusted for inflation, with apparently positive nominal returns in almost all years. However, when adjusted for inflation, real returns are positive less than 60% of the time. Even more startling, the average annual rate of return on treasury bills after adjusting for inflation is 0. In other words, treasury bills are usually only a match for inflation. Most of the time, you do get your money back, with its purchasing power intact. But that's all you get. There is virtually no real return on your money, just the return of your money. Long-term bonds produce higher returns, inflation-adjusted, for two reasons. Corporate bonds involve a risk of default, and both corporate and government bonds impose on the investor an exposure to market fluctuations caused by their more distant maturity, as the market continuously adjusts prices to changing expected interest rates. Investors don't want to experience market price fluctuations unless they get a higher rate of return to compensate, so long bonds pay a higher rate of interest, a maturity premium. The maturity premium is estimated at 0.9 to 1.1%, and the default premium on high-grade long-term corporate bonds works out to about 0.5%. When these two premiums are added to the risk-free rate, the inflation-adjusted annual real rate of return on long government bonds is nearly 2% in normal markets, and on long-term high-grade corporates, it is nearly 3%. It makes sense that returns on common stocks are higher than returns on bonds, which guarantee to pay interest and their full face value at maturity. Stocks make up for not having such guarantees with a risk premium built into their nominal returns. The inflation-adjusted expected real rate of return is about 5%. When the disruptive impact of inflation is removed and gains are examined over reasonably long periods, it becomes clear how consistent the returns investors require for their money really are. This consistency stems from two main factors. Investors are sensibly consistent in requiring higher rates of return to compensate them for accepting higher market risk. As the period over which returns are measured is lengthened, the short-term volatility in returns caused by fluctuating changes in the discount rate becomes less and less important, and the expected dividend stream or interest payments, which are much more stable, become more and more important. We do not have and cannot hope to get precise data on rates of return from investments in securities any more than we can expect to get perfect and precise data by sampling any other complex, dynamic, long-term continuous process that is affected by a multitude of large and small exogenous factors. However, we can get a useful approximation of what returns have actually been and what they're most likely to be. And that is all we really need to establish investment policies for the long term. Unless you buy in at the start of the period measured, sell out at the end, and then take your money out of the market, performance data are simply representational statistics. They describe small samples from a continuous and very long process in which stock prices go through a random walk series of successive approximations of the actual present value based on continuously revised estimates of future earnings and dividends and changing discount rates. Two further propositions on returns are important. First, the impact on returns of changes in the expected level of inflation can be large, particularly on common stocks, which are virtually perpetual investments. Such a change in the expected rate of inflation from approximately 2% in 1960 to over 10% in 1980, along with other changes, caused a change in the required nominal average rate of return from common stocks from about 8% in 1960 to about 17% in 1980, and this produced a major reduction in stock prices. From that reduced level, future returns would meet the returns after inflation that investors needed to justify buying stocks. Note that after factoring in the ravages of inflation, the losses investors experienced during that adjustment period were the worst in half a century. A decrease in the expected rate of inflation had the opposite effect, as we saw in the following 20 years of a bull market rise in stock prices. The second proposition on returns is that differences in rates of return that may appear moderate in the short run can, with compounding, multiply into large differences in the long run. Table 11.1 shows the compounding effect on $1 invested at different interest rates and compounded over different periods of time. It's well worth careful study, particularly to see how powerful time really is. That's why time is the Archimedes lever of investing. Before leaving the happy realm of investment returns, take another look at figure 10.1 in Chapter 10, particularly the data on 25-year returns. The moderate levels of real returns, adjusted for inflation, are impressive and instructive. 6.6% for stocks and 1.8% for bonds. After an extraordinary quarter century of generally highly favorable investment experiences, investors needed to remind themselves, in the early years of this century, of the normal, or base, rate of investment returns. The high nominal returns of the prior quarter century were well above the base rate, as the losses in 2008 would so bluntly prove. Beware of historical averages. If stocks return an average of 10% per year, how often over the past 75 years did stocks actually return 10%? Just once, in 1968. And how often did returns even come close to that specific number? Only 3 times. That's why investors need to average delightful and dreadful markets over many years. It's not easy. The next time you feel excited by a zooming bull market, try to remember what airline pilots say are the 2 strong expression wishes of passengers. The first is when your plane is on the ground because of bad weather and you're anxious to get to an important meeting. Waiting impatiently, you say, "I wish to God we were in the air." The second is when you are in the air in a major storm saying, "I wish to God we were on the ground." Most investors do not want to preclude themselves arbitrarily from making the big score, the opportunity to shoot the lights out. If you believe with Louis Pasteur that chance favors the prepared mind, be sure that you are prepared. First, be prepared to find nothing much. In over 50 years of continuous, active involvement with many of the world's best investors, I've found only two major opportunities that weren't obvious to many others. That's a discovery rate of only once every 25 years of nearly full-time searching. If you find a great investment opportunity, what should you do? Try asking 4 questions, and then ask other people to examine your reasoning process with you. 1. What could go really right, and how likely is that? 2. What could go wrong, and how likely is that? 3. Am I so confident that I should invest a significant part of my portfolio in this one investment? 4. If the price goes down, will I really want to buy a lot more? Chapter 12. Investment Risks versus Uncertainty. Risk is such a simple little word that it is amazing how many different meanings are given to it by different users. Risk is different from uncertainty. Risk describes the expected array of payoffs and losses when both their magnitude and their probabilities of occurrence are known. Actuarial mortality tables are a familiar example. The actuary does not know what will happen in 14 years to Mr. Frank Smith, but she does know quite precisely what to expect for a group of 100 million people in each and every year. Riskiness in investing, by contrast, is akin to uncertainty, and that's what the academics mean when they discuss beta, relative volatility, and market risk. Too bad they don't use the exact terms. Risk exists both in the markets and for the individual investor. Market risk is the price fluctuations that, over time, tend to cancel each other out. Investor risk, either euphoria and excessive confidence at peak prices or fear and panic at terrible market lows, can provoke actions causing permanent harm. Some of us can live fairly calmly with most near-term market volatilities and resist the urge to take action, knowing that over the long run, moderately more market volatility usually comes with higher average returns. But many cannot. For them, the great risks of taking the wrong actions at the wrong times by buying high or selling low are imposed on themselves, by themselves. Active investors typically think of risk in 4 different ways. Price risk. You can lose money by buying stock at too high a price. If you think a stock's price might be high, you should know you are taking price risk. Interest rate risk. If interest rates go up more than was previously expected and were already discounted in the market, your stocks will go down. You are taking interest rate risk. Business risk. The company may blunder, and earnings may not materialize. If this occurs, the stock will drop. Here you are taking business risk. Failure risk. This is the most extreme risk. The company may fail completely. That's what happened with Penn Central, Enron, WorldCom, and Polaroid. As the old pros will tell you, now that is a risk. Real risk is simple. Not enough cash when money is really needed, like running out of gas in the desert. Advisors wisely focus on the grave risk all investors, and 401k investors in particular, should focus on: running out of retirement money, particularly too late in life to go back to work. Another way to look at the whole concept of risk has come from the extensive academic research done over the past half-century. More and more investment managers and clients are using it because there's nothing so powerful as a theory that works. Here's the concept. Investors are exposed to 3 kinds of investment risk. One kind of risk, what I've termed market risk, simply cannot be avoided, so investors must be rewarded for taking it. The other 2 kinds of risk, what I call individual stock risk and stock group risk, can be avoided, reduced, or even eliminated through diversification. Investors are never rewarded for accepting these unnecessary and avoidable kinds of risk, and that's why we should all diversify. Individual stock risk and stock group risk, the 2 kinds of risk that can be avoided, reduced, or eliminated, are closely associated. Individual stock risk involves the risk linked to individual securities. Stock group risk involves the risk that is common to each type or group of securities. A few examples will clarify the meaning of stock group risk. Growth stocks as a group will tend to move up and down in price, in part because of changes in investor confidence and willingness to look more or less distantly into the future for growth. When investors are highly confident, they will look far out into the future when evaluating growth stocks. Interest-sensitive issues, such as utility and bank stocks, will all be affected by changes in expected interest rates. Stocks in the same industry, autos, retailers, computers, and so forth, will share market price behavior driven by changing expectations for their industry as a whole. The number of common causes that affect groups of stocks is great, and most stocks belong simultaneously to several different groups. To avoid unnecessary complexity, investors usually focus their thinking on the major forms of stock group risk. The central fact about both stock group risk and individual stock risk is this: they do not need to be taken by investors. Each can be greatly reduced and nearly eliminated. Unlike the risk of the overall market, the risk that comes from investing in particular market segments or specific issues can be diversified away, almost to oblivion. That's why in an efficient market, no incremental reward can or will be earned over the market rate of return simply by taking either more individual stock risk or more stock group risk. Either type of risk should be incurred only when doing so will enable the investor to achieve truly worthwhile increases in returns. The lack of reward for taking individual stock risk or stock group risk is important. An investor who takes such risks can hope to be rewarded only by superior skill in selecting individual stocks or groups of stocks that were somehow inappropriately priced. As explained in Chapter 4, often an investor who takes these risks can profit only if market competitors, who are now almost always experts, make mistakes. This is not an encouraging basis for making a major commitment. Fortunately, such risks can be avoided by using the simple and convenient strategy of investing in index funds that replicate the market. No deviations in portfolio composition relative to the overall market means no deviations in rates of return and no stock group risk or individual stock risk. An index fund provides a convenient and inexpensive way to invest in equities with the riskiness of particular market segments and specific issues diversified away. Note that eliminating these two particular forms of risk does not mean that all risk is gone. Overall market risk will always be there, and in the field of risk, that's the big one. Figure 12.1 shows vividly how the riskiness of a single stock consists primarily of individual stock risk and stock group risk, but it also highlights that due to diversification in a typical portfolio, these two kinds of risks are only a small part of the investor's total risk. The figure also shows that the typical index fund investor will have even more diversification, which will further reduce risks. Investors who add international index funds get still more diversification. The optimal level of overall market risk for a very long-term investor is moderately above the market average. This makes sense because most other investors do not take a very long-term view. Many know their investments will be liquidated somewhat sooner for their children's education, at the termination of a trust, or for a host of other near to medium-term events for which plans must be made. Other investors are simply unable to look with calm forbearance on the abrupt and substantial day-to-day, month-to-month, and year-to-year changes in stock prices that will be experienced in an equity portfolio over the long term. These investors want less risk and less fluctuation, and are willing to pay a price by giving up some incremental return to get what they want. In summary, the total return to an equity investor has four components. 1. The risk-free return after offsetting expected inflation. 2. An extra return to compensate for the riskiness or price uncertainty of investing in the overall equity market. 3. A potential extra return for investing in one or more particular groups of stocks or market segments that for various economic, business, or market psychology reasons may behave differently from the overall market. 4. An additional potential extra return for investing in specific stocks that, for the same sorts of reasons, may behave differently. Corresponding to each component of return is a component of risk. In investment management, we now know that the crucial factor over the long term is not how to manage rates of return, but how to manage market risk. By managing market risk, we are doing two things at the same time. 1. Deciding deliberately what level of market risk to establish as the portfolio's basic policy level. 2. Holding to that chosen level of market risk through good and bad markets. Changes in the level of market risk should be made deliberately and only because the investor's long-term objectives have changed. Managing market risk to suit the investor is the primary tool of investment management. That is a profound assertion, and it is the core idea of this chapter. The rate of return obtained in an investment portfolio comes from three sources, in this order of importance. First and foremost, the level of market risk assumed or avoided in the portfolio. Next, the consistency with which that risk level is maintained through market cycles. And last, the skill with which specific stock risk and stock group risk are minimized through portfolio diversification. The difference between true investment risk and apparent riskiness, or market risk, is a function of time. Yes, stocks can appear very risky if time is short. But unless you begin your investment program at a silly too high level in the stock market, the apparent riskiness of stocks fades away if the time is long enough, and the favorable long-term returns become increasingly evident. If you're not confident that the market is low or fairly low, you'll be wise to use dollar-cost averaging by investing a fixed dollar amount at regular intervals to get gradually invested over time. For investors, investment risk can also be divided by time into short-term risk versus long-term risk. The real risk in the short term is that you will need to sell to raise cash when the market happens to be low. That's why, in the long term, the risks are clearly lowest for stocks, but in the short term, the risks are just as clearly highest for stocks. One risk that most investors are not prepared for is how long it can take for the stock market to recover to peak prices. It's worth remembering that it took 16 years for the S&P 500 stock index to get back up to its 1966 peak, and even longer to regain the peak of 1929. But if you do not need to sell, and don't plan to sell, you really shouldn't much care about the nominal interim fluctuations of stock prices. They may matter to others, but they are no more relevant to you than stormy weather in faraway places. Because the real risks to investors in the long run are the risks created unnecessarily by their own reactions. Investors' best answers to short-term market riskiness is to ignore the interim fluctuations and be patient, persistent, long-term investors. Risk tolerance does not describe the behavior we expect of ourselves when calmly considering normal markets, long-term averages, or the normal volatility of returns. Risk tolerance calibrates our behavior when we are driven by real worries during market extremes, particularly after we've recently been proved wrong. Again. To the extent that you know your investments will be held for the very long term, you can automatically self-insure against the uncertainty of short-term market price fluctuations. As long as you stay invested, the interim price fluctuations of Mr. Market may be distressing, but will not cause you serious harm. Recognizing that investment risk drives returns and is not simply a residual of the struggle for higher returns transforms our concept of investment policy. We now know to focus not on rate of return, but rather on our informed management of risk. Chapter 13. Building Investment Portfolios. Whether investing is primarily an art or a science has long been a favorite topic of informal discussion among professional investment managers. Perhaps because the discussions typically are resolved quite cheerfully by demonstrating that since the practice of active investing is clearly not a science, it must be an art. Anyone who has observed gifted investors at work will recognize the art. Subtle, intuitive, complex, and almost inexplicable in selecting individual stocks or groups of stocks. The few great artists are true heroes of the profession who add value to portfolios by seeing and seizing opportunities others miss or recognize only later. However, for most investors, portfolio management is neither an art nor a science. It is instead a problem of engineering. The great lesson of engineering is that the key to finding a solution is to define the real problem correctly. When you have defined the problem correctly, you are well on your way to finding the correct solution. And portfolio construction is investment engineering. Stock and bond indexing simplifies the complexity of working within a remarkably uncertain, probabilistic, and always changing world of partial information and misinformation, all filtered through the inexact screen of human interpretation. So indexing provides the most reliable and efficient way to reach a specified goal given a set of policy constraints. As explained in Chapter 12, we now know that the real challenge in long-term investing is not how to increase returns by buying specific stocks or bonds low and selling high as active investors strive to do, but how to manage risk by deliberately taking appropriate levels of portfolio risk that will lead over time to moderately increased returns. Good portfolio design eliminates avoidable and unintended risk and maximizes expected returns at a deliberately chosen level of market risk. That's why an efficient portfolio has greater expected returns than any other feasible portfolio with equal risk and less risk than any other feasible portfolio with equal expected returns. Like stocks, bonds present both individual risk and group risk that can and should be diversified away. For example, bonds issued by companies in a particular industry will, as a group, change in value with major changes in that industry's economics. Bonds sharing particular call or refunding features will rise and fall as a group in relative market popularity. Bond rating agencies have found that most of their rating errors are caused by the difficulty inherent in estimating group risks, not in estimating the individual risk of a particular bond issuer compared with the other issuers in the same industry or group. Sadly, this was proved again in 2008 when AAA credit ratings were given to newly issued securities backed by subprime mortgages. The rating agencies were seriously wrong systematically on group risk, which led to enormous losses for investors relying too much on Moody's and S&P ratings. Credit rating mistakes have happened many times before, starting with AAA-rated street railways in the 1920s. Virtually all went bankrupt as people switched to automobiles. Conceptually, bond portfolio management starts with a passive portfolio that represents the overall bond market. This baseline portfolio is diversified across numerous groups and across individual issues to protect against the credit risk of individual issuers or types of issuers. And it uses an evenly spaced schedule of maturities to defend against adverse changes in interest rates. As with equities, the historical evidence is that the risk of individual bonds can be substantially reduced through diversification. Historically, portfolios of medium to lower grade issues do, after absorbing all actual losses through defaults, provide higher net returns over time than portfolios of higher grade issues. Individual investors should never buy individual bonds. That's because diversification is an absolute necessity in bond investing to ensure the return of your money. Fortunately, index bond funds of many types are now available at low cost. How much to invest in bonds and whether to invest in bonds at all, not which particular bonds you invest in, will be the determinant of your overall investment results. As it has been for fiduciaries since the invention of insurance and pooled risk accounts in merchant shipping on sailing vessels hundreds of years ago, the basic responsibility of all investment professionals is to prevent adverse surprises and to control portfolio risk in deliberate pursuit of wisely determined and explicitly stated long-term investment objectives. Most active investors see their work as assertive and on the offensive. But today, the reality is that stock investing and bond investing are and should be primarily defensive processes. The great secret to success in long-term investing is avoiding serious, permanent loss. And the best way to do that, history shows, is indexing. Chapter 14. Whole Picture Investing. Money, as we are told in Economics 101, is fungible. Yet most investors think of their investment portfolios as standalone entities, separate from all their other assets. This is a major mistake because the wrong framing will almost certainly lead to unnecessary worries as securities markets fluctuate. It will also lead to asking the wrong questions, getting the wrong answers, and making the wrong decisions by not seeing the whole financial picture. Here's one example. Conventional wisdom says we should invest our age in bonds. But is that sensible? Should a 30-year-old MBA professional actually put 30% of her investment portfolio in bonds? Not if you reframe the question to include her largest single financial reality, the present value of her earned income over the next 35 to 45 years. So how might she think today about her expected future income? With a little effort, the most probable earnings progression can be sensibly estimated. She could check with her company's human resources department, her graduate school, or executive search firms on what progression is normal. Once she has estimated her earnings progression, she could convert that future stream of annual expected incomes into its net present value. Without much effort, we already know the first words she'll use when she sees the number. Wow, huge! My goodness! And this ignores her probable opportunities for getting stock options or bonuses or investing savings to earn further returns. It also leaves out any pension or 401k plan and Social Security benefits. As an asset, the net present value of her future earnings will tower over her current investment portfolio. She should certainly include this asset in her total portfolio thinking. The asset mix of her whole picture portfolio will be heavily loaded with the capitalized value of her future earnings, likely over 95% of her total financial portfolio. The net present value of these future earnings will not go up or down with the stock market. It will be more stable or consistent. So why should she invest her age in bonds? Surely she shouldn't. She's already overinvested in a stable value asset, her future earning power. Her securities portfolio should be 100% in stocks. Over time, other components of her whole picture portfolio will gradually become important. For example, there's a high probability she will have a nice home. Note that equity in a home is almost never a major moneymaker. While many older people believe our home has been our best ever investment, they are almost always including the usual dominant factors in their perceptions: long-term inflation and the tax deduction of mortgage interest in their calculation. Don't make this error. The main returns on a home come in family comfort and happiness. That's why many economists consider our homes consumer goods. But homes last a long, long time, far too long to be thought of as a consumable in my view. Better to think of your home as a stable value asset. If she's thinking in terms of her whole picture, our MBA graduate will include her home as well as the net present value of her future earnings, and not make the mistake of thinking of her securities portfolio in isolation from her other present and future assets. Also, when stocks go up and down, she will be particularly wise to practice thinking of her whole financial picture, which, thanks to her macro diversification, will be changing much less than the part invested in stocks. So she need not worry as much as will her cohorts who compartmentalize their assets into subgroups and fret too much about the relatively volatile behavior of just one part of the whole picture. Stocks. Chances are she does not need to own any bonds to achieve balance. Over the long term, whole picture thinking will enable her to invest more in stocks and over the very long term, possibly half a century, earn a significantly higher total rate of return. The whole picture portfolio includes capitalized Social Security benefits as well as the value of a pension fund or 401k. These assets are certainly part of the whole financial portfolio each of us should be seeing in its totality. If she is anticipating an inheritance, that too might be considered as she thinks through her overall financial situation and plans, although parents' circumstances can change. Chapter 15. More about bonds. Bonds have a long history, and there have been many changes in what have been considered best practices for investors on how and how much to invest in bonds. In the early 20th century, sensible, conservative investment in securities was almost always restricted to bonds, particularly those with good credit ratings. Individual investors also invested in home mortgages, usually in those days with just a 5-year maturity. Stocks, other than those of major railroads and banks, were almost always considered less than investment worthy. This way of thinking changed in the 20s when Edgar Lawrence Smith published Common Stocks as Long-Term Investments, his seminal study showing that, over the long haul, dividends from a portfolio of stocks not only were more sure of continuing without interruption than interest payments from a portfolio of bonds, but would also rise over time, producing higher and higher income streams for the long-term investor. Smith's book played an important role in the long bull stock market of the 20s and in attracting more investors to buy stocks. So did the rising stock market, the chance to use margin to try to make a killing, and favorable newspaper stories. That way of thinking got changed by the crash of 1929 and the Depression. Sensible investors went back into bonds as investments. During World War II, war bonds were widely promoted. Then, after the war, fears of a depression were powerful. Bonds were back. The 60-40 ratio of stocks and bonds became established as wise policy for personal trusts and corporate pension funds and endowments, and widely respected as prudent and conservative. Public pension funds were typically 90% in bonds. When stocks went up, bonds usually went down, and vice versa, people said. Others pointed out that since it was terribly hard for investors to stay on plan, given Mr. Market's gyrations, bonds being more stable had the important advantage of damping down market fluctuations and thereby helping investors stay on plan over the market cycle. The average 60-40 ratio was made more sophisticated by adjusting that familiar ratio to different age groups of investors, most commonly by recommending invest your age in bonds, or in other words, at age 30, hold 30% in bonds, at age 40, 40%, on up to 90% in bonds at age 90. Anything so neat and tidy should be viewed with great skepticism. Having listened to the last chapter, listeners will not be surprised to be urged to look carefully at their own total portfolio before deciding how much of their securities portfolio to invest in bonds. If your main reason for owning bonds is, candidly, to reduce the anxieties Mr. Market can generate in your emotional reactions to day-to-day or month-to-month price changes in the stock market, you can also reduce your worries by looking at the changes in the value of your whole picture portfolio, not at just the securities part of your portfolio in isolation. We have already explained how indexing with a broadly diversified portfolio of stocks will significantly reduce the anxieties driven by Mr. Market and thus make it less difficult to stay on plan with your investments. That's one of the many benefits of indexing. Another way to increase capacities to live with Mr. Market's tricks is to study the way markets have behaved in the past and are likely to behave in the future, so you will be well prepared for the many ways markets can provoke or drive us into all too human overreactions and worries. Bond ownership by most investors is, realistically, the cost of protecting your investments from yourself and excessive anxieties. Let me give a personal example. Now in my 80s, I continue to work because I enjoy my work and like being helpful to others. Do I have 80% in bonds? No, not even close. I've been engaged in investing all my working life and seen Mr. Market yank folks' chains so many times that I hope to be fairly well prepared for whatever he decides to try on me. Actually, my bond holdings are zero, but in my total portfolio, I have a chunk of stable assets. They are not investments made to earn returns, but they are significant to me as assets. If you capitalized Social Security benefits and added that to the stable asset value of your home and furnishings, they together might come to 30 to 40% of your total portfolio. So why not put more in stable assets? Because the time horizon for my securities portfolio is the life expectancy of our children and their children, and the average age of the first group is only 50 years. And for the younger group, the average age is less than 15, meaning that this younger group's investment time horizon is well over 70 and likely over 80 years out in the future. Sure, I have been and am lucky, but that's not the point. The point is that each of us has the privileged opportunity to look at the facts of our own situation and make a deliberate decision about the investment program that will work best for us. Should listeners do what I do? Yes, and no. Yes, all individuals should definitely do as I do in thinking for themselves and look carefully at their total portfolio and make sensible decisions about what would be right for them in that portion of the total represented by their securities. But no, since each of us is unique, unless you're exactly like me in age, income, investment horizon, risk tolerance, savings, etc., your best way of investing should be what's right for you, not what's right for me. What about target date or life cycle retirement funds? For those who do not want to make the time to work with an advisor on a tailored program of investments, these off-the-rack, sensible blends of index funds are clearly better than nothing. But beware, they are not far from the Procrustean put your age in bonds policy. That is not a good answer to how best to invest your assets to finance comfort and security in the last years of your life. Bonds are in a particularly bad spot today. Treasuries yield less than 2%. The Fed aims to have 2% inflation, so the likely net or true yield on those bonds is 0. Not a good investment when you get no real return. And there's always the risk that interest rates will rise, causing bond prices to fall, leaving investors with losses. Even if you don't like bonds for long-term investment, is there ever a time and reason for owning bonds? Certainly. When you have a commitment to pay a known amount for a specific purpose or purchase in the next year or so, it makes good sense to segregate that amount and invest in a money market account ready for action. Similarly, for a major purchase such as a family home, for which it would take much longer to accumulate the down payment, it would make sense to invest that down payment in a portfolio of intermediate maturity bonds. Every investor will want to have a ready reserve in case of a sudden financial emergency. This prudence can be provided via a bank loan or access to a stockbroker's margin account, but many investors like to have an assured cushion for caution they can turn to immediately, and this makes good sense. In the eat well versus sleep well trade-off, the purpose of this reserve is entirely to sleep well. So the amount that you decide is enough should be held in a short-term money market fund, clearly separated from your long-term investment portfolio. If you just don't buy the total portfolio concept, you will almost certainly want to buy more bonds, because the purpose of setting the asset mix of your portfolio is to set market risk at a level you can live with, particularly during distressing markets when Mr. Market is slinging lots of risk in your face, screaming that the world is coming to an end, and jumping up and down and waving his arms in alarm. But if you do buy and hold more bonds, history says clearly that you will pay a hefty price for this insurance. Most of investors' anxieties and vulnerability to Mr. Market's cost shenanigans are a result of what they don't yet understand about markets. More bonds are a high cost to pay for not doing enough study of markets and ourselves to be able to remain calm and carry on with our long-term plans. Chapter 16. Why Policy Matters. The principal reason we should all articulate our long-term investment policies explicitly, and ideally in writing, is to protect our portfolio from ourselves. The discipline helps us adhere to our long-term plans when Mr. Market misbehaves again and makes current markets distressing and puts our long-term investment policies suddenly in doubt. Misdemeanors in investing are almost always the result of our inadequate advanced understanding of the internal realm of our own short-term emotions in response to abrupt changes in the external realm of capital markets or specific investments, or both. All too often, investment policy is vague and implicit and is left to be resolved in haste when unusually distressing market conditions are piling pressure on. That's when it is all too easy to make the wrong decision at the wrong time for the wrong reasons. Such hasty decisions can result in investors selling stocks after the stocks have dropped steeply in value and then missing the subsequent recovery in the equity market, and vice versa, buying stocks at or near the market's highs when the past record looks most compelling. Such ill-timed changes in the asset mix have been severely harmful to investors' long-term returns. Technology has been transforming investing. Thanks to new technology, investment managers can approximate, within the array of feasible results, the intended long-term relative to market level of risk for any particular portfolio. Investors now have every right to expect results that match their reasonable risk expectations and their fund manager's capabilities. With investment operations conveniently indexed, investors can focus on developing long-term policies that will, over time, Achieve specified goals within each investor's tolerance for interim market risk. The best shields against the disruption of Mr. Market's short-term provocations are understanding and knowledge, particularly understanding of markets and knowledge of yourself and your own goals and priorities. That's why your carefully considered investment strategy should be committed to writing. Don't trust yourself to be completely rational when all those around you are being driven by emotion, because you too are human. As an investor, you will be winning when the results you want are the results you get by following the long-term policies that match your personal long-term priorities. In theory, we all know our long-term interests are best served by lower stock prices, so we can all buy more shares at bargain prices. But who among us is delighted by falling markets? And who does not feel a warm glow of affection for stocks and markets that have gone up, even though we know it means that stocks are now more expensive to buy and future rates of return on investments at these higher price levels will surely be lower? By contrast, who among us would close our pocketbook and turn away from the store that puts its most attractive wares on sale at 10, 20, or even 30% off its recent prices? None of us would say, I don't want to buy these things when they're on sale. I'll wait until the price goes back up and then buy. But that's exactly how most of us actually do behave with investments. When the market drops, putting stocks on sale, we stop buying. In fact, the record shows that we even join in the selling. And when the market rises, we buy more and more enthusiastically. As market expert Jason Zweig puts it, if we shopped for stocks the way we shop for socks, we'd be better off. We are wrong when we feel good about stocks having gone up, and we are wrong when we feel bad about stocks having gone down. So we should keep reminding ourselves that a falling stock market is the necessary first step in our buying low. Psychologists who study anxiety and fear have found that 4 characteristics make people more worried about the perceived riskiness of a situation than the realities would warrant: large-scale consequences, a lack of personal control or influence, unfamiliarity, and sudden occurrence. As a result, we are more fearful of domestic air travel, in which fewer than 30 people are killed and far fewer than 350 are hurt in a typical year, than of automobile travel in the United States. In 2019, over 38,000 people were killed and over 4 million were seriously injured. Most investors experience great anxiety over large-scale, sudden losses in portfolio value primarily because they were not informed in advance that such events are part of how markets sometimes behave. Sharp losses are to be expected and even considered normal by those who have studied and understand the long history of stock markets. Such drops in the market are predictable, not in their timing, of course, but in their probable magnitude and suddenness. No wonder non-students experience attacks of anxiety. It is in these periods of anxiety, when the market has recently been most severely negative, that investors allow their short-term fears to overwhelm the calm rationality that is best for long-term investing. Not only does the resulting excessive attention to the present produce groupthink mistakes, but it also distracts our attention from the long-run nature of successful investing. Investors need protection from their human proclivities toward unrealistic hopes and unnecessary fears, provoked by the emotionally compelling experiences of positive or negative surges in the market and by the current opinions that drive them. This is understandable. Investors who are not sufficiently informed about the true nature of investment markets will get surprised. Severe, sudden storms, such as the financial world experienced in 2008 and in 2020, surprise almost everyone. The investors' collective reactions to surprise, in turn, surprise almost everyone else. That's what can create a panic. We can substantially improve our long-term investment returns by being sure we understand, as much as we can, the realities of the investment environment in which our portfolios operate. Thoughtful, objective study of the past is the best and least costly way to develop an understanding of the basic nature of markets and, in particular, the nature of market extremes. That's why it pays to study market rates of return and patterns of deviation from the averages over the past several decades, learning as thoroughly as possible why markets move as they do. As an investor, it is more rewarding to study investment history than to study the present market activity or estimates of the future. We don't want to get caught in Santayana's trap. Those who cannot remember the past are condemned to repeat it. Again, visit your local library and read the financial section of your favorite magazine or newspaper for 1928 through 1929, 1957, 1962, 1973, 1987, 2000, 2008, and 2020. As Yogi Berra said, it's deja vu all over again. Markets always have been and always will seem surprising because while every market is different in its details, the major characteristics of markets are remarkably similar, time after time. Only by understanding the nature of investing and capital markets will you escape the paradox in which too much attention is paid to daily market happenings and too little attention is devoted to the truly important work of developing and adhering to wise, appropriate investment policies and practices that can, over time, achieve better results for you, much better than most other investors will enjoy. Chapter 17. Playing to Win. The winner's game in investing is open to all investors, so every investor can be a real winner, and it's almost easy. Almost. The first secret for success is that each investor has to ignore the beat-the-market hype that pervades the advertising that floods out of brokerage firms, actively managed mutual funds, and the investment letters from stock market gurus working in cahoots with Mr. Market. The second secret for success is that each investor must personally decide what are the investment policies that she or he can and will stay with through thick and thin, and that will, over the long term, have the best chance of producing the particular results he or she most wants to achieve. Investment policy is the explicit linkage between your long-term investment objectives and the daily operational work of investing. If policy is not determined through carefully developed understanding, it will be determined by improvisation or ad hocracy. Winning investors are not in competition with one another. They are in competition only with themselves. Can you stay on policy even when Mr. Market goes into his gyrations? While most investors think of investing as an enormously complex blend of activities, it is easy and worthwhile to unbundle investing into 5 separate levels of decision each investor can make. Level 1. Settling on your long-term objectives and your asset mix. The optimal proportion of equities, bonds, and perhaps other assets to achieve your objectives. Level 2. Deciding on your equity mix. The right proportions of various types of stocks. Growth versus value. Large cap versus small cap. Domestic versus international. Same with bonds. If you have a large portfolio, the same decisions can be made for subcategories of each major asset class. Level 3. Choosing either active management or indexing to implement your policy mix of investments. As we have heard, for most investors, low-cost index funds will be the best long-term choice. Level 4. Deciding, if you use active investing, which funds or managers will handle each component of your overall portfolio, where most investors unfortunately concentrate most of their time and effort. Level 5. Selecting specific securities and executing buy and sell transactions. The least costly and the most valuable decisions are made on level 1, getting it basically right on long-term goals and asset mix. The last 2 levels, selecting specific managers and buying and selling specific securities, are the most expensive and the least likely to add value. In addition, taxes and operating costs are much higher with the extra activity that comes from trying harder. Here's the ultimate irony of the loser's game. We are all too often dazzled by the excitement of the action and the chance to win on level 5, Mr. Market's favorite territory, where the costs to play are high and the rewards are small. Even worse, the search for ways to beat the market distracts us from focusing on level 1, where the costs are low and the rewards can be large. Very large. Because almost any asset mix can be achieved through low-cost indexing, investors considering active management should have an objective basis for deciding that the actual incremental returns, not just happy promises, will fully justify the extra cost and risk of selecting active managers. Note this important reality. Most active investors dream of being in the top quartile. The easy and assured way to get there is simple. Index over any reasonably long term. As the evidence clearly shows over the long term, it always works. If instead of using index funds, you wish to select an active investment manager who deliberately differentiates his portfolios from the market, you must take the time to understand clearly how he will differentiate his portfolios, whether by betting heavily on a few stocks, for example, or by favoring a particular stock market sector. When he will do so, whether continually as part of a long-term strategy or occasionally as a short-term tactic. And most important, why you can be confident that he will achieve favorable incremental future results by taking these actions. If you're thinking of making these exceedingly difficult decisions yourself as an individual investor, please think again. In today's investment school of hard knocks, the tuition is high and the benefits are low. Time, as we have heard, is the single most important factor that separates the appropriate investment objective of one portfolio from the appropriate objectives of other portfolios. The key is the length of time over which the portfolio can and will remain committed to a sustained investment policy and over which you will patiently evaluate investment results versus your objectives and policies. Your personal income requirements are excluded from this discussion of investment policy because the rate of return for an investment portfolio cannot be increased by much without taking more risk just because you want more money to spend. It is indeed a foolish idea that the investment objective for a portfolio could or even should be set according to how much the investor wants to spend each year. Sometimes this perverse idea shows up in pension funds, where the actuarial assumption about the rate of return is put forth as a guide to investment management. Sometimes it shows up when college presidents insist on higher endowment income to make up for operating deficits. And sometimes it arises when individuals try to force their retirement funds to finance a more expensive way of life than the funds can sustain. In all its forms, this practice is nonsense. Spending decisions should never drive investment decisions. It should be the other way around. Spending decisions should most definitely be governed by investment results, which follow from investment policies and the market's returns. Because frankly, the market doesn't give a damn what you want to spend. From time to time, perhaps once every 5 or 10 years, it will be appropriate to make a systematic examination of your overall resources, your spending objectives, your market experience, your risk tolerance, and your investment time horizon, all key factors in establishing your personal investment policy. Here are a few simple tests for every investment policy. Would the policy, if implemented, achieve your long-term objectives? Is the policy written so clearly and explicitly that a professionally competent stranger could manage the portfolio and conform clearly to your true intentions? Would you have been able to sustain a commitment to the policy during the most troubling markets of the past 50 years, including 2008? Is the policy realistically designed to meet your real needs and objectives as a long-term investor? A sound investment policy will meet all these tests. Does yours? Chapter 18. Challenges of Performance Measurement. You understand all you really need to know about the most important characteristics of investment performance statistics when you accept as obvious the following proposition. If many people are in a coin-tossing contest, you can predict 2 results with great confidence. 1. In the long run, most coin tossers will average about 50% heads and 50% tails. 2. In the short to intermediate term, however, some of the coin tossers will appear to be somewhat better than average at tossing heads or tails, and a very few will appear to be much better than average. If we were to inspect the record, surely the data on each individual coin tosser would be clear and objective. But we'd know better than to think that the past results would be good predictions of future results in coin tossing. Sooner or later, each of the coin tossers would inevitably become more and more average. As we've seen, statisticians call this powerful yet common phenomenon regression to the mean, a concept we touched on in previous chapters. Understanding the determining power of regression to the mean is the key to understanding a lot about reported investment performance. Here is the challenge. Investment skill is exceedingly hard to evaluate because the investment process is so complex and involves the interactions of so many different variables. Investment management is a continuous process filled with many transactions, so it takes a long, long time to be able to evaluate the process effectively. Specific investing problems differ day to day as companies change and industries evolve in many different ways. The economy, government, and market environments differ from year to year, and the competition from other investors changes. The stocks and bonds in the portfolios frequently change. Companies and their businesses are always changing, and the factors that most affect the prices of securities, fear, greed, inflation, politics, economic news, business profits, investors' expectations, and more, never cease to change. Meanwhile, every investment manager ages. While firms accumulate assets to manage, add or lose people and their relationships, access new technologies, change ownership, and so forth. By the time a masterful manager can be identified with reasonable certainty, the chances are high that she or he has changed significantly too. Since there is so much change and complexity in investing, a large sample of evidence, necessarily gathered over a really long time, is needed to achieve significance. The performance statistics cited in most advertisements are all too often short-term samples of just a few years. In a typical 12-month period, about 40% of mutual funds will beat the market, and even after taxes, 30% or more will succeed. But can they succeed again and again over the next 10 or 20 years, or even longer? Historical data say, no, not likely. After careful statistical analysis, one quantitative expert estimated that it would require 70 years of observations to show conclusively that even a large 2% annual incremental return, a very large 25 to 30% increase over a 7 to 8% base rate of return, was the result of superior active investment management skill rather than chance. As an investor, you will probably be investing for a very long time. If you start at age 30 and continue to 85, that's over half a century. You know that changing managers is notoriously fraught with costs and risks, so you would want to stay with one superior manager if you could. But the lesson of history is that apparently superior active managers seldom stay superior for very long. Changing active managers is both difficult and costly, particularly in errors made in both terminating and initiating relationships. The main reason for measuring performance is to improve client-manager communication. The purpose of performance measurement is not to provide answers, but to identify questions that investors and managers should explore together to be sure they have a good mutual understanding of what is contributing to and what is detracting from investment performance. Ask the child's favorite series of questions. Why? 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 You may find that just one or two decisions, perhaps brilliantly skillful, perhaps lucky, perhaps both, can make a powerful difference in the reported performance of an active manager. If portfolio operations have not been in accord with agreed-upon policy and the investment manager's agreed-upon mission, it is not really important whether current portfolio results happen to be above, lucky you, or below, unlucky you, the results that would be expected if the policy had been followed faithfully. In either case, the truly important information is that the portfolio and the portfolio manager are out of conformance and probably somewhat out of control. Sooner or later, this lack of control will show up in losses, all too often unrecoverable losses. Warning: performance measurement is least useful when it is needed most, and is needed least when it would be most effective. Performance data are based on too short a time period, too small a sample, to provide enough information to make an accurate, objective evaluation of a manager's long-term investing process. And performance results for longer periods, which offer greater assurance of accuracy, are not sufficiently timely to be useful for current decisions. By the time performance data are good enough for investors to act with confidence, the optimal time for action will be long past. Measurements of investment performance do not, at least in the short run, mean what they say. Performance measurement services do not report results. They report only statistical estimates. As usually reported, with 2 decimal precision for a specified time period, investment returns seem almost microscopically accurate. Over the 12 months ended June 30, Manager A returned 7.53%. Such articulated precision gives performance numbers the appearance of legitimacy. They do not deserve it. They are, in truth, only a small sampling of, not a measurement of, a long-term series of investment returns. Instead of 7.53%, it would be wiser to use 7.4 to 7.7%. As small samples, they should be treated as statistics, with their lack of certainty fully shown with plus or minus boundaries. As long as your investment portfolio is not being cashed in, this multidimensional turbulent set of change forces will go on and on. There are no real or final results until the process stops and the portfolio is liquidated. A form of Gresham's law, bad money drives out good, can easily take over as both fund managers and investors allow the obsession with short-term performance to drive out thoughtful consideration of longer-term investment practices and objectives. By expressing recent short-term returns so precisely, performance measurement may turn our heads and make us believe that the short-term is meaningful and that the long-term will resemble it. It almost never does. That's why Mr. Market's specialty of short-term focus is the mortal enemy of long-term investment success. Usually, a large part of the apparently superior performance was not due to superior skill that will continue to produce superior results, but was instead due to one sector of the market temporarily enjoying above-average rates of return. Or luck. When the tide turns, the behavior of the segment of the market that propelled the active manager ahead may now hold him or her back. That's one reason mutual fund managers' results so often regress to the mean. Another reason is this. With so many professional investors who are so good at what they do, it is difficult for any one of them to beat the crowd continuously at price discovery, the essential key to superior performance. Because the crowd is full of equally well-informed, intensely competitive, and disciplined professionals who play the same game with the same information technology and the same information. Long-term performance data on active managers will almost always have both a survivor bias and a backdating or new firm bias. As we have heard, the resulting combination of these two kinds of bias can create dangerously deceptive distortions. Survivor bias occurs when managers are removed from the record because their results were unsatisfactory or their fund was closed due to poor results. Deleting the poor performers artificially enhances the overall average, and investors who believe figures don't lie get deceived. In a related cause of bias, new mutual funds are incubated, to use the industry term, for a few years. Then those funds with the best recent performance get presented to the public as new investment opportunities. When these new funds are blended with the other funds into the overall record, the calculated average performance of the funds again gets a lift, and investors again get deceived. Caveat emptor. The distortion produced by these two biases usually equals and often exceeds the apparent superiority of the selected managers. Meanwhile, advertising will tout the funds with the best records, so investors will hear most often from those that have been, at least so far, the most successful. Moreover, as with any series of statistics, the starting point can be important. Many of the most impressive gee whiz charts of investment performance become quite ordinary by simply adding or subtracting 1 or 2 years at the start or at the end of the period shown. Investors wishing to use performance data should always get the whole record over many years, not just selected excerpts. For users of performance measurement, a big problem is separating 3 very different factors that are often mixed together. One factor is the sampling error, the probability that the statistics do not equal the reality. As with any sample, there will be imprecision and uncertainty. In investment performance data, the sampling error is the degree to which the particular portfolio for the particular time period is not a fair and representative sample of the manager's work. The second factor is the possibility that, during the measurement period, the market environment may have been favorable or unfavorable for the particular fund's way of investing. For example, Funds of small-cap stocks have had both very favorable and very unfavorable market environments during the past few decades. As a result, they all looked better in some years than they really were, and looked worse than they really were in other periods. The third factor is the skill, or lack of skill, of the manager. This is what many clients most want to measure. But here's the rub. In the short run, sampling errors will usually have a much larger impact on the reported results than will the manager's skill. As noted earlier, it would take many decades of performance measurement to know whether the apparently superior results reflected the manager's skill or just good luck. By the time you gather enough data to determine whether your fund manager's results were due to skill or luck, it will be too late for a timely decision. And at least one of you will probably have retired or even died of old age. This is illuminated in Table 18.1. Each row shows the returns achieved over the next 3 years by investing with last year's first, second, third, and fourth quartile managers. Even a brief inspection of the data shows that the performance in each row is almost random. Past performance does not predict future performance. Take a careful look at the data in Table 18.1. As you'll soon see, there's nothing to see. Net of fees, there is no pattern. Like Sherlock Holmes's dog that didn't bark, this lack of pattern is the pattern. As Gertrude Stein once said in dismissing the possibility of visiting Oakland, California, there's no there. Most individual investors are aware of the widely recognized ratings of mutual fund performance bestowed by investment research firm Morningstar. But Morningstar's 1 to 5-star ratings report only a fund's past performance. While the firm candidly says that its star ratings have little or no predictive power, 100% of the new investment money flowing into mutual funds goes to funds that were recently awarded 4 and 5 stars. We've all seen the numerous ads trumpeting these high ratings. This is too bad for investors because careful research concludes there is little statistical evidence that Morningstar's highest-rated funds outperform the medium-rated funds. Indeed, in the months after the ratings are handed out each year, the 5-star funds generally earn less than half as much as the broad market index. However unintentionally, these ratings are misleading investors into buying high and selling low. The grievous lack of predictability of future performance on the basis of past performance is also shown in Table 18.2, a stunning comparison of the results for the top 20 performers during a bull market and the results for the same 3,896 funds in a bear market the very next year. All but one fund plunged from the top. Over very long periods, the average return obtained by most actively managed mutual funds must be expected to be close to the market average, minus about 1.5% of costs each year for management fees, commissions, and costs of transactions, and custody expenses. Given today's consensus expectation of 7% average annual returns, that 1.5% is over 20% of the expected returns. That is a very high cost. So, even if they are, before costs, slightly ahead of the market, thanks to all their skill and hard work, most active managers lag behind the market after fees and expenses. And this is what studies of investment performance consistently show. Only 2% of active funds were more than 2% ahead of the market over the whole period, and that's before taxes. A much larger 16% were 2% or more worse than the market. If only 2% of mutual funds are significantly above the market versus 16% below, and you share the view that the odds of finding the right 2 in 100 are not good in a game played with real money, you would probably also agree that there is a fine alternative: index funds. In addition, as we've seen, income taxes are negligible with index funds because turnover is far lower and the funds can easily be managed to avoid incurring taxes. Even more disconcerting for mutual fund investors, the average mutual fund investor actually gets a return that is significantly below the return of the average mutual fund he or she invests in. From 1997 to 2011, the shortfall was stunning. Investors got only 1/2 of the returns earned by the average equity mutual fund. Even investors in bond funds got less than their funds did. We've seen this movie before. A 1999 study concluded that while the S&P 500 gained an average of 17.9% a year over the 15 years from 1984 through 1998, the typical investor in stock funds gained only 7% a year over that same period. The reason? Frequent trading in and out of funds chasing performance. Instead of staying the course with their mutual funds, many investors tried to time the market cycles, typically holding a fund for less than 3 years before selling it and buying a different fund. When the income tax consequences of what has become typical portfolio turnover, 60% or more annually, are deducted, mutual fund performance gets cut back even more. The odds of outperforming the market get worse and worse, and more statistically significant, as the measurement period gets longer, as shown in Table 18.3. One long-term study found that over 25 years, only 10% of surviving mutual funds had beaten the S&P 500. Note the qualifying term, surviving. As seen earlier, mutual fund companies bury their mistakes. So of all the funds that started out, the percentage that beat the market is even lower, much lower. And because professional investors are increasingly comparable in education, information, and technology, and expert professionals are so dominant in the market, the next 25 years will be harder to outperform the competition than the past 25 years. The purpose of measuring performance is to determine whether current portfolio operations are in faithful accord with long-term policy. A key concept is this: any unexpected and unexplained deviation from realistic expectation may signal poor performance. A sensible proxy for realistic expectations of a mutual fund is the average performance of other funds with similar investment objectives. A large unexplained deviation is very poor performance. And as every user of these statistical techniques for quality control knows, it makes no qualitative difference whether the deviation is above or below expectation. Sure, we investors are trained to think that higher returns are better returns, and in the long run they certainly are. But in the shorter run, deviating above or below expectation indicates that the manager is out of conformance with his or her mission. And out of conformance usually means out of control, with unhappy results being the probable eventual outcome. A ship is just as far off course when it is 10 miles west of its objective as when it is 10 miles east of its objective. It's nice for the investor to get a higher return than a lower return, but either one is off target, and the investor should not confuse good luck, or bad luck, with the manager's level of skill. One of the great frustrations professional investors have with short-term performance measurements is that bad decisions with favorable outcomes are often well received by amateur investors, while good decisions with temporarily unfavorable outcomes can lead to a loss of confidence at just the wrong time. Investors who choose a mutual fund just after it has benefited from a particularly favorable market environment often impute to the fund manager a special set of skills and genius that will prove impossible to reproduce after that favorable market environment changes. The final problem with performance measurement is its perverse tendency to stimulate counterproductive thinking and behavior by diverting the investor's interest and attention away from long-term policy and over to short-term operating results. The process of measuring almost certainly influences the phenomenon being measured, as the physicist Werner Heisenberg elucidated years ago with his principle of indeterminacy. Chapter 19. Active Investing's Failures. Dark forces have been stalking active investment management. Over the past 15 years, 90% of all domestic actively managed mutual funds failed to keep up with the index they chose to compete with and have tried to beat. As shown in Table 19.1, similar rates of failure have been experienced in all fund categories. And statistical experts would expect roughly 90% of that top 10% to fall short over the next 15 years. Most insiders are understandably reluctant to recognize and discuss the real meaning of those dark forces. Perhaps because they explain why active managers have, predictably, been more and more frequently failing. Most clients have not yet recognized that those powerful forces have been making it increasingly difficult for active managers to succeed in their self-chosen and self-celebrated mission, beating the market. The grim purpose of this chapter is to explain how much more disappointing investment performance has been than investment managers and selection consultants have reported and clients have been led to believe. Of course, some active managers will succeed over a decade. Fewer will succeed over longer runs. This dour reality is caused by two major forces. First, as will be shown in Chapter 23, fees have increased to surprisingly high levels when correctly calculated. Second, the huge influx of skillful, dedicated professionals with superb IT equipment and instant equal access to remarkably extensive information has continued to reduce both the number of winners and the magnitude of their winning, and increase the number of managers unable to overcome the cost of their fees and their operations. As a result, the average practitioner today is much better equipped and more capable than his or her average predecessor. But so are today's numerous competitors. Also, the distribution around the mean has become more and more concentrated, so it's much harder for any one manager to break out of the pack and achieve significantly better performance over the long run. The important reality is that most actively managed mutual funds, in category after category, fail to keep up with index funds with the same objectives. This crucial reality is shown dramatically in Table 19.1, which is based on data from SPIVA, the most trusted independent evaluator of mutual fund performance. The data in Table 19.1 are shown after the deduction of fees from all funds. Note particularly how low the success rate is over 15 years. Only 11% of all mutual funds keep up with their chosen index over 15 years. Or, as the hard evidence shows, 89% of actively managed mutual funds fail to keep up with their chosen market. At least as serious as the high rates of failure, nearly half of the mutual funds did not even survive for the full 15 years. Those funds that were closed down or merged into other better performing funds, almost always for poor performance, were no less than 44% of all large-cap growth funds, 43% of all small-cap growth funds, 37% of all large-cap value funds, 29% of all small-cap value funds. These abandoned orphans are, of course, essential parts of the whole truth that all investors need to know and understand. Finally, Figure 19.1 shows the painful sting in the tail from funds that close, never again to be reported or even acknowledged. They typically declined sharply during their last 12 to 18 months. Of course, most investors will not recognize such data. Most will say, "The performance numbers I've seen are much more favorable than these data. Something must be wrong." What's wrong is this. The way numbers are selectively reported in advertisements and promotional materials give investors a false and much enhanced impression of the performance of active managers. Alas, as already discussed, this deception is not accidental. No law or regulation requires mutual fund organizations to keep reporting funds they no longer manage. Nor are they required to report how many funds in their family have been closed or merged into a stronger fund within the same family. Nor is there any requirement to continue reporting the poor performance that preceded the closure or merger. As a result, many mutual fund families do what their competitors do. They quietly delete the poor and mediocre performers from the database as though they had never existed. Adding the deleted failures back into the record converts soft, selective, favorable claims to hard, unfavorable evidence and flips the conclusion from active usually works over to active usually does not work. Similarly, when consultants that help institutional investors select investment managers drop a manager from their recommended list, they usually delete all past data on that manager. I continue to report on a manager they no longer recommend. And when they add a new recommended manager, they add that manager's favorable results for prior years, retroactively. The result is a chart purporting to show that their chosen managers have outperformed. The data may be precise, with numbers taken to the third decimal, but they are not accurate measures of the consultant's selection skills or record. Given the many major changes in the composition of the securities markets, investors should recognize that it has been getting harder and in recent years, much harder, for most active investment managers to keep up with, let alone outperform, their chosen benchmarks. The data in Table 19.2 include results for funds that were merged or closed, and confirm this pessimistic evaluation. In almost every category and in almost every year, active managers as a group underperform their own chosen benchmarks. The trend over time is for larger and larger percentages of active managers to underperform their benchmarks. Table 19.2 shows that almost 40% of domestic mutual funds were terminated within 15 years of their launch. While the hard evidence is conclusive that active equity management is just not working and that a stunning 90% of actively managed funds fall short of their chosen benchmarks, the debate continues. Why? Because it's hard for anyone who depends on a particular belief to earn a living, especially when the financial and non-financial rewards are large, to deny that belief. We've seen this with big tobacco and big oil, the former denying it was causing cancer and the latter denying climate change. And our ancestors saw it in the Confederacy's stubborn defense of slavery. Unfortunately for the defenders of active management, as a brief review will show, their arguments are far from solid. Here's a collection. 1. Passive is no way to be successful in any competitive situation, so why give up trying with active investing? Because trying to win by being active doesn't work and is too expensive. Even better, every investor can be assured of top quartile results over the long term simply by indexing. 2. Indexing makes investors buy overpriced stocks like GE 15 years ago and hold them as they fall and fall more in price. True, but indexing also makes investors buy and hold stocks like Amazon, Facebook, Microsoft, or Google and hold them as they rise and rise and rise even more. 3. Indexing means a small group you do not know selects your stocks. That's no way to win. The selectors are carefully following the rules of matching the index you choose. Their job is not to be exciting or creative, but to be meticulous and consistent rule followers. 4. Indexing is for losers. Actually, indexing is the one sure way of achieving top quartile results, or better. 5. Active funds will beat the index next year, actives coming back. Serious investing is based on more than a single year, and over a decade, active will indeed have good years here and there. But the bad years will outnumber the good, and over a decade or longer, active falls significantly short. Compare these candidly limp arguments in favor of active investing with the following arguments in favor of indexing. 1. Over the past half-century, the investment markets and the investors operating in those markets and the resources they work with have all changed so much that anyone trying to beat the market index faces increasingly formidable challenges that are virtually impossible to overcome, except by good luck. 2. Operating costs of indexing are far lower than the all-in costs of active management. The keys here are the volume of portfolio transactions and the chances that when your active manager wants to sell or buy, many other active managers do too. So prices are driven up just when they want to buy and are driven down just when they want to sell. Of course, this doesn't happen every day, but when it does happen, prices can get moved a lot. Taking all trading costs for a year and dividing them into a percentage of assets managed, they come close to 1% of assets or 15% of normal returns. 3. Taxes are lower for indexing because portfolio turnover is much lower, typically about 5% in an index fund versus 40% or more in an active fund. 4. Fees are much lower for indexing, less than 0.10% versus 1.00% or more for active funds. And most actively managed funds now have 0.20% extra, 12B-1 fees to encourage brokers to encourage investors not to switch from fund to fund. 5. Indexing makes it much easier to stay on plan. For most investors, the most important part of their responsibility is for long-term success. When you have 500 or 1,000 different stocks or bonds in your portfolio, it's so much easier to remain calm and continue to focus on the long term, than when you own just a few stocks and Mr. Market sneaks up and jumps out in front of you, waving his arms and trying to distract you from your long-term plan with worries or excitement. 6. Indexing does not have any worries about the manager being acquired or about losing a great leader or becoming too big. Over a decade, half of all the leading active managers will likely experience one or more of these major disruptions, and over 20 years, almost all will. As a result, indexing avoids the costs and difficulties of deciding to leave a failing manager and of selecting a new manager, or the worry about whether or when to do so. 7. Experts on investing: Warren Buffett, Bert Malkiel, David Swensen, Daniel Kahneman, and a string of Nobel laureates all agree that indexing is the best way for individuals and most institutions to invest. 8. You have better things, much better investment management things, to do with your time and talent than trying to beat the market or find a manager who can and will beat the market. Much better. Every investor is unique, and each investor's most important responsibilities are much more important and much more doable than going on a snipe hunt, hoping to find a manager who will beat the index over the long haul. Those responsibilities are to save enough for your long-term future, to develop a long-term investment plan that is realistic and right for the particular investor, and to stay on plan. Simple? Yes, but hard to do well. So give yourself a well-deserved break and concentrate your time and capabilities where only you can get it done. Long-term investment policy. Most of us do not recognize how much the stock and bond markets have changed over the last 60 years. The changes have been enormous, many, and all in the same direction, making it much, much harder for active managers to be successful. Here are the most important changes. 60 years ago, a major securities firm might have had a dozen analysts in New York City looking for small but interesting stocks for the firm's partners to buy for their own portfolios, but most definitely not for the firm's clients. Today, every major securities dealer will have as many as 600 company and industry analysts, economists, commodities experts, political analysts, portfolio strategists, accounting experts, working in offices all over the world to cover every major economy, market, and company, each producing all the information and insight they can for distribution to investors all over the world. Satellite feeds track the number of cars in parking lots of shopping malls, the number of tankers going in and out of seaports all over the world, and all sorts of other data that might have investment impact. Bloomberg terminals that provide every user with every kind of information or historical trend or relationship he or she might want did not exist then, but today they number 345,000. Everybody is on the internet with email all the time, so global distribution of information is instantaneous 24/7. 50 to 60 years ago, corporate executives met regularly with selected active managers in posh private clubs for small lunches and dinners for insider briefings on current operations and earnings for the quarter and year. Now that's against the law. The SEC's Regulation FD, for full disclosure, requires that every listed company make diligent efforts to assure that whenever any information that might be useful in making an investment decision is disclosed to any one investor, the company must make sure that same information is simultaneously made available to all investors. Calculations were mostly done on slide rules. I still have my pride and joy, a log decatrix, somewhere, but wouldn't know where to find it. Computers were rare. Today we all have cell phones with us all the time, with more capabilities than an IBM 360 mainframe. Years ago, almost all investors confined their investments to the stocks and bonds of the companies in their own country. Today, investors all over the world invest in stocks and bonds of companies all over the world. Investors are increasingly global, and international investors are important in every market. As a result of all these cross-linkages, the reality is that almost all professional investors have almost all the same information as almost all their competitors at almost the same time. And this takes us to another major change in the nature of today's stock and bond markets, the change that makes all the other changes so powerful. In the 60s, the stock market was 90+% dominated by amateurs who put money into stocks when they got a bonus or inheritance, and sold when they bought a home or kids went to college. They bought or sold every few years and usually dealt in odd lots. They had no access to research, and half the time they invested in AT&T. Back then, institutions did only 9% of NYSE trading volume, and half of this 9% was done by local bank trust departments. Bank branching was limited to a single state or part of a state, and a mid-sized city might have 3 to 5 banks with trust departments, with a committee of seniors selecting stocks for the approved list of well-known blue-chip stocks that had good dividends and would be held long-term to avoid taxes. Today, stock exchange trading and off-the-board trading are massively different. First, the volume has increased from about 3 million shares a day to over 6 billion shares, an increase of over 2,000 times. Significantly, the value of derivatives trading is equal to or larger than the trading on the exchange. Far more important than the volume of trading is the change in the mix of who does all that trading. The percentage done by expert professionals in computers has gone up and up and up, from 9% in the early 60s to 20%, to 30%, to 50%, and onward to 70, then 80, and is now over 90%. What this means is compelling. Almost all the time, experts at institutional investors do almost all the buying and almost all the selling, and therefore they can only buy from or sell to other institutional experts who have just as powerful computers and also know almost all they know at almost always the same time. Now, put the numbers together. If fees and costs of operation combine to, let's be modest, 1 to 2% of assets, then in a market where the return is 7%, just to cover those costs, an active manager would need to be at least 15% better than the market consensus of experts. Grim as the record has been for active equity investment, the record for active bond management is even worse, as shown in Table 19.3. Chapter 20. Predicting the market, roughly. Investors naturally want to know the most probable investment outlook for the years ahead. Understanding the outlook for the next few days or weeks is easy. As J.P. Morgan famously said, it will fluctuate. One good way to be realistic about future returns is to assume that the future range of price and earnings, P&E, multiples, and corporate profits will be within their historical upper and lower limits, and will appear with increasing frequency at values closer and closer to the long-term average. While the economy is extraordinarily complex at a detailed level, and the stock market reflects all sorts of factors in every domestic and global industry, in thousands of companies, and in the overall economy, 2 big factors dominate reality for investors: corporate profits, and the dividends they provide, and the price and earnings ratio at which these earnings are capitalized. The market's P&E ratio is determined by interest rates, the outlook for profits and expected inflation, and an equity premium, reflecting the uncertainty of investing in stocks, plus or minus a speculative factor reflecting how optimistic or pessimistic investors currently feel. The best way to start a study of the future is to study the past. For the period 1901 to 1921, the inflation-adjusted average annual return of the U.S. stock market was just 0.2%. For the period 1929 to 1949, it was only 0.4%. And for 1966 to 1986, it was 1.9%. In other words, for periods covering more than 60% of the 20th century, the real annual returns generated by the third best performing stock market in the world were less than 2.0%. And the first decade of the 21st century was worse. At year-end 1964 and at year-end 1981, the Dow Jones Industrial Average stood at 875. That's 17 long years with zero net change before adjusting for inflation. Even though corporate profits were up nicely, interest rates had soared from 4 to 15%, compressing the market's price and earnings multiple substantially. Investors had become deeply pessimistic. From that low level, where did the market go? Up. In 1988, dividends yielded 3.5%, and over the next 11 years, earnings grew at an average of 7.1% annually. Good news for investors. The fundamental return of dividends plus earnings growth was 10.6% per annum. But that's not all. Investors got paid a lot more. While the fundamental return was 10.6%, the total investment return was a stunning 18.9%. The difference was made up by the annual add-on of 8.3 percentage points in price-only returns as the price and earnings ratio took flight and more than doubled from 12 to 29 at the millennium. Could it last? Of course not. Regression to the mean was sure to come again. Just as a price and earnings multiple of 12 had been too low, a price and earnings multiple of 29 was too high and eventually sure to go down. Historical perspective is always helpful. How do these two major factors, earnings and P&E, explain America's best ever bull market from 1982 to 1999? Here's how. First, corporate profits in 1982 were only 3.5% of the gross domestic product, significantly below the 4 to 6% normal range. By the late 1990s, corporate profits were almost 6%, the high side of the normal range. That's a big change. Next, interest rates on long-term U.S. government bonds plunged over that period from 14 to 5%. This single change would multiply the market value of those bonds eightfold, or 13% compounded annually. As with all long-term changes in the market's valuation, the main forces were fundamental and objective. Also included was an additional subjective factor that depended on how investors felt. Very pessimistic at the end of the bear market in the 70s and very optimistic in the late 90s. Over the same years, partly as a result of earnings growth, but primarily because of the major decline in interest rates, as expectations for inflation fell substantially, the Dow, with all dividends reinvested, increased nearly 20 times for a compounded annual return of 19%. Investors almost always project recent past market and economic behavior out into the future, somehow expecting more of the same to continue, even when we all know about cycles and fluctuations. In the early 1970s, investors were sure that inflation would stay sky high and earnings would stay low or get even worse, and most newspapers and magazines featured the same grisly prospects. In 2000, investors were, almost predictably, overly optimistic, anticipating more of the same compounding. Investors who were particularly enamored of internet stocks were chanting the mantra of all stock market bubbles. This time it's different. Past doomed investor enthusiasms were for canals in Britain in the 1820s, railroads in Europe and America in the 1850s, automobiles in the 1920s, and real estate in Japan in the 1980s. By 2007, the dot-com collapse had been forgotten, and investors were again comfortable with above-average P&Es. Then the subprime mortgage debacle compounded into a cataclysmic perfect storm that slammed the markets down as credit markets froze. Well-known banks and securities firms were suddenly closed, and fears of a major recession mushroomed. Once again, investors learned how difficult it is to estimate the near-term market. To start, if dividends yield 1.5% and corporate earnings grow at 4.5%, the middle of their normal range of growth over the long term, then a composite of 6% is the reasonable first part of the fundamental rate of return to expect before adjusting for inflation. Next, what change in valuation, if any, is reasonable? As a starting point, the average price and earnings ratio in recent decades has been about 15.5. Benjamin Graham wisely cautioned in the introduction to his classic textbook, Security Analysis, long-term investors must be careful not to learn too much from recent experience. He was talking about the 1929 market crash and the ghastly months and years that followed. He could just as easily have been talking about the internet market or the financial crisis of 2008 to 2009, or any of a long series of occasions when all or part of the stock market overreacted to recent events, sometimes positively and sometimes negatively, and short-term hopes or fears overwhelmed long-term valuations. Predicting the stock market roughly is not hard, but predicting it accurately is truly impossible. Equally, predicting approximately where the stock market will normally be in the long run is not hard, but even estimating how it will move over the next few months is nearly impossible and pointless. Chapter 21. Individual Investor Decisions. Individual investors are profoundly different from institutional investors, such as pension funds and endowments. It's not just that individual investors have less money. There is a difference in taxes. Active managers with typically over 40% annual turnover generate tax obligations that their investors must pay. So beware. Declared investment performance is before taxes. Another difference is decisive. Every individual is mortal, and we all know, as individuals and as investors, that life is short. While the exact timing is not known, mortality is a dominant reality for all individual investors. Those of us who are earning incomes know we each have a finite number of years in which to build our savings for retirement security. And those who are no longer earning and saving have finite financial resources on which they will depend for the indefinite duration of their lives. While the key to success in investing is rationality, most investors can't help letting their emotions get involved and, at certain market junctures, even get the upper hand. Individual investors' money often takes on great symbolic meaning and can engage investors' emotions powerfully, all too often, too powerfully. Many investors feel that their money represents them and the worth of their lives, just as entrepreneurs often identify their self-worth with their companies. This "my money is me" syndrome is particularly common among elderly people and can cause irascible or even petty behavior. If it happens to someone in your family, be tolerant. It's probably just another way of expressing fear of death. Yet another important reality is that individual investors have considerable power to affect others, both financially and emotionally, with gifts and bequests made, or not made larger or smaller than anticipated, or considered fair or unfair. Within a family, the emotional power and the symbolism of money are often more important than the economic power of money. Individual investors will be wise to deal carefully with both. Individual investors, as we know, usually buy stocks for reasons outside the stock market. They buy because they inherit money, get a bonus, sell a house, or for any other happy reason have money to invest as a result of something that has no direct connection to the stock market. Similarly, they sell stocks because a child is going off to college, or they have decided to buy a home, almost always for reasons outside of the stock market. Unlike the full-time professionals who so completely dominate today's stock markets, individual investors typically do not do extensive, rigorous comparison shopping across the many alternatives within the stock market. Most individual investors are not experts on even a few companies. Individuals may think they know something important when they invest, but almost always what they think they know is either not true or not relevant or not important new information. The amateur's scoop is usually already well known and factored into the market price by the professionals who are active in the market all the time. Thus, the activity of most individual investors is what market researchers correctly call informationless trading, or noise. These terms are not meant to be rude. They are simply descriptive. Anyone who feels offended by them is being too sensitive. It is little wonder that way back in the 1960s, the pioneers of active professional investing were working inside the market, making rigorous and well-informed comparisons of price to value across hundreds and hundreds of different stocks on which they could command up-to-the-minute information, and that they were confident they could outperform the individual amateur investors who back then did 90% of the trading. Back then, the professionals could and did outperform the amateurs' market. But that was over half a century ago. Now the picture is profoundly different. After over 50 years of enormous growth in mutual funds, pension funds, and hedge funds, and increasing turnover in those institutions' portfolios, the old 90-10 ratio has been more than completely reversed. Over 90% of all New York Stock Exchange trades, on and off the big board, are made by investment professionals. In fact, 70% of all trading is done by the professionals at the 100 largest and most active institutions, and fully half of all NYSE trading is done by the professionals at just the 50 largest and most active institutional investors. This means that 70% of the time that an individual investor trades, he or she is either buying from or selling to one of the 100 most experienced and best-informed investors in the world. Just how tough to beat are the 100 largest institutions? Here are some realities. The very largest institutions each pay their leading stockbrokers as much as $100 million apiece annually. The stockbrokers earn it by making the best markets and providing the best research services they can deliver. The institutions have extensive information services and powerful computers with sophisticated models and programs. They'll have teams of in-house analysts and senior portfolio managers with an average of 20-plus years of investing experience, all working their contacts and networks to get the best information all the time. You get the picture. Compared with an individual investor, the institutional investor has all the advantages. All investors share one all too easily underestimated risk: inflation. This adversary can be dangerous for individual investors, and most particularly dangerous for retired people, as it certainly was in the 70s. Because we now have so little inflation, many assume it will never come again. The Federal Reserve target is now 2% inflation, but perfect control is not likely, and a 3 or 4% inflation is certainly possible. Over the long run, inflation has been a major problem for investors, more serious than the attention-getting daily or cyclical changes in securities prices that most investors fret about. The corrosive power of inflation can be truly daunting. At 2% normal inflation, the purchasing power of money is cut in half in 36 years. At 5% inflation, the purchasing power of money is cut in half in just 14 years, and it gets cut in half again in the next 14 years to just 1/4. In our society, the average person can expect to live to about 86. When you are retired and have no way to offset the dreadful erosion of purchasing power caused by inflation, this is clearly serious business. Individual investors have responsibilities they take personally: educating children, providing a good family home, providing security in retirement, providing a strong self-defense against catastrophe or the risk of living longer and needing more health care than anticipated, helping to pay for health care for elderly relatives, contributing to the schools and other institutions from which they have benefited or hope their communities will benefit, and more. Finally, most individuals wish to leave something to their children and or grandchildren to enhance their lives. Children having better lives than their parents and grandparents is, for most people, the real meaning of progress. For some needs, particularly health care late in life, the amount of money that will be required is unknown, but may be very large, particularly compared with available savings. In planning the responsibility side of your total financial picture, balance sheet, you'll want to decide who is included in your we, and for what purpose. Doing so will be useful and informative. How much responsibility do you plan to take for your children's education? College is costly. Graduate school is increasingly desired, and it's costly too. After providing for education, is helping with a child's first home important to you? Help in starting a business or a dental practice? How about your parents, your brothers and sisters, or your in-laws? Under what circumstances would they need your financial help? How much might be involved, and when? Be sure you know what your total commitments might add up to, and when the money might be needed, so you can plan ahead. Investing must always begin with saving. No saving, no investing. Too little saving, too little investing. So we'll end our discussion of how best to invest with a very brief look at the success secrets of wise investors and how they manage that sine qua non saving. First, saving is not easy. It's hard. It's particularly hard if we frame the saving process in terms of what we give up or self-denial or any other negative. Successful savers don't think of saving that way at all. Successful savers frame saving as a positive, a winning process in which they avoid the mistakes others make again and again and, instead, make smart moves they know will benefit them in the future. This way they feel good about their decisions and about themselves, and positive about their good saving habits. The next success secret is to make your savings goals explicit. Abstract saving is nowhere near as powerful a motivator as having an explicit and credible goal you know you can achieve. A 10-year-old saving for a bike, a teen saving for college, and a young couple saving for a home are examples. The more specific, the better. Then comes a plan. For a $100 bike, $5 a week. For college, $100 a month. And for a down payment on a home, $10,000 a year. Where will the savings come from? How will the money be saved? Who will save it, and when will it be saved? How will you know you are on the right track, and what will you do if you slip behind schedule? As progress is made, give yourself positive feedback and affirmation. Think always in terms of your developing success and enjoy the process of creating a real victory for yourself. In many ways, good savers are like athletes who train hard and cheerfully report, "No pain, no gain." Where a person with a focus on current pleasures might indulge, the successful saver keeps a long-term focus on the more important and desirable longer-term results. Saving can be done in a variety of tactical ways, or in strategic ways, or in policy ways. Tactical ways to save include such devices as, when dining out, selecting one of the 3 lowest priced entrees, or having 2 appetizers instead of the more expensive entree, or taking the subway instead of a taxi to the restaurant, or having that first glass of wine at home before going out. Or perhaps you might even rethink dining out and instead dine at home. And as far as vacations go, you might choose to take your family camping for a vacation instead of going to New York City or to Paris. Again, the key is to frame the decision in explicit terms so your savings, large or small, will include the important positive of what you will do with your savings and how you will enjoy it when, later on, you spend the money you are now saving. Structural or policy ways of saving involve larger numbers of dollars and are typically easier to frame in a positive way. Instead of a larger or more expensive home, choose a smaller one you find particularly charming. Or buy a pre-owned car. Or act as though your income now is what it was 2 years ago and save the difference. Social ways to reduce spending and increase saving include shopping with your spouse and only buying what you both want to buy, or to avoid impulse buying, limiting your purchases to items on your list. As you make progress with your wisely selected way of saving, make time periodically to evaluate your results and your process. Is the process sustainable for you? Or have you taken on more than you can comfortably sustain or maintain? Now that you have some experience, would you like to increase or reduce your rate of saving? What adjustments would enable you to continue successful saving for years and years with enjoyment in both the process and the results? The point here is that there are many ways to save, so find the ways that will work best for you and enable you to stay on plan so you will have the double satisfaction of successfully achieving your saving objective and being able to buy what you most want to experience or own, increasing your number of first choices. Remember, the purpose of saving is to enable you to make your life experiences better. Better in anticipation, better in experience, and better in retrospect than they would have been, for you, without your saving as you did and being able to invest those savings to develop even more favorable experiences for you and for the people and organizations you care for. Of course, in investing, the easy way to reduce what you pay in costs is by indexing all the investment operations and sidestepping a series of costs. High fees, high operating costs, more taxes, and the significant costs of changing from a faltering manager to, the hope is, a stronger manager. As we've seen again and again, these costs are cumulatively large. That's why Jack Bogle liked to say, "You get what you don't pay for." The first purpose of saving is to accumulate a defensive reserve that, like a fire extinguisher, can be used when trouble comes. And like a fire extinguisher, such a reserve should be used boldly and fully whenever needed. The reserve is on hand to be spent. If you use your defensive reserve cautiously or only partially, you will simply require a proportionately larger reserve. A core concept of this book is that funds available for long-term investment will do best for the investor if they are invested in stocks and kept in stocks over the long term. This guideline is particularly important for young working investors for 2 major reasons. First, even at 7% returns, every $1 saved and invested will be over $2 in 10 years, over $4 in 20 years, over $8 in 30 years, and so on, following the rule of 72. Second, taking a total view of your financial picture, The largest asset is your ability to earn income year after year, probably in increasing amounts. The present value of this earning power can be conceptually viewed as an asset, as a future receivable in the individual's 30s, 40s, or 50s, and that asset's present value will be a large percentage of the investor's true total financial picture. But what about elderly investors whose life expectancy is less than the 10 years that usually approximate long term? Shouldn't they, as the conventional wisdom would have it, invest primarily in bonds to preserve capital? As usual, the conventional wisdom may well be wrong, particularly at today's low interest rates. While retired investors may decide, for peace of mind, that they prefer to invest in relatively stable securities, they may be letting their emotional interests dominate their economic interests. While elderly investors may not expect to live for many more years, their investments, after being inherited by beneficiaries, may have a very long-term mission. Why limit the time horizon for thinking about investments to the owner's lifetime when the owner's true objectives, providing for children, grandchildren, or alma mater, have a much longer-term horizon? Besides, one of the secrets to a long and happy life is to keep climbing and stay, in Disraeli's felicitous phrase, in league with the future. Investing in stocks can help keep us thinking young. To be a truly successful lifetime investor, the first and central challenge is always to know thyself, to understand your personal financial goals and what would truly be successful for you. Remember the wise counsel of author Adam Smith. If you don't know who you are, the stock market is an expensive place to find out. So are the markets for real estate, commodities, and options. Investors will be wise to take time to learn as much as possible about themselves and how they will feel and behave as investors during market highs and lows. We need to know our true selves so we can put our best rational thinking in control of our own emotions. For example, here's a simple test with a friendly twist. Question: if you had your choice, which would you prefer? Choice A: stocks go up by quite a lot and stay up for several years. Choice B: stocks go down by quite a lot and stay down for several years. Please make your choice before you listen to the next paragraph. Without listening ahead, which did you choose? If you selected choice A, you would be joining 90% of the investors, both individual and professional, who've taken this test. Comforted to know that most investors agree with you? You shouldn't be. Unless you are a seller of stocks, you would have chosen against your own interests if you chose A. Here's why. First, remember that when you buy a common stock, what you really buy is the right to receive the dividends paid on that share of stock. Just as we buy cows for their milk and hens for their eggs, we buy stocks for their current and future earnings and dividends. If you ran a dairy, would you prefer to have cow prices low when you were buying so you could get more gallons of milk for your investment in cows? The lower the price of the shares when you buy, the more shares you will get for every $1,000 you invest, and the greater the dollars you will receive in future dividends as a percentage of your investment. Therefore, if you are a saver and a buyer of shares, as most investors are and will continue to be for many years, your real long-term interest is, curiously, to have stock prices go down quite a lot and stay down. That way, you can accumulate even more shares at low prices and so receive more future dividends with the money you invest. So the right long-term choice is counterintuitive choice B. This insight may enable you to enjoy greater success as an investor and greater peace of mind in the inevitable bear markets during your investing career. You may even learn to see a benefit in bear markets. If you're really rational, you will. Most investors, being all too human, much prefer stock markets that have been rising and feel most enthusiastic about buying more shares when stock prices are already high, axiomatically causing the future rate of return from their dividends to be low and their risk of market losses high. Similarly, most investors feel quite negative about stocks after share prices have gone down and are most tempted to sell out at the really wrong time, when prices are already low and the future dividend yield on the prices paid will be high. See Figure 21.1. As shown in the figure, A $1927 invested in stocks grew to $106 over 72 years as a result of price appreciation. Naturally, you can't invest without absorbing lots of small interim losses because markets do fluctuate. But don't ever risk serious irrevocable losses. And don't invest with borrowed money. If you find yourself getting caught up in the excitement of a rising market or distressed by a falling market, stop. Go for a walk and cool down. Otherwise, you will soon become part of the crowd wanting to do something, and you will start making mistakes, perhaps grave mistakes that you will later regret. Benign neglect is, for most investors, the secret to long-term success in investing. If you have successfully saved and invested enough to have ample funds for all your chosen responsibilities and obligations, you have truly won the money game. Bravo! This is an appropriately thrilling achievement. Winners should be careful, however, never to put their victory at risk in an attempt to win big, particularly through unnecessarily borrowing, committing too much to any single investment, or overextending responsibilities and commitments. Winners should also avoid speculating. It's not worth the risk of becoming a big loser, truly a sucker. Winners should be equally careful about being too careful. For an individual investor, these 10 commandments may be useful guides to thinking about your decisions on investments. 1. Save. Invest your savings in your future happiness and security, education for your kids, and fiscal freedom to choose. 2. If you must play the market to satisfy an emotional itch, recognize that you are gambling on your ability to beat the pros. So limit the amounts you play with to the same, surely tiny, amounts you would set aside to gamble with the pros in Las Vegas. Keep accurate records of your results, and you'll soon persuade yourself to quit. Don't do anything in investing primarily for tax reasons. Tax shelters are usually poor investments. Tax loss selling is primarily a way for brokers to increase their commissions. There are exceptions. Be sure you have an astute estate plan that is current with your financial situation and the ever-changing tax laws. Making charitable gifts of low-cost stock that has appreciated in value can make sense if you are going to sell the stock anyway. Set up an IRA if you can, and maximize contributions to your tax-sheltered 401k or profit-sharing plan every year. If you have investments outside your 401k, make your investment decisions based on your total picture. To minimize income taxes, any bonds or bond funds belong in your tax-sheltered retirement fund. 4. Don't think of your home as an investment. Think of it as a store of value and a nice place to live with your family. Period. A home is not a good financial investment and never was. But a home can certainly be a fine investment in your family's happiness. House prices will always center on the cost to replace an existing home with a new one. Due to increasing efficiency in construction, the cost of building a new home is about the same as 50 years ago after adjusting for inflation. 5. Don't do commodities. Dealing in commodities is really only price speculation. It's not investing because there's no economic productivity or value added. 6. Don't get confused about stockbrokers and mutual fund salespeople. They are usually very nice people, but their job is not to make money for you. Their job is to make money from you. While a few stockbrokers are wonderfully conscientious people devoted to doing a thoughtful job for the customers they work with over many, many years, you can't assume that your stockbroker is working that way for you. Some do, but most simply can't afford it. Be realistic. The typical stockbroker talks to 200 customers with total invested assets of $5 million. To earn $100,000 a year, he or she needs to generate about $300,000 in gross commissions, or 6% of the money he or she talks to. To generate this volume of commissions, heavy expenses to the investors, the broker cannot afford the time to learn what is right. He or she has to keep the money, your money, moving. 7. Don't invest in novel or unusual kinds of investments. They are all too often designed to be sold to investors, not to be owned by investors. When the novice fisherman expressed wonderment that fish would actually go for the gaudy, decorated lures offered at the bait shop, the proprietor's laconic reply was, "We don't sell them lures to fish." 8. Don't invest in bonds just because you've heard that bonds are conservative or you think they are safe. Bond prices fluctuate, and bonds are a poor defense against the major risk of long-term investing: inflation. 9. Write out your long-term goals, your long-term investing program, and your estate plan, and then stay with them. While annual reviews of your investments are recommended, review your estate plans at least once each decade. 10. Distrust your feelings. When you feel euphoric, you're probably in for a bruising. When you feel glum, remember that it's darkest just before dawn, so take no action. Activity in investing is almost always in surplus supply. Less is better. Chapter 22. Selecting mutual funds. If you are not ready to accept indexing yet, you have two alternatives. You can make your own investment decisions, or you can invest in actively managed mutual funds. If, after listening to this short book, you still decide to pick your own stocks, please do yourself a favor and keep a careful record of your decisions, your expectations when you made each decision, the way your picks worked out, and all the costs. Stockbrokers may say that you pay nothing for their investment advice, their firm's research, or all the services you get. But take time to record all the costs, and you'll soon find that the stock brokerage commissions you're paying can easily add up over a year's time to a much higher total cost as a percentage of your assets than the fees of a mutual fund. Investing is not a hobby. Every major study has found that average long-term results for self-reliant individual investors are poor. Moreover, the dispersion of results above and below that average is quite wide, so all too many investors get stuck with very poor results. That's why stockbrokers typically lose more than 20% of their customers every year, and almost all those customers lost real money they will never win back. Start by knowing what your own investment objectives and staying power really are. Determining your investment staying power will help you set the level of market risk you can and will live with. Don't overcommit. Know your internal sensitivity to market risk and stay within your own limitations. As my father wisely advised, never risk more than you know you can afford to lose. In the mid-1970s, I made a major commitment to John Neff's Gemini Fund. I knew John well enough to know that he was unusually careful to control and limit risk. While conventional investors were not discriminating carefully between real risk and perception, John clearly did. The stock market was in the depths of a major bear market and had been particularly negative on the value stocks John liked to own. As a closed-end dual-purpose fund, with one class of shares getting all the dividend income and a second class getting all the capital gains, Gemini's capital shares had experienced the adverse leveraged impact of a multi-year major decline in the stock market and were selling at a large discount from net asset value. I calculated how much broker's margin could be used without getting a margin call, even after a further 20% drop in stock prices, and bought in, fully margined. As the market rose, I enjoyed 6 layers of benefits. John Neff as my investment manager, plus the recovery of the market, plus the superior returns to value stocks, plus the shift from discount to premium in the Gemini Capital shares, plus the leverage of the Duo Fund, plus the leverage of heavy margin. Despite all the apparent leverage risk, I felt very confident and quite safe for one great reason. I knew that John was both rigorously risk-averse and a disciplined, rational investor. The following 10 years, thanks to John's great work as the professional investor's favorite investment professional, were very well rewarded. Study your own record of decisions over the years to see how well you perform as an investor, and examine your capacity to tolerate market adversity in different time frames. It's one thing to know your ability to handle quarter-to-quarter fluctuations. They are usually relatively modest and soon reversed. It's another thing to absorb and accept a full bear market, particularly one that lasts longer and plummets more than normal. For example, ask yourself how you felt when stocks lost over 45% of their value in 2008. How did you feel, and how did you act under the ferocious pressures as day after day the market fell again and again? You may still want to select your own mutual funds, so here's a suggestion. You can jumpstart your search by getting a list of the leaders in 401ks or other defined contribution plans from Money, Forbes, or Bloomberg Businessweek. Then ask your most knowledgeable acquaintances which of these funds consistently attract the best people and are most likely to achieve good results over the very long term. Your list will soon be dominated by such outstanding organizations as American Funds, managed by Capital Group companies, T. Rowe Price, and Vanguard. Look for organizations that charge low fees and whose professionals invest most of their own net worth in their employer's own funds. When selecting an actively managed mutual fund, make your selection in a deliberately unorthodox way. Do not pick one fund. Instead, start with a ballpark decision. Rather than trying to find the best mutual fund, look for a superior investment organization that offers a full family of mutual funds. Ask around. Is that organization considered a great place to work that consistently attracts and keeps first-rate people? Does it manage itself primarily as a professional organization rather than a commercial organization? The key to your investment success is not found in last year's performance numbers. It's in the long-term professional culture of the organization. Stocks and investment ideas come and go. Fund managers come and go. But character in a person or culture in an organization, good or bad, is hard to change. So look for the culture that attracts and keeps superior people for 30 or 40-year careers. Look for consistency in statements about how we do things here. And be skeptical of organizations that try to get you to focus on recent results when your true interests are all long-term. Eventually, character or organizational culture will surely dominate. So look for a well-established organization with a good long-term record, an organization that is respected and admired by knowledgeable investment people, and one you will be comfortable to live with over the long term. The idea of comfortable to live with is the key to long-term investment success for most individuals investing in mutual funds, because you do not want to change funds. Change is the investor's enemy in two ways. First, the cost of changing mutual funds may look small. Switching funds only costs a few percent of assets. But all too many of those who change funds do so every few years, and those costs of change keep adding up. Second, most investors who change funds pay much larger hidden costs because they sell after the worst part of the losses and buy after the best part of the gains. Watch the total industry money flows. Most of the selling comes after a fund has already underperformed, and most of the buying comes after a fund has already outperformed. And the inflows and outflows are largest for the funds with the most dramatic ups and downs, making the self-inflicted pain all the worse. Sales-driven mutual fund companies may look back with understandable pride on how very far they've come as entrepreneurial businesses. But all too few recognize that in winning the confidence of more than 100 million individuals and over half the families in the United States, mutual fund companies have not only won the battle for business success, they have also transformed themselves from business organizations into organizations with large fiduciary responsibilities because they have accepted the public trust. So whether the fund companies recognize it or not, the standards are now very different. How many different mutual funds should you use? Not many. With mutual funds, an investor usually can find several different styles or classes of investing offered by any one major family of funds. Index funds of different kinds, growth funds versus value funds, large cap versus small cap, money market funds, real estate investment trusts, international versus global, and many more. All the funds offered by a well-managed family of funds will be organizationally accountable for the same standards of professionalism, reasonable fees, and investor services. That's why it makes sense to choose carefully and concentrate your mutual fund investing with one fund family whose long-term investment results, business values, and practices you respect. Wise investors choose mutual funds carefully and then stay the course. A good rule that is simple to state, but very difficult for most investors to follow is this. Never choose a mutual fund you would not confidently double up on if the fund's performance was significantly behind the market for 2 or 3 years, and popular opinion was that the fund's manager had somehow lost his or her touch. Most mutual funds with superior long-term performance success have, within their long-term record, 3 straight years of subpar performance, usually because the fund's long-term investing discipline was out of step with the market for that particular period. You know from personal experience at ticket counters and airport security lines that it usually does not pay to switch from one line to another. Switching investment managers is even less productive, and switching funds is costly. Staying with a competent mutual fund manager who is conforming to his or her own promises, particularly when this manager is out of phase with the current market environment, shows real client prudence in investing and ultimately will be rewarded. Of course, the easy answer is to use index funds. Rare is the mutual fund that achieves long-term results substantially superior after adjustment for risk. The data are as grim as a photograph of the 1913 graduating class of the Military Academy in Saint-Cyr, France, a snapshot in time of a group of young men destined for combat in the trenches of World War I. For over 50 years, mutual funds in the aggregate lost 180 basis points compounded annually to the S&P 500, returning 11.8% versus 13.6% for the benchmark index. Over the past 2 decades, index fund returns have exceeded the results of nearly 90% of all U.S. mutual funds. After years of careful study, Princeton's popular professor Bert Malkiel has found that the best estimate of a mutual fund's future performance relative to other mutual funds is based on just 2 factors: portfolio turnover and expenses. In both cases, less is more. And in both cases, the secret is low-fee index funds. Chapter 23. Phooey on fees. The pricing of investment management services has been an increasingly glaring exception to the hallowed laws of economics for the past 50 years. At long last, this exception may now be subject to substantial disruption. Though some critics grouse about them, most investors have long thought investment management fees are best described with one 3-letter word: low, or a 4-letter word and one number: only 1%. In particular, fees are seen as so low that they are almost inconsequential when choosing an investment manager. This view of fees is a delusion for investors, and a not-so-innocent deception by investment managers. Framing the way we describe and see something can make a major difference, and so it has been with investment management fees. Seen correctly for what they are, fees for active management are very high, and much higher than even most critics of fees have recognized. When stated as a percentage of assets, average fees do look low, a little over 1% of assets for individuals, and a little less than 0.5% for institutional investors. But is this the right way to measure or describe fees? No, not even close. Here's why. The investors already have their assets, so investment management fees should really be based on what value added is contributed by the investment manager: higher returns. Calculated correctly as a percentage of returns, fees no longer look low. Do the math. If future stock returns average, as most observers seem to expect, 7% a year, then compared with returns, those same fees are not 1% or 0.5%. They are much higher, more like 14% for individuals, 1/7 of returns, and over 7% for institutions. But even this recalculation substantially understates the real cost of active investment management. That's because index funds produce a commodity product that reliably delivers the market rate of return with no more than market risk. Index funds are now available at fees that are very small, 0.10%, or less for individuals, and 0.05%, or even less for institutions. Since the commodity product is available to all investors, we should apply the lesson learned in Economics 101. When a reliable commodity product is widely available, the real cost of any alternative is the incremental cost as a percentage of the incremental value. So rational investors should consider the true cost of fees charged by active managers not just as a percentage of total returns, but as a percentage of risk-adjusted incremental returns above the market index. This is because the correct calculation is the incremental fee versus the fee for indexing as a percent of this incremental return. Thus, correctly stated, management fees for active management are remarkably high. The impact of only 1% can accumulate over time into a very large number. In one example, two investors each start with $100,000 and add $14,000 each year for 25 years. One of the investors selects a manager who charges 1.10%, and the other investor pays only 0.10%, a difference of only 1%. After 25 years, both have more than $1 million, but the difference between them is $255,423. Over $250,000 separates $1,400,666 from $1,145,243. If you think that the level of fees should be in proportion to the actual benefit the fund shareholder gets, you'll be impressed to learn that the fees most mutual funds charge, relative to incremental risk-adjusted returns, are over 100%. That's right. All the value added over the index commodity product, plus some, goes to the active fund manager. And there's nothing left over for the investors who put up all the money and took all the risk. It is a funny business, and worth thinking about. Are any other services of any kind priced at such a high proportion of client-delivered value? How long can active investment managers continue to thrive on the assumption that clients won't figure out the reality that, compared with the readily available index fund alternative, fees for active management are astonishingly high? Fees for active management have a long and interesting history. Once upon a time, 75 years ago, investment management was considered a loss leader. When pension funds mushroomed as fringe benefits during the post-World War II wage and price freeze, major banks controlled most of this new business by agreeing to manage pension fund assets as a customer accommodation for little or no explicit fee. But the banks found a backdoor way to monetize their activities. With the high fixed-rate brokerage commissions of those days, the banks exchanged trust department brokerage commissions for the large cash balances arising from retail customers' accounts. Under the terms of these agreements, brokers got reciprocal commission business, then averaging about 40 cents per share. And in exchange, the banks got the idle cash balances in thousands of customers' accounts, adding up to millions of dollars, that they could lend out at prevailing interest rates. Both parties benefited, but not the broker's customers, whose money was the mother's milk in the silent arrangement. In the 60s, a few institutional brokerage firms like Donaldson, Lufkin and Jenrette, Mitchell Hutchins, and Baker Weeks had investment management units that nominally charged full fees, usually 1%, but then offset those nominal fees entirely by deducting the brokerage commissions generated by their active management practices, so their real fees were actually zero. The new managers organized in the 60s and 70s found that they could easily charge much more than banks and insurance companies because higher fees were seen as a confirmation of their expected superior performance. Compared with the magnitude of the predicted superior performance, the fees for active investments simply did not seem to matter. Any quibbling about fees was easily dismissed with comments like, "You wouldn't choose your child's brain surgeon on the basis of price, would you?" When Morgan Bank took the lead in the late 60s by announcing it would charge institutional fees of 0.25%, conventional Wall Street wisdom held that the move would cost the bank a ton of business. Clients would never accept such a high charge. Actually, Morgan lost only one small account, so other managers realized that fees could be raised, and so they were. Thus began nearly a half-century of persistent fee increases by major managers, facilitated by client perceptions that fees would be comfortably exceeded by incremental returns if the right managers were chosen. Even today, despite extensive evidence to the contrary, both individual and institutional investors somehow expect their chosen managers to produce significantly higher than market returns. That's apparently why fees have seemed low. Decade after decade, assets of mutual funds and pension funds multiplied. And at the same time, fee schedules for active investment management tripled or quadrupled, instead of going down, as might be expected by economists. With this combination, the investment business grew increasingly profitable. High pay and interesting work attracted rising numbers of highly capable MBAs, MDs, and PhDs to become analysts and portfolio managers, and, collectively, more competition for one another. The worldwide increase in the number of highly trained professionals, all working intensively to achieve any competitive advantage, has been phenomenal. Estimates of the number of professionals now devoted to various aspects of price discovery range from 500,000 to 1 million, up from perhaps 5,000 50 years ago. Meanwhile, particularly during the high returns of the great bull market of the last quarter of the 20th century, investors continued to ignore fees because almost everyone assumed that fees were unimportant. Fees for investment management are remarkable in another way. Nobody actually pays the fees by writing a check for an explicit amount. Instead, fees are quietly and automatically deducted by the investment managers, and, by custom, are stated not in dollars, but as a small percentage of assets. Now, with return experience and return expectations both lower, a previously overlooked reality is getting more attention. While asset-based fees have increased substantially over the past 50 years, more than fourfold for both institutional and individual investors, investment results relative to the market have not improved. They've gotten worse. As a result of many major compounding changes in the stock markets of the world, particularly the massive influx of skillful competitors, most active managers are unable to overcome both operating costs and fees. Fees are surely not everything, but just as surely, fees are not nothing. When analyzed as incremental costs for incremental returns, investment management fees are now very large. No wonder that increasing numbers of individual and institutional investors are turning to index funds and ETFs, and that those with experience with either or both are steadily increasing their use. One thing is clear. Few, if any, indexers would consider switching from indexing to active management. Why pay over 10 times the fees, plus more in taxes, to get more uncertainty and lower long-term returns, plus the risk of a serious and costly manager disappointment? Meanwhile, those hardworking and happy souls immersed in the fascinating complexities of active investment management might wonder, is industry-wide compensation for active management now in a global bubble of its own creation? Does a specter of declining fees haunt the industry's future? Chapter 24. Planning your play. Yes, death is every individual's ultimate reality. But as an investor, you may well be making too much of it. If, for example, you plan to leave most of your capital in bequests to your children or grandchildren, the appropriate time horizon for your family investment policy, even if you are well into your 80s or 90s, may be so long-term that you'd be correct to ignore such investment conventions as older people should invest in bonds for higher income and greater safety. Or the adage, to determine the percentage of your assets you should have in stocks, subtract your age from 100. Or invest your age in bonds. The wiser, better decision for you and your family might be to invest as much as 100% in equities, as I do at age 83, because your investing horizon may be far longer than your living horizon. If the people you love, your family and heirs, or even the organizations you love, your university or favorite charities, are likely to outlive you, as they almost certainly will, perhaps you should extend your investment planning horizon to cover not just your own lifespan, but theirs as well. For instance, if you are 40 years old and have a 5-year-old son, your real investment horizon may not be another 40 or 50 years, your own future life expectancy, but closer to the 80 or more years your son is likely to live, particularly for any funds you plan to leave to him. Even if you are 75 years old, your investment horizon could be equally long if you have young grandchildren or a favorite charity. We investors are mortal, but our investments don't know it, and frankly don't care. Remember another admonition from Adam Smith. The stock doesn't know you own it. This observation applies to all investments, stocks, bonds, buildings, and so forth. All have value today and will have a future value irrespective of who owns them. Therefore, investing should be done for investment reasons, not for such personal reasons as your age. So don't change your investments just because you have reached a certain age or have retired. If you could afford fine paintings, you wouldn't change the pictures you love the most simply because you'd reached retirement or celebrated your 70th or 80th birthday. It's the same with investments. Why not maintain a long-term goal-centered strategy? Compounding is powerful, particularly over the long term. Remember the grateful sultan who offered to reward his vizier generously for a good deed that had saved the sultan's empire. The vizier modestly offered to accept only 1 grain of wheat on the first square of a checkerboard, only 2 grains on the next, 4 grains on the third, 8 grains on the fourth, and so on, and on and on. The crafty vizier said that he had no need for a great reward, and that the symbolism of this compounding reward would please his humble heart. Joyfully, the sultan seized upon this seemingly simple way to clear his obligation. But he did not reckon on the formidable power of compounding. Anything doubled 64 consecutive times will balloon, and balloon again. In the story, the few grains of wheat compounded to a total value that was greater than all the wealth in the empire. To defend his honor before Allah, the sultan ended up turning over the entire empire to the vizier. All investors need to understand the impact on them and their investments from market risk and inflation risk. Table 24.1 shows how these two unavoidable risks trade off over 80 years. The first 3 columns show nominal returns, with stocks producing nearly 3 times the returns of Treasury bills, and the T-bills never showing a loss. The next 3 columns, adjusted for inflation, tell a very different story. The real return on stocks is a full 9 times the returns on T-bills. Note the percentage of years with negative returns. Before adjusting for inflation, T-bills never lose, and stocks are negative 30% of the time. But after adjusting for inflation, T-bills and stocks both have negative returns 35% of the time. Bonds are slightly worse. The message is not just how wonderfully compounding increases real wealth. The message has 2 parts. And the second is that inflation relentlessly destroys purchasing power. Beware of the promotional materials and advertising that are deceiving investors with a Lorelei promise of phenomenal future riches without explaining the grimly negative impact inflation can have as the ruthless, unrelenting destroyer of capital. To purchase an item costing $100 in 1960 would cost more than $850 today. The power of inflation to impose real harm on investments can be seen by studying the Dow Jones Industrial Average after adjustment for inflation. Note particularly, over the 5 years from 1977 to 1982, the inflation-adjusted Dow took a 5-year loss of 63%. Rational long-term investors should know and remember that in the 15 years from the late 1960s to the early 1980s, the unweighted stock market, adjusted for inflation, plunged by about 80%. As a result, the decade of the 1970s was actually worse for investors than the decade of the 1930s. In 1993, the Dow was at last equal to its inflation-adjusted level at the peak of the market in 1929. 64 years was a long, long time waiting to get even. In developing a sound financial plan, investors will want to begin with good answers to these 3 overarching questions. Does my plan assure me of having enough income after inflation to pay for an appropriate standard of living during retirement? For most people, this sufficiency of income works out to 75 or 80% of pre-retirement spending, plus 2 to 3% compounded annually to offset inflation. Will my financial reserves be sufficient to cover unexpected emergencies, usually healthcare, in old age? Beware, 80% of a typical person's lifetime expenditures on healthcare are spent in the last 6 months of life. Women live longer than men, and wives are often younger than their husbands. So most couples will want to pay particular attention to providing adequately for the wife's years as a widow. Will the remaining capital match our goals and intentions for giving to our heirs and favorite charities? If these core questions are not answered fully and affirmatively, your plan needs to be reconsidered and changed, perhaps substantially. If change is called for, do it now so you'll have time on your side and working for you as long as possible. Write down your goals, with the target dates by which you intend to achieve them, so you can measure your actual progress compared with your explicit plan. Time is a key factor in all matters of investing. Investment decisions are not always best when driven by non-investment events, such as the timing of a child's admission to college, the receipt of an inheritance, and the date of retirement. So separate when you invest from how you invest. Your investments do not know your wishes or intentions. The investment market won't adapt to you. So as an investor, you must adapt to the market. Over your lifetime as an investor, your optimal investment program will change and change again, partly because your circumstances and resources will change, and partly because your objectives and priorities will change. But the more thoughtfully and soundly you plan, and the further in advance you do your planning, the less you will need to change your plan as time passes. Planning a sound, long-term investment program is often done best in 10-year chunks of time. This helps because working with decades reminds us that sound investing is inherently long-term in nature. Of course, planning is only as useful as the actual implementation that follows. The first step is clear. Get out of debt. It's a great, well-earned feeling when you achieve the first victory of paying off your school loans and the debt you incurred while you were setting up your first household. The key to getting out of debt is clear. Save. A lifetime based on the habit of thrift, spending less than you might, and deferring the spending you can, is essential to saving. Those who assume or hope that their incomes will somehow outstrip their spending may believe in magic, but they are doomed to be disappointed, often grievously. Pay yourself first. Do this by putting money into savings on a regular basis. Dollar cost averaging, a fixed dollar amount each month, is a good way to pay yourself first. And if your employer has a defined contribution retirement plan, be sure you make all the matchable contributions. Why leave free money on the table? Strive to participate at the maximum allowable level in a workplace matching retirement plan. There's a big difference between borrowing in a deliberate, judicious way and being in debt. The sensible borrower is comfortable because he or she has ample capacity to repay, and most important, decides or controls the timing of repayment. The debtor borrows only what a lender decides to lend and must repay at the time chosen by the lender. That's why borrowing with a mortgage is very different from being in debt. Just as borrowing differs from being in debt, retirement differs from old age. In retirement, you have more time for travel, reading, sports, and other interests. In old age, your body aches in different ways every day and every night. Table 24.2 tells an important story about inflation. The figures in the second row, labeled nest egg goal, are the amounts you would have to have saved by age 70 to have the inflation-adjusted equivalent of $35,000 in yearly spending money. If you want $70,000 a year of spending money to sustain your lifestyle, multiply the figures in the second row by 2. If you want $105,000, multiply by 3, and so on. Here's how to read the table. Find your present age in the top row. The nest egg goal is the amount of capital you will need to accumulate to have an inflation-adjusted $35,000 to spend each year from age 65 on. The current savings on the left, ranging from $0 to $250,000, is the annual amount invested tax-free at a return of 10% annually until you reach age 70. Note, 10% is convenient for calculations, but almost certainly too high. The rest of the table shows the amount you would need to save and invest to achieve your nest egg goal. After retiring at age 70, the assumed returns average 7%. It is further assumed that by age 90, all your accumulated savings will have been spent. Note, many of us will live past 90. If your age is 35, the second column, you'll need to accumulate $2.5 million by the time you reach age 70 to produce $35,000 a year of real spending money. The column shows, for each level of savings you've already accumulated, how much you'll have to save every year to achieve that goal. Note the rather favorable assumptions. All your savings go into a tax-deferred account, such as a 401k plan, where they are further assumed to compound at 10% annually, which certainly would be too high an expectation given the current economic outlook, until your retirement at age 70. Starting from present market levels, this may be possible, but it will certainly be challenging, even if you invest entirely in equities. In bonds, it simply cannot be done. Remember algebra and solving equations with 2 unknowns? Did your course get to 3 unknowns? As investors, we are confronted by a much more complex challenge: to solve, or at least manage sensibly and rationally, a puzzle with 5 major unknowns, each of which is changing. The 5 unknowns are: 1. Rate of return on investments. 2. Inflation. 3. Spending. 4. Taxes. 5. Time. One analysis of a hypothetical 35-year investment plan started with the happy assumption that an investor began in 1964 with a cool $1 million. The consequences of various investment programs were then examined. The nominal compound rates of return for this period were unusually favorable: 11.8% for stocks, 7.9% for bonds, and 6.8% for treasury bills. The very pleasing, but as we'll soon see, very deceptive theoretical final portfolio values produced by the initial $1 million were: stocks, $55 million, bonds, $15.5 million, T-bills, $10.7 million. Everyone's a winner, or so it may appear. But here's how the results look after taxes. Stocks, $30.2 million, bonds, $6.6 million, T-bills, $4.4 million. What a difference those taxes make, particularly to bonds and T-bills. Note that the taxes assumed are minimal. The investor pays only federal taxes, no state or local taxes, has no other sources of taxable income, and files a joint return. For most investors who can invest $1 million, actual taxes are almost certain to be larger. Brace yourself for the impact of inflation, because that's the way we convert nominal or apparent values into real money. The results are sobering. Here's the result after adjusting for inflation over the same 35 years. Stocks, $5.4 million. Bonds, $1.2 million. T-bills, $0.8 million. Inflation, the data show, was a far larger problem for investors than taxes. In real purchasing power, bonds were only 20% ahead of the initial investment after a whole generation, and T-bills were actually behind the starting line by 20%. That's why taxes and inflation are rightly known as fearsome fiscal pirates. It would be worse if the data had included realistic ownership costs, such as mutual fund expenses and trading costs. Even the typical money market mutual fund charges roughly 0.5% per year in expenses, while bond funds charge up to 1%, and stock funds can charge as much as 1.5%. At those rates, you would have the following take-home results for your $1 million after deducting ownership costs. Stocks, $1.8 million. Bonds, $755,000. T-bills, $589,000. Finally, as all investors were painfully reminded in 2008 to 2009, to earn the long-term average return, you would have needed enough fortitude to stay fully invested when the market plunged, tearing away your portfolio and your determination to stay the course. Spending is the next key factor. Again, time makes all the difference. Consider the consequences of 2 commonly used spending rules. One rule is to limit spending in retirement to a moderate rate, such as 5% of your capital. If you followed this spending rule, and your investments were entirely in bonds, your $1 million would have fallen in real purchasing power to just $200,000. The all-stock portfolio alternative was better, of course, up by about 30% or less than 1% per year. Another spending rule is to limit spending to dividends and interest payments received. The investor following this rule starts out having significantly less to spend than does Mr. 5%. But because dividends rise with corporate earnings, he soon catches up and goes ahead in spending more. Compounding is at work again. Beware of a subtle danger. As an investor, you can almost always produce more income from your portfolio by investing more heavily in bonds, or so-called income stocks with high dividend yields. But other investors are rational, and they'll let you get more today, only if they can expect more tomorrow. Thus, what appears to be high current income can be partly a return of capital. For example, high-yield bonds may appear to pay 8 to 10% interest, but part of that payment is actually a return of the capital that's needed to offset the risk of occasional defaults. And every so often, one of those high-yield bonds does default. What to do? In retirement, be conservative. Better safe than sorry. Ideally, limit annual withdrawals to 4% of a 3-year moving average of your portfolio. This will protect your portfolio from inflation and from overspending. If you need to draw 5% each year, you'll want more portfolio stability. Put a rolling 5 years expenditure in medium-term bonds and the rest in equities the year you retire. Each year, convert 1 more year's spending from equities to bonds unless the stock market is high and all the chatter is about good prospects, in which case you may be wise to convert to 2 years. Yes, this is a form of market timing, but it's seldom a bad idea to lean against the wind. If you need to draw 6% of your retirement funds to live comfortably, you need to know you will be depleting your capital over time after adjusting for inflation, and eventually, you will run out of money. If 6% won't meet your spending level, you owe it to yourself to cut back your spending to a level you can sustain. Nobody wants to outlive his or her resources. Money links the past with the present and the present with the future as a medium of stored value. You can estimate the dollars you'll want to spend each year, and at a spending rate such as 4 or 5%, the total wealth required to produce the income to meet that level of spending. First, determine what you have now and what you will save each year. Then see whether you can achieve your capital accumulation objectives through a sensible investing program. If the first plan you designed doesn't work, you need to go around again, planning to save more each year or work and save for more years or have less to live on. Be careful. Being optimistic will not help you get the right answers. Be cautious and conservative with each assumption, your saving rate, your rate of return, and your spending. For investors who depend on their annual income from investments, the good news is that while interest paid on T-bills will fluctuate from year to year, and sometimes substantially, dividends on a wildly diversified fund portfolio of common stocks have almost never gone down and will generally rise each year a little more than the rate of inflation. By combining your saving and capital objectives with your realistic rate of return expectations and your available time horizon, you can work out your own investor's triangulation to see what amount of savings you will need to contribute each year to your long-term investment portfolio so you can achieve your realistic objectives for spendable money during retirement. Your accountant or investment advisor can help you with the calculations. If you're surprised at how much you'll need to save and invest each year to meet your retirement spending goals, it may be modestly comforting to know that you are not alone. Retirement is expensive, partly because we are likely to live longer than our parents or grandparents, and incur more medical expenses in our later years because we have access to more advanced health care. Investors may ponder the double-edged irony of death. If death comes sooner than expected and planned for, the resources saved over many years may go at least partially unused by the saver. If death comes much later than planned for, the saved-up resources may be too small, and a grim poverty can result. Be prudent, but don't be prudent to excess. You can save too much, and those who love you do not want you to suffer a life of self-enforced penury just so they can have extra money to spend after you're gone. Your best bargain as a long-term investor is sound investment counseling that leads to the sensible long-term investing program most appropriate to your particular financial resources and responsibilities, and to your particular risk tolerance, investment skills, and philanthropic aspirations. Ironically, most investors are unwilling to pay for real help from registered investment advisors in developing an optimal long-term investment program. This grievous sin of omission incurs great opportunity costs, the cost of missing out on what might easily have been. Most investors could obtain very good one-time investment counseling for a per diem fee of less than $5,000, paid only once each decade, perhaps when you have your estate plan refreshed. Most investors will regularly pay more than $10,000 per $1 million every year in investment operating expenses, such as brokerage commissions, advisory fees, and custody charges. It's ironic that investors will, however innocently, pay more for the lower value-adding services. Suggestion: pick one day a year, for example, your birthday, New Year's Day, or Thanksgiving, as your day away for investing, and pledge to spend a few hours on that day every year quietly and systematically answering the following questions in writing. After the first annual review, which may take several hours, you'll be updating the plan you wrote out in the prior year, so it won't take much more than an hour. You can make that hour even more productive by rereading last year's plan a week or so before your day away, so it will be in your subconscious where so much good thinking and rethinking gets done. These questions will help define and articulate your objectives. During retirement, how much income do I want to have each year in addition to Social Security and my employer's retirement benefit? How many years will I be in retirement? The key here is to estimate how long you'll live. Ask your doctor how to apply the average lifespan of your parents or grandparents to get a reasonable fix on your own genetic envelope, appropriately adjusted for contemporary medicines and the healthfulness of your personal lifestyle. What spending rule am I ready to live with and live by? How much capital will I need to provide amply for each year of my retirement? What savings and insurance will I need, inflation adjusted, to cover full health care for my spouse and me? How much capital do I want to pass on to each member of my family and to special friends? How much capital do I hope to direct to my philanthropic priorities? Next comes an easy-to-use solution to what most investors consider the truly difficult part of the problem: estimating long-term average annual rates of return on your investments. Here's one way. First, recognize that over the long term, after adjusting for inflation, average returns for each type of investment have in the past been approximately as follows. Stocks, 6.5%. Bonds, 2.5%. T-bills, 1.25%. Second, remember and act on the understanding that over the truly long term, the most important investment decisions seem almost obvious. Here are the two most important decision rules. Any funds that will stay invested for 10 years or longer should probably be in stocks. Any long-term investments in bonds are made as protection, not from the markets, but from your probable reaction to the markets when they are most upsetting. Any funds that will be invested for less than 2 to 3 years should be in money market instruments. Next, prepare a complete inventory of your total investments, including stocks and bonds, equity in your home, and assets in any retirement plans. If still working, also estimate your future savings. Next, review your retirement income. You can get help from your employer's human resources department or from your accountant. Here are the obvious sources: pension benefits, Social Security, and income from your investments. Last, review your desired bequests to family members and others, and your intended charitable contributions. In investing over the longer run, benign neglect pays off. After basic decisions on long-term investment policy have been made, with care and rigor, hold on to them. Nervous money never wins, say poker players, and they should know. At the Kinderheim Nursery in Vail, Colorado, I saw a sign offering skiers a fine service at a great price. Leave your kids for the day, $10. Then, mindful of the nursery's experience with overanxious parents, two alternatives are offered. You watch, $15, and you help, $25. One final thought. Before making any final, irreversible commitments that are large in proportion to your total wealth, reread King Lear. Chapter 25. Disaster again and again. In March of 2020, investors all over the world saw their equity investments suddenly drop by a painful 30%. Workers were laid off, particularly in service industries. Globally, a new virus, COVID-19, brought death and illness to millions. Lack of preparation made it worse. Inadequate steps by ill-informed governments made it even worse. Their economies went down, and unemployment shot up. And so did uncertainties. On December 11, 2008, 8,000 investors, formerly happy to be receiving reports of their year-in, year-out returns of 10% or better on a secretive, inside-the-market operation they had been privately let in on by well-connected friends, found they had actually been victims of a giant Ponzi scheme run by Bernard L. Madoff. $50 billion was Madoff's initial estimate of how much money he had vaporized. For Madoff's victims, it was a personal disaster. Madoff told clients he specialized in split-strike conversion strategies, using derivatives to minimize risk. Strategies he made clear were so proprietary that he would not discuss them in any detail for fear others would copy his technique and ruin everything for everyone. He claimed to buy stocks and sell put and call options on them. Selling the calls meant not participating in a price increase beyond a set amount, while the puts protected against a price decrease by a set amount. To protect his secret process, Madoff, who had been chairman of NASDAQ and a frequent expert advisor to the Securities and Exchange Commission and had served on several philanthropic boards, kept a tight inner circle. Audits were conducted by a tiny 3-person accounting firm, and all trading was executed through his own captive dealership. Like Charles Ponzi in the 1920s, Madoff had been paying out money to withdrawing investors not from accumulating profits, but from new cash coming in from new investors. Those content to receive 10% or so every year, at which rate the money doubles in just over 7 years, doubles again in the next 7, and then doubles again, got comforting monthly reports on how steadily their fortunes were compounding. Most preferred to leave their money with Madoff, presumably steadily multiplying. Consistency was remarkable. Only 11 monthly losses from 1992 to 2008. The lesson for all? If it seems too good to be true, and this time it's different, it is too good to be true. So don't bite. Sure, Bernie was charming, modest, and bright. Sure, it was a family firm. Sure, you got introduced through a friend of a friend. Sure, you felt certain you could trust him. Everybody seemed to. 10% was very good, good enough to attract investors, but not beyond plausibility. The SEC had been tipped several times, but had not found any wrongdoing. Bernie had friends in a variety of charities and in other high places. On October 6, 2008, Iceland, geographically remote and historically detached from the rest of the world, with a hardy population of just 320,000, suddenly became the epicenter of financial violence. Icelanders, traditionally savers and famously stubborn while enduring serial hardships, had a national pension system sufficient to ensure security for all their elderly. All that suddenly changed when Prime Minister Geir Haarde went on TV to make 2 astonishing announcements. The nation was virtually bankrupt, and the government was taking over all of the nation's banks. In the years before Haarde's painful broadcast, Iceland's bold, self-congratulating young businessmen, who called themselves Viking Raiders, had borrowed heavily to acquire the banks. But suddenly, all lending had stopped cold, and currency exchange was not possible. The nation was bankrupt, and the 3 banks were bankrupt, as were many Icelandic families and businesses. Iceland's krona was frozen in the world's capital markets. Easy access to loans and 100% mortgages, payable in foreign currencies and ominously indexed to inflation that had shot up locally to 20% annually, had allowed young people to buy homes, cars, and furniture with debt. Retirement funds that had been sufficient to ensure security for all Icelanders were suddenly cut in half, and then cut even more. In the 7 years after the national banks had been privatized, Iceland's financial institutions had borrowed $75 billion abroad, many times the national gross domestic product, and $250,000 for every person in Iceland. Some blamed the Viking Raiders, some blamed lax regulators. Never before had any nation or any country's population been trapped so cataclysmically in the stark realities of being deeply mired in debt to strangers. That's why the head of government went on television to address the nation. Fellow countrymen, if there was ever a time when the Icelandic nation needed to stand together and show fortitude in the face of adversity, then this is the moment. I urge you all to guard that which is most important in the life of every one of us, to protect those values which will survive the storm now beginning. I urge families to talk together and not allow anxiety to get the upper hand, even though the outlook is grim for many. We need to explain to our children that the world is not on the edge of a precipice, and we all need to find an inner courage to look to the future. Thus, with Icelandic optimism, fortitude, and solidarity as weapons, we will ride out the storm. God bless Iceland. All across Iceland, silence followed as the grim reality sank in. There was no sympathy for Iceland or its banks when 500,000 British and continental savers, individuals, charities, and local authorities realized that they had just lost $15 billion, or an average of $30,000 per Icelander. Restoring those losses would take longer than most investors' lifetimes. The Madoff and Iceland experiences are both different in one profound way from the horrendous global market meltdown of 2008 or the sharp drop in 2020. Many of the Madoff investors lost money permanently, as did many in Iceland. Markets, on the other hand, do recover. So the great risk to individual investors, as it has been so often before, and will be again and again, is not that the market can and will plummet, but that investors will get frightened into liquidating their investments at or near the bottom and will miss all the recovery, thus turning the temporary market loss into a permanent capital loss. This happens to all too many investors in every terrible market. Market prices, as we all know, are driven by buying and selling. The only way to push prices up to peak levels is for the largest possible number of investors with the most money, including borrowed money, to reach their highest conviction that stocks are an imperative buy. And the only way to drive prices down to their lowest level is to have the largest possible aggregate amount of insistent, concentrated selling. That's what happened all over the world in the fall of 2008 and in the spring of 2020. In 2008, it had all started with a high level of confidence in the outlook for the economy and corporate profits and a confident view that risks were low. In stock market after stock market around the world, prices were between fully priced and high. There were few bargains. Those prices might have been okay if the underlying economies and corporate earnings had continued to advance. But in one of the sharpest ever reversals of expectations, the investors, banks, individuals, and governments, which had been financing expansion with debt, slammed into reverse. Trust disappeared, taking credit with it. The culprit at the center was the ever-increasing use of leverage, particularly in the United States. Easy credit terms, high property appraisals, low interest rates, derivatives, the rising mass of leveraged hedge funds, and the SEC's authorizing Wall Street dealers to increase their use of debt were major ingredients in the cheap credit cocktail. Republicans, determined to deregulate the economy, joined forces with Democrats interested in helping more families get mortgages and agreed to change the home loan regulations and increase credit from Fannie Mae and Freddie Mac. This led eventually to ninja loans to borrowers with no income, no jobs, and no assets, who assumed they could speculate profitably on rising house prices. Packages of inappropriate mortgage loans were securitized and sold all over the world with credit ratings that were far too favorable, based on excessively high property valuations or appraisals and credit default insurance, which proved to be disastrously poorly underwritten. When the mortgage securities' values plunged, the pain spread everywhere. Economic, market, and psychological dominoes pushed one another over. Credit ratings were found faulty, and security values were cut. Confidence disappeared. Credit markets froze. Leverage was pulled away from hedge funds, and dealers were forced to sell. Investor withdrawals from these funds compounded the selling pressure. Massive, urgent selling swept the markets as hedge funds and others dumped stocks to raise cash to meet lenders' insistent demands and anticipations of a further drop in share prices. Credit markets stayed frozen. Prominent financial institutions failed. Government rescues collided with politics. Forced selling and anticipation of more hard selling yet to come dominated markets that were already dropping because of fears of recession. In 14 months, the U.S. stock market lost half its value, more than $7 trillion. Credit rating agencies were severely criticized for failing to understand the true credit worthiness of the packaged subprime loans that they had been rating AAA. Major corporations like GE cannot even refinance short-term commercial paper, and Lehman Brothers failed. Wachovia and Washington Mutual went into shotgun mergers. AIG, the nation's largest insurance company, was taken over by the government. Comparable difficulties beset commercial banks, central banks, and governments in one nation after another. The "now what" question every investor was asking during each crisis would bring a new clarity to the true meaning of risk. In its classic and most powerful definition, risk is a function of unacceptable permanent loss. Madoff and Iceland exemplified that kind of risk. So too did the destruction of Lehman Brothers and others. And so did individual investors who sold off their stocks in a flight to safety, making their personal market disasters permanent. For long-term investors, as always, the worst mistake was getting out of stocks, locking the barn door after the animals had run off. In the jargon of Wall Street, this was a big black swan event. Black swans are creatures that, though rare, do occur once in a while. Chapter 26. Getting okay on your 401k plan. As more observers are recognizing with increasing alarm, a major problem, widespread retirement insecurity, is coming our nation's way unless we take corrective action soon. While most people in the economic top 1/3 of affluence will be okay, the problem seriously threatens the lower 2/3, and particularly the bottom third. They risk experiencing a seriously negative trifecta, being old, poor, and on their own. This could take us back to the early 1950s in social injustice, a problem we worked hard to put far behind us. This could easily lead to social and political problems of a severe kind with painful consequences. It does not need to happen. We can prevent this painful problem if we act sensibly and soon. The main 401k problem is not with plan design or the intentions of plan sponsors. The main problem is with implementation. In most cases, all the important decisions are made not by experts at the company, but by each employee. But most of us are not trained, prepared for, or skilled at making those key decisions. So as the evidence now shows, we make all too human mistakes, and we make them at every stage. Individual 401k participants make mistakes at as many as 8 different stages. 1. Not participating in their company's plan. 2. Not matching the match. 3. Not increasing contributions, ideally to 12% or more of compensation, as their pay increases. 4. Borrowing or taking money out of their 401ks to cover expenses between jobs. 5. Changing investments, buying high and selling low as markets gyrate. 6. Retiring too soon, because we can. 7. Withdrawing too much each year in retirement. And 8. Not anticipating those ballooning late-in-life costs for healthcare and assisted living. The result? If we leave things as they are, millions of workers will have far too little for a comfortable retirement. They will be living too long and running out of savings. Contrary to the American dream, many will find themselves on their own, too old to return to work, with too little money and with late-in-life costs for healthcare and assisted living looming ahead. Our angry seniors will be demanding, "You could see the problem coming. Why didn't you tell me?" Using lessons from behavioral economics, leading companies have found and adopted an effective set of best practices. Instead of leaving employees on their own to analyze complex questions and make each important decision, including whether to opt in, these companies guide their employees to best practices. Each employee either accepts each of the best practices or decides to opt out and make his or her own decisions. Experience shows that this simple switch from opt-in to opt-out greatly increases the number of employees who participate and save enough and invest sensibly. If we made the proven best practices standard, many millions more American workers would be on their way to enjoying retirement security. Table 26.1, based on the experiences of companies that have made the change, shows the splendid impact on participation by simply shifting the worker's decision from opt-in to opt-out. The second major problem is that many workers assume 65 or even younger is the right age for retirement. A brief look at history and a look into the future will show why this assumption is way out of date and dangerous. Age 65 started being used for retirement in Bismarck's Germany in the 1880s, when everyone rode horses and when the average life expectancy at birth was only 45. And those still alive at 65 were expected to live, on average, only 18 more months. Given the historical precedent in Germany and the United Kingdom, Retirement at 65 was included when the United States established Social Security in 1935, when life expectancy at 65 was 6 years. Today, life expectancy at 65 is 20 years for men and 22 years for women. 25% of couples will see one or both of them live into their 90s. The shift from defined benefit plans, arguably the best consumer financial service ever developed, to 401k plans cannot be stopped. Today, far fewer people work for just one company for their full career, so they want portability. And plan sponsors are understandably concerned about costs. But while accepting reality is important, that does not mean accepting all the current imperfections in 401k plans when we know how to make them work so much better. Saving is particularly hard for those who fall below the median income. Deciding how much to save is challenging for almost everyone, and investing wisely for the long-term distant future is very hard for all of us. Yet today, many 401k plans, as presently implemented, leave all the saving and investing decisions up to each individual plan participant. Given what we know about the mistakes many individuals make with their investments, we should anticipate trouble, and the trouble is snowballing and bearing down on us. Most companies want to do the right thing in their retirement programs because they care about their workers' welfare and know that a strong retirement plan attracts good workers and fosters good morale. When setting policies for 401k plans and balancing the interests of employees, retirees, and owners, each company has its own priorities. This has resulted in a great variety of practices by different companies, all for good reasons. Still, experience reveals a series of opportunities for many companies to improve their 401k plans by adopting the best practices of leading corporations. Let's begin with an emphatic, non-political declaration. None of the following recommendations, all based on proven best practices of leading corporations sponsoring 401k plans, need to be mandatory for individual participants. But they should be required in each plan, with an opt-out provision for individual participants to protect each individual's freedom of choice. 20 years of retirement is expensive and far too expensive for many individuals to pay for with benefits from Social Security and inadequate funds in their 401ks. The median 401k balance for a 65-year-old American is currently only $120,000. With a 4% drawdown and market returns reduced by 2% to offset inflation, that provides only $4,800 a year. Adding Social Security benefits and 401k draws, the average combined payout would be a serious drop from the median earned income for active workers earning at 65 about $63,000. The benefits of working to age 70 or longer are substantial. Start with Social Security. Close examination of Social Security benefits reveals an important reality. Due to past changes, the financially optimal age for retirement has already shifted from 65 to 70. While the Social Security Administration still calls 65 full retirement age, and workers can, if they want, claim benefits even earlier at 62, the financial rewards of working until 70 are eye-popping, as cited briefly in Chapter 24. Social Security benefits begun at 70 are a stunning 76% higher than benefits claimed at 62. As always, these higher benefits are inflation-protected and continue as long as you live. In addition to the 76% increase in Social Security benefits, working to age 70 instead of 62 gives employees 8 years during which they can make new contributions to a 401k and saves them 8 years of payouts not taken. Together, these two changes can double the size of an employee's 401k balance before including any investment return. Adding in investment returns, that 401k balance can more than double, and depending on investment returns, possibly triple over those 8 years, to an average of about $360,000. This would provide the average retiree with an additional $12,000 to $15,000 every year. The combination of 76% higher Social Security benefits and a doubling or even tripling of 401k payouts would assure many retirees of a financially comfortable retirement. Given an awareness of these financial realities, who would not want to add 1/5 to their working and saving years to enjoy up to 3 times as much annual income in every year of retirement? Though estimates differ on how many millions of American workers will have inadequate savings for financially secure retirements, because the experts differ on whether an income replacement of 60, 70, or 80% of pre-retirement income is enough for comfort, all experts agree that unless we make changes soon, Millions of American workers will have too little for the comfortable retirements they are now expecting. The realities of practice are falling way short of the theory and the early promises of the 401k plans that increasingly dominate corporate retirement programs. America can change the course of retirement history by being sure that each worker understands the major benefits of working longer and that employers with 401k plans, to get the tax advantages on which our nation now spends over $160 billion every year, commit to using the proven best practices of automatic enrollment, automatic match the match, automatic increases in savings, such as 1/4 of each pay raise going into savings, and investing in age-appropriate balanced investments using low-cost index funds. The net result of making these changes would shift millions of retirees from having too little to having enough for a decent, financially secure retirement. To see why everyone who can participate in such plans should do so, and to the maximum extent allowed, just look at Figure 26.1. Note the huge impact of starting early and compounding. Here's a series of recommendations. Please give each one your serious consideration. 1. Do not confuse loyalty to your company with investment wisdom. Many 401k investors invest in their employer's stock because they know and trust the company. Don't do it. You already have a major economic dependency on that one company through your job, so adding more to that economic relationship is not smart diversification. 2. Your retirement fund should be organized for safety first, and safety means defense. If you have any doubts, read all about Polaroid and Enron, two of the numerous major U.S. companies that later lost all their market value, obliterating many employees' retirement savings, and were forced to lay off large numbers of loyal workers. Result? Retirement savings lost, jobs lost, and dreams lost. 3. Do not change investment managers. The best way not to change managers is to index. 4. Do not play the market. Making more than one important change per decade is almost certainly too much and can be costly. 5. Sign up for automatic deductions from your income before you see the money, so saving is almost easy. And arrange to increase your rate of saving each and every time you get a pay raise. 6. Get your children or grandchildren started early. One great concern is that many young 401k investors keep surprisingly large proportions of their initial portfolios in money market or stable value funds, even though they may be decades away from retirement. They are saving, but they are not investing, as they really must to assure themselves of adequate retirement security. 7. If your employer offers a life cycle or target date fund with the mix of stock and bond index funds managed in proportions that change sensibly as you move toward retirement, give this hassle-free option consideration. But to the extent you are not average, get yourself a registered investment advisor to help you design the plan that's right for you. 8. Be sure you invest enough each year to take full advantage of your employer's matching contribution. Most companies have and want their workers to use a matching contribution so you can double your own money immediately. That's a great way to start. 9. Be aware of the fees that funds charge. Fees matter a lot, and fees can differ a lot. BlackRock, Northern Trust, State Street, and Vanguard charge less than 0.1% for their index funds. Another index manager charges 10 times as much, a 50% higher 0.15% plus a 0.35% 12B-1 marketing fee plus other expenses that can total over 1%. And other providers, usually insurance companies serving small plans, charge even more. Over time, the impact of these small differences in fees, 1% versus 2% versus 3%, can compound into large differences, as shown in Figure 26.2. 10. Depending on your age, consider a Roth IRA. Roth IRAs make sense for young people. Most mutual fund companies provide plain language guides for deciding whether a Roth is right for you. Some plan sponsors worry philosophically about paternalism. Some worry about possible future class action suits because of regulatory uncertainty. And some worry about too much government regulation. All these concerns would evaporate if Congress provided a safe harbor for any company that adopts the already established norms of best practices. Chapter 27. Your Endgame. Investors can, and certainly should, substantially increase their lifetime financial and emotional success by paying appropriate attention to what all chess players know is important: the endgame. If you are fortunate, as many Americans are, to have earned or inherited more than you need to live out your own definition of the good life, you'll have the opportunity and the responsibility to decide where and how to direct the funds not spent. Most affluent people focus on two quite different kinds of beneficiaries, which can both be deeply meaningful: people, usually family members, and values, usually such philanthropic organizations as colleges, schools, hospitals, and religious organizations. Deciding what will be done with your capital to maximize its real value can be just as important as deciding how to save, accumulate, and invest. Providing for your retirement is one of three important challenges and opportunities. Bequests and gifts to those you love are another. The third, giving back to our society, can be exciting and personally fulfilling. Because money is such an effective way to store or transfer value, an investor with a surplus beyond his or her own lifetime's wants and needs will have the opportunity to make a difference to others. Wealth is power, both the power to do good and the power to do harm. Blessed are the investors whose assets do good. Cursed are those who, despite their best intentions, cause harm. Greater wealth means greater power. Investors who have enjoyed substantial financial success should give careful consideration, no matter what their hopes or intentions, to whether the amount of wealth they can transfer to their children might do real harm by distorting their offspring's values and priorities, or by taking away their descendants' joy in making their own way in life. While Mae West was speaking for herself when she announced that too much of a good thing can be wonderful, a giant inheritance is usually not wonderful for your children. All too often, poor little rich kids are miserable. Successful families make thoughtful choices concerning their wealth and think about the effect of their decisions on the lives of their children and their spouses and their grandchildren, said Harvard's long-serving philanthropic advisor Charles W. Collier. Most importantly, they talk openly with their children at age-appropriate times about all the issues surrounding the family's true wealth and give their younger family members as much responsibility as they can manage as soon as possible. As Collier explained in his wise guidebook, Wealth and Families, according to Aristotle and his latter-day student, Thomas Jefferson, the pursuit of happiness has to do with an internal journey of learning to know ourselves and an external journey of service of others. Before outlining some of the possibilities for transfers within the circle of those you love or feel responsibility for, let's remember that money has powerful symbolic meaning. Psychiatrists marvel that although patients talk rather extensively and relatively early in therapy about relationships with parents, childhood experiences, central hopes and fears, and even very private matters such as dreams and sexual experiences, the one subject almost never discussed is money. Money is often the thermonuclear device among symbols, and it symbolizes a lot, in different, and often quite unexpected, ways for different people. Most people find it very difficult to discuss money matters openly, fully, rationally, and wisely. Therefore, it's best to be especially thoughtful and cautious when making plans about how your money will pass on to others. Yes, it's your money now, and while you live, but neither of these cheerful current realities will last forever. You'll want to get expert legal advice when formulating a sound estate plan, but here are some items for consideration, recognizing that individual people will have their own objectives and resources and will want to make their own decisions. 1. You can give up to $15,000 without any tax to each person you wish every year. Married couples can give $30,000 annually to each person. For most investors, over time, these annual gifts can be the central, even dominant part of a lifelong estate planning and family investment management program. Gifts to young children can be made in care of a parent as custodian under the Uniform Transfers to Minors Act. A main advantage of these gifts is completely sidestepping the estate tax when you die. You might concentrate on your children. Such gifts can really mount up, partly because the future investment income earned on the sums given is taxed at the child's tax rate, which is almost certain to be lower than yours. Over 20 years, $15,000 given annually can, with sensible investing, accumulate to the better part of $500,000. $30,000 a year from both parents could produce $1 million or more. Again, the keys to success are time and compounding, so plan well. Start early and stay with your plan. 2. As of 2021, $11.7 million is exempt from federal tax for an individual. So those with substantial wealth may wish to give sizable gifts to take advantage of this raised limit, which is set to expire in 2025. 3. A curious provision called a Qualified Personal Residence Trust enables you to transfer ownership of your house to your children and live in your home rent-free for a set period of time, such as 15 years. You save substantially on estate taxes unless you die before the trust matures. While ownership passes to your children, a home can be transferred as a taxable gift. The IRS considers the taxable present value of the gift to be just the value of the children's right to take possession at the end of, say, the 15-year term of the trust. 4. If you wish to transfer a substantial sum to your descendants, but worry about distorting their values if they inherit the money at an early age, you can create a trust that specifies the circumstances under which they can receive distributions. 5. If you want to postpone giving to your descendants and want to make a major charitable contribution, consider an arrangement used by Jackie Onassis. Here's the general idea. A trust can be established for 20 to 30 years with interim annual distributions of income payable to your favorite school or charity, either at a set dollar amount or as a percentage of the trust's assets. With the trust corpus, the body of the money, corpus being the Latin word for body, paid after the 20 to 30-year term you selected to your chosen beneficiaries, such as your children. There's no estate tax, and a gift tax is paid only on the estimated net present value of the trust's corpus after discounting at the IRS's prescribed interest rate to an amount that is only a fraction of the probable market value of the corpus 20 to 30 years from now. This sort of trust can be an effective way to transfer substantial wealth with minimal tax. Noting that the key figures are all based on estimates of market valuations far out in the future, the wise investor will want to work out the specific term of the trust and the investment policy under several different scenarios and select the choice with which he or she feels most comfortable. With this vehicle, you have dual benefits of helping a charity you support as well as your descendants. 6. It takes more capital to deliver $1 million after taxes as a bequest than as a gift. Gift taxes are assessed on the gift without regard to other taxes paid, while estate taxes are based on the whole estate before taxes are deducted. 7. It is good sense to find an estate lawyer who will be your advisor for the long haul. As the estate lawyer for our family, Lee Newman of Day Pitney LLP, reminds us, estate laws and regulations are continually changing. Investors who have conscientiously worked to maximize the amount of their savings and investments will also want to pay comparable attention to minimizing the diversion of funds caused by taxes, particularly estate taxes. This effort will help you achieve your fiscal objectives in support of your main values. Inverted, or upside-down, reasoning can be a usefully mind-freeing way to explore any complex issue. Investors can think of an estate tax not as a tax on wealth, but as a tax on caution. Your reluctance to make irrevocable decisions while living, particularly long before your death, about the distribution of your wealth. If you are willing and able to make irrevocable decisions now regarding the long-term future disposition of your capital, you can save substantially on taxes. And as always, a penny saved is a penny earned. Many investors are not willing to make these wealth distribution decisions, yet. But please remember, only if you are willing to make decisions about the future now can the power of compound interest be used for the maximum period to have the maximum impact on achieving your carefully considered goals and objectives. Maximizing your lifetime financial success has 5 stages: earning, saving, investing, contributing, estate planning. Ideally, you will maximize achievement in each area, according to your own core values, within the feasible set of opportunities available to you as you enjoy a full and balanced life. As with other areas of investing, it's wise to plan ahead, to be conservative, and to make productive use of time by beginning early and sustaining your commitments over as long a period as you can. Education is usually your best investment, whether you invest in your own or in that of your children or grandchildren, or in the education of a great kid whose family can't afford the education of his or her choice. Education increases earning power over many years and leads to richer, more enjoyably interesting lives with more freedom of choice. The other best investment is staying in good health through exercising, controlling one's weight, not smoking, and the like. You really can live longer and better, and at a lower total cost. In thinking about bequests to children and grandchildren, wise people focus on deciding what amount would be the best, as distinct from the most. Wisdom is knowing what is enough. Two of the wealthiest people in the United States have decided to leave only moderate amounts to their children. Warren Buffett says that the right amount to leave children is enough money so they would feel they could do anything, but not so much that they could do nothing. Buffett's friend Bill Gates echoes that view. Part of the reason for believing that my wealth should be given back to society, says Gates, and not in any substantial percentage be passed on to my children, is that I don't think it would be good for them. They really need to get out and work and contribute to society. I think that's an important element of a fulfilling life. When thinking about gifts and bequests to children, parents know that each child is a unique individual and may be quite different from his or her siblings in wealth, earnings, or financial needs. This can make it tough to decide between fair and equal. The best financial plans resolve the natural tension or dynamic between each person being an individual and each being part of a family. Capital transfers can divide or enhance family relationships. What's right for taxes may or may not be right for the individuals in your family. Most families have core values, such as the importance of philanthropy or entrepreneurship, that need money for realization. Sharing and developing those values can be a vital part of the next generation's growing up years. The meaning you give to wealth says a lot about who you are and the way you'll be seen and remembered. That's why developing shared values with your family and articulating guiding principles that will inform your family's choices can be so important. Suggestion: take time to talk to your family about your values and your hopes for their future, and also prepare a letter separate from your will, sharing your values and feelings with those you love. It may be your last opportunity to be heard. If you have surplus funds beyond the amount you wish to transfer to members of your family and others you care for, don't overlook the profoundly rewarding opportunities you may have created for yourself to cause good things to happen through philanthropy. Giving money away to charity puts the whole proposition the wrong way. Instead, think in terms of imaginatively and vigorously investing your money, the stored values you and your skills have created over many years, to make good things happen for and through the people and organizations you care about. You can derive a great deal of pleasure and personal fulfillment in the process of making a positive difference in other people's lives. People inclined to think they made their fortunes by themselves are partly right. Most fortune builders did work hard, took risks, and overcame major barriers. Still, they might well ponder how well they would have done if they had been born in Central Africa or Western China or a variety of other places. Most Americans know that we owe a large fraction of our successes to our dynamic economy and its myriad market opportunities, our educational system, and the ability to let investment values compound without tax until they are sold, and then to pay only capital gains taxes. No man or woman is an island, as John Donne understood. We are all part of the main. Those with modest wealth may focus on their families and a few local charities, while those with more wealth may respond to all of humanity and their ability to invest wealth creatively in reducing painful problems or increasing opportunities. On Abraham Maslow's famous needs hierarchy, after and above self-actualization are transcendencies. These needs can be realized when we move beyond ourselves to see a greater fulfillment linked directly to serving the needs and hopes of others. Givers have learned how greatly they can enjoy seeing the wealth they have created, the stored-up consequences of their hard work, imagination, and good fortune, come to life again by reducing constraints on individuals or society and enabling good things to happen during their lives in ways that matter to them. As the old saying has it, you can't take it with you. Those who give something back invariably speak of this dimension of their lives with genuine satisfaction. And those who contribute even more find they enjoy even greater satisfaction. Select the actions or changes that would give you deep spiritual satisfaction or pleasure to see coming to fruition, and make these good things come true by committing your capital to help make them happen. Like many others, you may find you enjoy great gratification in converting your financial resources into actions and values you truly care about. Here are some opportunities to make an impact. Establish scholarships for young people with great talent who aspire to make significant contributions in the arts, science, business, or government. Contribute to scholarships for young people who've gotten a bad deal in life and need someone's help to get on the right road. Provide financial support for advancing science, medicine, or social justice. Support hospitals, shelters, and other institutions to help those in severe need or those who served in our military. Supply funding for the arts, music, dance, theater, painting, sculpture, that enrich our lives. Help make your community a better place to live in by being one of the go-to leaders who commit time and money to make good things happen. Your greatest satisfaction may come from serving as a volunteer for a major national institution, a global organization, or a small entity in your neighborhood. Experienced charitable activists agree that while contributing money is important, even greater enjoyment and satisfaction result when they also make a substantial commitment of their time, skills, and energy. Give time and treasure. Don't leave this important part of your life experience in storage for someone else to enjoy doing after you're gone. Contributing your time, talent, and money can be profoundly gratifying in two ways. For you, there is great personal satisfaction in seeing how real, living people and organizations benefit. Also, deeply satisfying personal experiences result from engaging productively with stimulating and interesting people and making new and valuable friendships. Good works do attract good people, and important good works attract the best. Chapter 28. Thoughts for the Wealthy. If you are so fortunate as to have over $25 million, you know you have achieved a great success. Congratulations. Fewer than 250,000 Americans have done this well financially. Most likely, you recognize that you have new kinds of problems. How do you find investment advisors and investment managers who are right for you? How much do you pass on to your children and grandchildren? And when do you do it? How much do you commit to philanthropy? And when? If you have a much larger fortune, over $100 million, you might consider organizing an investment committee to advise you on all aspects of investing. If paying 1% to 2% of assets to an investment advisor year after year seems high to you, as it sure does to me, an alternative is to engage an advisor once every 5 years on a fee-for-time basis to conduct a thorough evaluation of all your financial and investment plans to be sure they make sense for you. If your personal expert helps save you from just one major mistake or helps you make one wise move, you'll have found a bargain. Tip: some of the best informed and most thoughtful investment professionals work at large foundations and educational endowments or at large corporate pension funds. They might be glad to help you on weekends for a nice per diem compensation. You'll also be wise to retain one of the finest trust and estate lawyers. Tip: young lawyers can be best because they are building their practices and will still be practicing many years from now, so you and your wealth will have continuing service from the same trusted advisor. Finally, retain the best young partner at a major accounting firm as an advisor and overseer, and jointly hire a superb part-time bookkeeper you like personally to maintain all the records, report monthly, and watch the watchman by monitoring investments. Good retired bookkeepers often like to work part-time. If you have won the money game, ask yourself, is it more important for me to concentrate on offense to win even more, or is it better to concentrate on defense and lose less? If you have substantial wealth, you'll be inundated by delightful, articulate people known in the trade as asset gatherers because of their ability to win the trust of wealthy people. You may enjoy seeing how personally charming they can be, but please be cautious and check their references carefully. Alternative investments have been in the limelight, partly because some practitioners are paid astronomical amounts and make a good copy for the media, partly because some have achieved extraordinary investment results, and partly because so many investors still hope to find a way to obtain high returns with little risk. Another reason alternative investing has attracted so much attention is that it has worked well for 4 of the earliest, largest, and most skillful practitioners. Yale, Harvard, MIT, and Princeton. Full disclosure, I served as chair of Yale's investment committee for many years. Their results are extraordinary and, equally important, have been achieved systematically through a rigorously disciplined process. But the results are very hard to replicate. Don't even think of trying. When I was 8, our mother took my sister and brother and me to the Ringling Brothers and Barnum and Bailey circus. Impressed by the daring young acrobats on the flying trapeze, I resolved to try it at home, with predictable results. I got skinned knees, skinned elbows, and a skinned chin, and learned that copying experts is not easy. Old Wall Street question. What's the fastest way to make a small fortune? Answer. Start with a large fortune and try to copy the experts. So here are some friendly warnings about recently popular but unconventional ways to invest. Hedge funds. Hedge funds burst on the scene partly because they performed well in the millennium market collapse of dot-com stocks, but primarily because they offer their managers an amazingly powerful way to get rich. The 2% fee easily covers all costs of running the fund, plus the manager gets 20% of all profits. Learning that smart friends are making $10 million in a single year, and several hedge fund managers made over $1 billion in 1 year, is hard to ignore if you are gifted, young, competitive, and keen to make a fortune yourself and want to work in a small shop with several other brilliant people trying to figure things out. It's creative, it's fascinating, and when it clicks, you make serious money. Who wouldn't be interested? Hedge funds come in an almost infinite variety of strategies. They are run by brilliant, intensely striving, supremely confident, fashionably dressed managers with distinguished academic and employment records. However, most hedge funds have a major problem. Other hedge funds. Thousands of them. As soon as one hedge fund develops an edge, a new winning way of investing, other hedge funds try to figure it out so they can use it too. Pretty soon, the edge gets arbitraged down to normal returns and a new edge is needed. Creating edges is hard. Creating a series of edges is very hard. That's one of the reasons over 10% of hedge funds disappear each year. Meanwhile, the performance records of most hedge funds have been disappointing, largely due to crowding. The fundamental challenge for hedge funds, and therefore for those investing in hedge funds, is in the numbers. If the rate of return for stocks is 7%, the break-even return for a hedge fund has to be 11.25% to cover all the fees. This requires an alpha, the extra return from superior management, of 4.25%, which is over 60% more than the expected market return of 7%, a very large superiority. Some hedge funds will get that high return, and some will get more. But that's not the real question. The real question is whether the fund you invest in will do that well year after year, particularly as more money goes into hedge funds that compete with one another in the search to capture alpha. Venture capital. Venture capital attracts attention. Over the long term, the surging flow of investment capital into venture capital funds has been astonishing. No doubt there is romance about discovering explosively successful companies like Apple, eBay, Facebook, Google, or Uber, and making more than 100 times your investment. But before investing in venture capital, consider the following. Over the past 30 years, while the median return of the top quartile of venture capital funds was 28%, the median return of all venture capital funds was actually less than 5%. A dozen of the most successful venture capital organizations made combined profits higher than the total excess returns over and above those of the S&P 500 index, of the entire venture capital industry. In other words, relative to the overall market, all the other funds collectively lost money, gave up liquidity, and took serious risk. The leading venture capital firms are continually the leaders, for strong reasons, and the odds are high that they will continue to be the most successful. The secret to success in venture capital is no secret. It's not the money. Money to invest is necessary, but not nearly sufficient. The best venture capital managers are not simply shrewd backers of exciting new products. They're good at this, of course, but their great strengths are too. They know how to select entrepreneurs and they know how to help bring effective teams of talented people together to build unusually successful companies. They are certainly not passive investors. They are vigorously active and creative. Savvy, budding entrepreneurs learn from already successful entrepreneurs how important the best venture investors can be in helping their new companies succeed. So the best entrepreneurs with the best ideas all want to work with the best venture developing investors. The best venture investors are always in touch with the large, medium, and small companies in the industries they plan to invest in. They make sure that the most exciting young stars who might decide to launch new companies know how important their assistance can be, and how often they have made crucial differences to the fledgling companies they've previously invested in. Specializing in specific aspects of technology, they know all the most effective engineers, salespeople, production managers, and financial experts. They know why these people are so effective, and they appreciate how particular people can fit together as successful teams. They use this expertise to help their companies get smarter and stronger and become much more likely to succeed. And they know that effective entrepreneurs almost always change their products, business plans, and target markets as they learn what works and what doesn't work. They don't fixate on products or markets or business plans, no matter how exciting, because they know the key to success is always the entrepreneur who has a compelling need to succeed and is a skillful risk manager, not a risk taker. It's no accident that the winners keep winning. There's only one problem. You and I cannot use this insight. Like the best hedge funds, the best venture capital organizations are closed to new investors. In fact, they are already overbooked and unable to accommodate all the money that even their long-standing investor clients want to give them. In addition, some of their successful entrepreneurs now have large amounts they too would like to invest. And the venture managers, having made large fortunes in successful past investments, want to invest more of their own money. Long story short, you can't get into the funds you'd want to invest in. The other venture funds remind wise investors of Groucho Marx's sardonic remark, "I don't care to belong to any club that would accept people like me as a member." Real estate. Real estate has many appeals. A remarkable proportion of the nation's wealthiest individuals and families made their fortunes in real estate. Tax advantages are a major factor. The astute use of leverage and access to credit, lots of it, are important. Exceptional skill at adversarial negotiations is crucial, and patience and decisive action are both essential. In addition, success depends on extraordinary, intimate knowledge of all the relevant details of each local market and, within a chosen market, of each property, its tenants, and their lease agreements. Clever insights into ways specific improvements will significantly enhance future rentals, and a special ability to attract desirable tenants. An absolute devotion to the business is mandatory. Few people would be willing and able to meet all these requirements, and hardly anybody can hope to succeed on a part-time basis. That's why those who do devote themselves to real estate investing can, if fortune smiles on them, do so very well. If you want to invest in real estate without a big-time commitment, you can invest in the common stocks of real estate investment trusts, which are listed on the principal exchanges. They trade at prices reflecting both real estate and the overall stock market, with long-term returns similar to overall stock returns. Private equity. As with other specialized alternative investments, the best private equity funds are closed to new investors. That's okay for individual investors, because private equity funds, overall and on average, have underperformed the market averages after the benefit of their substantial leverage was factored in. In other words, investors would be better off and have more liquidity by buying publicly traded stocks with moderate margin debt. Commodities. Commodities are economically inert, and so do not develop increasing economic value. Changes in their prices are driven only by changes in demand or supply. Those who buy and sell commodities are not investing. They are speculating that they know more or better than the market. They may be right with their bets and trades, but for every right, there must always be an equal wrong. The total of all trading adds up to a negative, a zero-sum game, minus the cost of trading. Gold has attracted attention in recent years, particularly since the creation of gold ETFs. Gold has changed in price, and bulls predict a higher price. But investors will want to remember that the inflation-adjusted price of gold in early 1980 was over $2,250 an ounce and is now trading at about $1,870 an ounce. Chapter 29. Good to go. As you now know, you, not your investment managers, have the most important job in successful investment management. Your central responsibilities are to decide on your long-term investment objectives and determine a reasoned and realistic set of investment policies that can achieve your objectives, with or without the help of a professional investment advisor. You should study your total investment situation, your emotional tolerance for risk, the history of investment markets, and how they would interplay, because a mismatch between the market's sometimes grim realities and your financial and emotional needs can result in great harm. Investors who study past realities of investing will be able to protect themselves and their investments from the all-too-common and unrealistic belief that they can find active managers who will substantially beat the market by beating the expert competition. If the question were, can we find a team of brilliant, well-informed, hard-working, and experienced managers who would do their very best, the answer would be a resounding yes. But that would be the wrong question. The right question would be, can we find an investment manager who is even better than the other experts by enough to outperform the consensus of experts by enough to cover fees and costs and offset the risks and uncertainties? The well-informed investor understands that the only way an active investment manager can beat the market is to find and exploit other investors' mistakes more often than they find and exploit his or her mistakes. This investor understands that a manager who strives to beat the market is all too likely to try too hard and get beaten instead. Most of the clients who insist on trying, either on their own or with professional managers, will be disappointed by the results. Active investing is a loser's game. Happily, there is an easy way to win the loser's game, and that's simply by not playing by the historical conventions, which, given the many major changes, are now seriously out of date. Raised in the tradition that says, if you find a problem, find a solution, I felt intrigued by the task of finding a solution to the problem identified nearly 50 years ago in my article, The Loser's Game. As is so often true, the solution was to think outside the box and redefine the problem. Thus, the focus shifted from the loser's game, working ever harder in a futile effort to beat the experts' market, to the winner's game of concentrating on the big picture of your longer-term objectives, asset mix, and investment policies, and staying the course. Individual investors are important for three major reasons. First, there are so many, nearly 50 million in the United States, and an equal number in other nations. Second, most individual investors are truly on their own in designing long-term investment policies and strategies, even though investment advisors can provide the counseling most individuals need for a reasonable hourly fee. Third, most how-to books on investing are sold on the false promise that the typical individual can beat the market consensus of professional investors. He can't, and she won't. Fortunately, the individual investor does not have to beat the market to be successful. Attempting to beat the market will distract you from the important, interesting, and highly productive task of designing a realistic, long-term investing program that will succeed at providing the results best for you. Soundly conceived, persistently followed, long-term investment policies are the pathway to success in investing. The actions required are not complicated. If you feel, as I do, that some of the advice in this book is pretty simple, remember Warren Buffett's wonderful summary. Investing is simple, but it's not easy. The real challenge is to commit to the discipline of long-term investing and avoid reacting to Mr. Market's compelling short-term distractions, which are superfluous to the real work of investing. A persistent commitment to the discipline of long-term investing is your principal responsibility and your best opportunity to assure your own long-term investing success. There are two different kinds of problems in trying to beat the market. One problem is that beating the market is extraordinarily difficult to do, and it's all too easy, while trying to do better, to do worse, even much worse. The other problem is that it will divert your attention from establishing long-range objectives and investment policies that are well matched to your particular needs. Winning the loser's game of beating the market is easy. Do not play it. Concentrate on the winner's game of defining and adhering faithfully to sound investment policies that are right for the market realities and right for your long-term goals and objectives, and that you can sustain. Assuring top quartile investment performance is easy, too. Index, and you're sure to have it, particularly over the long term. Actually, over the past 20 years, index funds have achieved results in the top half of the top quartile, and have done so without taking extra risk. The needs and purposes of different investors are not the same, so their investment portfolios should not be the same. Your investing program will depend on how you answer these important questions. Where are you financially? How long will the money be invested? What are your assets, income, debts, and responsibilities? How do you feel about market risk? And can you trust yourself to be a persistent long-term investor? The answers to these few questions are what make each of us unique as investors. To fulfill your financial responsibilities to yourself, you need 3 characteristics. 1. A genuine interest in developing an understanding of your own true values and investment objectives. 2. A basic appreciation of the fundamental nature of capital markets and investments, including Mr. Market's clever tricks and the market dominance by expert institutional investors. 3. The personal discipline to work out and hold on to the basic policies that will, over time, succeed in fulfilling your realistic investment objectives. That's what this book is all about. While a spirited critique of contemporary active investment practice, this book is by no means a condemnation of active managers. The problem is not that professional managers lack skill or diligence. Quite the opposite. The problem with trying to beat the market is that so many professional investors are so talented and so dedicated to their work and have equal instant access to so much superb information and computing power that, as a highly competitive group, they make it very difficult for any one of their number to do better, particularly in the long run. This book is written with a clear point of view. The real purpose of investment management is not to beat the market. It is to do what is right for each particular investor who accepts the threefold central responsibility of defining his or her true and realistic investment objectives, developing sensible long-term policies, and staying with them. Much as it might seem obvious that investors should care a lot about the way their money is managed, the reality is that many do too little, until it's too late. This book is written for investors who are prepared to take charge of their own investment destiny. Registered investment advisors should encourage their clients to use this book as a guide to performing the vital role of being informed, engaged, and therefore successful clients. When you have finished digesting the straightforward propositions presented in this short book, you will know all you will ever need to know to be truly successful with investments. You are now ready to enjoy winning investing. You're good to go. Chapter 30. Parting Thoughts. Genuine doubt, said the great physicist Richard Feynman, is the necessary first step toward creativity. So I've learned to double-check my answers, particularly when the evidence seems most confirming, and to ask, could I be wrong? On the main parts of my argument, I've checked with experts over many years and am confident that certain basic structural realities are not going to change. The number of brilliant, hard-working investment professionals is not going to decrease enough to convert active investing back into the winner's game of the 1960s and 1970s. The proportion of transactions made by institutions and the splendid professionals who lead them will not decline. Investing, therefore, will stay dangerous for even the most gifted amateur. Maybe someday, so many investors will have agreed to index that the last stock pickers standing will have the field all to themselves. That'll be the day. Meanwhile, I've got better things to do, and so do you. We can play to win with both our time and our money by focusing on determining the asset mix policy best suited to our true long-term objectives, and by indexing our investment assets. You've been listening to Winning the Loser's Game by Charles D. Ellis. Narrated by Andrew B. Werlin. Copyright 2021 by McGraw-Hill. Published by arrangement with McGraw-Hill. Recording copyright 2021 by McGraw-Hill Ascent Audio.
Audible hopes you have enjoyed this program.